Please like, share, and subscribe. Wishing you happiness and good luck every day.
You ever feel like you're just a tiny little player in this huge, massive stock market? Well, what if I told you that's actually your biggest advantage? Today we're going to dive into a really powerful idea from Daryl Guppy's classic book, Trend Trading. And it all boils down to this: you need to be a flea on an elephant.
And we're going straight to the source for this one. Yeah, everything we're talking about today comes right out of the preface of Daryl Guppy's Trend Trading. And trust me, it's a way of thinking that completely flips what most people believe about trading, right on its head.
All right, so this is going to sound totally backwards, but this is the first big lesson. In the stock market, you do not want to be the elephant, right? You don't want to be that huge, lumbering giant trying to push the market around. No, the real power, it comes from being something way, way smaller. And that, of course, brings us to our main idea for today, the flea and the elephant. This simple picture, this metaphor, is honestly the key to understanding your real role as a trader and, where your true strength actually lies.
So here's the idea, in Guppy's own words. Think about it. The elephant, that's the market trend. It's this massive, unstoppable force. And you're the flea. You don't get to tell the elephant where to go, right? You can't create the trend. Your entire game is about being small, being nimble, and being smart enough to see which way that elephant is headed, and then just hitching a ride.
Okay, so to really get this flea mindset, we first have to unlearn some stuff. We've got to get rid of some really common and, frankly, just plain wrong ideas about trading. Guppy calls it confused thinking, and it's a perfect description.
So Guppy lays out this whole list of bad assumptions that just trip traders up, Things like thinking you need these massive home run wins to make up for your losses, or that trading is some kind of crystal ball prediction game. But the biggest one, the one that gets almost everybody, it's this idea that every single trade is just a 50-50 coin flip. So that's the million-dollar question, isn't it? Is that actually true? When you go to place a trade, are your odds really just 50-50, just like guessing heads or tails on a coin? Because, let me tell you, the answer to that question changes everything about how you look at the market.
All right, this is where things get really cool. Guppy just tosses that whole coin flip idea right out the window, and instead, he brings in a concept from a completely different world to explain how markets move. He brings in physics. Yeah, seriously. Think of it like Newton's laws, but for the stock market.
The concept is called price inertia, and it's basically Newton's first law of motion, right? An object in motion tends to stay in motion. Well, Guppy says a price trend works the exact same way. A price that's already moving in one direction is simply more likely to keep going in that direction unless some big outside force, like major news, comes along and knocks it off course.
And check out how the actual probabilities break down. Even in a totally flat, sideways market, it is not 50-50. Guppy figures there's a huge 70% chance the price just keeps doing what it's doing, moving sideways. That only leaves a tiny 15% chance of it breaking out up or down. See? The path of least resistance is for it to just continue. But now, watch what happens when you have a real established uptrend. That price inertia, that physics, it really kicks in. The probability that the price will keep going up, it jumps to 75%. And the chance of it suddenly reversing, that drops down to just 10%. The momentum is real, and it's literally stacking the odds in your favor.
And what about a downtrend? Well, think of it like gravity just takes over. We all know prices tend to fall way faster than they rise, so it makes sense that the probability of a downtrend continuing is even higher, a staggering 80%. It is so much harder to fight against that downward pull.
Okay, so let's put the numbers together for an uptrend. If you've got a 75% chance it keeps going up, and another 15% chance it just moves sideways, what's that add up to? That's a 90% probability that the price will either be the same or higher. All of a sudden, trading with the trend doesn't feel like a 50-50 gamble anymore, does it? Not even close.
So we've got the physics down. We see the probabilities. The big question is, how do we actually use this to get on that elephant?
And this quote from Guppy just nails it. Your job is not to be a hero. You're not trying to start a trend. Your job is to be more like a detective. You're just looking for the crowd, for that momentum, for that elephant that's already moving with a ton of force in one direction. And then you just join them for the ride.
So what does this actually look like in practice? Well, it's pretty much a four-step process. Step 1, find the elephant.
That means identifying that strong dominant trend. Step 2, understand the odds. You have to really get it in your head that the probabilities are now stacked in your favor. Step 3, hitch that ride. You place your trade with the trend, never against it. And then step 4, and this is the really crucial part for any flea, you have to have the discipline to know when that ride is over and when it's time to get off.
At the end of the day, this isn't just some new trading strategy. It's a complete shift in how you think. It's about finally understanding and using your real advantage as a trader.
Look, the old way is all about prediction. It's about trying to guess the future, which is super stressful and usually doesn't work out so well. It's basically fortune telling. But this flea mindset, it's all about probability. It's about seeing what's happening right now, identifying the current reality, and riding that wave. Now, it takes a ton of discipline, for sure, but it puts the odds squarely on your side. You stop trying to be a fortune teller and you become a trend follower.
And really, that's the whole ballgame. So, I'll just leave you with this one question to think about. Are you burning yourself out, trying to predict where the market is going to go next, or are you ready to just find the elephant and ride the trend?
Welcome to The Explainer. Today we're going to tear into the first chapter of a really popular trading guide to figure out what are the real first steps to making money in the market. And trust me, it's probably not what you think. All right, so let's just jump right in. You're ready to start, right? You open up your trading platform and bam, you're hit with this. On just one major stock exchange, you're looking at over 1,500 different stocks to choose from. I mean, for a beginner, that is an opportunity. That's just a wall of noise.
So where do you even begin? That's the million-dollar question, right? Well, what's so interesting about the guide we're looking at today is that the answer isn't go find a hot stock. No. The real first step, it says, is to unlearn all the myths, the bad advice that holds pretty much every beginner back.
Okay, so let's get into our very first myth. And it's a big one. It's this fantasy, this idea that to be a successful trader, you've got to quit your day job, maybe put on one of those green visors, and just stare at 6 monitors all day long.
And this is a huge mental block for so many people. You start thinking, man, do I have to go all in just to make this work? You get this fear that it's an all or nothing kind of game. But the answer we get from our source, it's really direct. And honestly, it's pretty liberating. The answer is just a flat-out no. It's that simple. In fact, the author goes even further. They argue that not only do you not need to be a full-time trader, but that starting out part-time is actually the smartest, most effective way to go for pretty much everybody. And this chart, this shows you exactly why that's true. Just take a look at these results from a study of beginners. See that first yellow bar? That shows that by using a really simple part-time strategy, they got a 16% return on their capital. Now, look at the third bar. That's the market index. Over that same time, the market actually lost 13%. I mean, that's not just beating the market, that's a massive 29-point outperformance. It's huge. Okay, so we've got that settled. Part-time trading can absolutely work. But that brings up another question. If you're not a full-time trader, then what exactly are you? And this leads us straight into the next big myth, which you could call an identity crisis for beginners. Are you a trader or are you an investor? We usually think of it like this, don't we? A trader, that's the short-term gambler, flipping stocks in a few days or weeks. An investor, well, that's the wise, long-term planner, holding on to stocks for months or even years. Seems simple enough. But here's the thing. According to the guide we're exploring, this super common idea is one of the biggest and most damaging misconceptions in all of finance. Defining yourself by how long you hold a stock, apparently, that's a trap.
Now, this slide right here completely flips the script. Look on the left at the correct division. See how both long-term and traders are under the same big umbrella? The real difference isn't about time at all. It's about your objective. It really all boils down to just one question. Why did you buy that thing in the first place?
So a true investor from this point of view is someone who's focused on an asset that actually generates an income stream for them. Think about buying a rental property to collect the monthly rent, right? Or buying a stock specifically because it pays out a consistent dividend. The income itself is the main goal.
And a trader? Well, a trader, on the other hand, is anyone, and I really mean anyone, who buys an asset with the main goal of selling it later for a higher price. It honestly doesn't matter if you plan to hold it for 10 minutes or 10 years. If your profit is coming from that capital gain, from the price going up, you're trading.
And that brings us to what might be the most important difference of all, which you can see right here in this diagram. It's all about how you look at risk. See that investor row?
They believe the main risk is in making the decision before they buy. But for the trader, the real risk, the real game, begins after they buy. It's all about managing that position and knowing when to get out.
All right, let's get to our final myth, and you'll see how this builds on everything we've just talked about. And this one is a trap that catches not just beginners, but, even experienced folks who really should know better.
I mean, think about it. In pretty much every other part of life, we assume this is true, right? More knowledge equals more success. The more you study, the more you learn, the better your results get. It's just a straight line up.
But in trading, the reality looks more like this. And this is kind of shocking. Look at the bottom axis. That's your knowledge going up. The side axis is your ability. So at first, as you learn, your ability goes up. But then you hit what's called plateau 1. You try to learn more advanced, complicated stuff, and suddenly your performance starts to drop. This is the knowledge trap, right there in action.
So this slide kind of breaks down that painful journey. You start out, you're happy, you get some early wins. Then you hit that plateau, and you're just stuck. So what do? You go looking for more complex tools, which just leads to what's called analysis confusion, that tangled mess where everything is telling you something different. And this is where your performance can actually get worse, leaving you frustrated and on an even lower plateau than where you started.
So how do you break out of that cycle? It's not about adding more complexity. It's about consciously choosing simplicity. It's like an artist. The best pictures are built from what you choose to leave out. The most successful traders, they know a ton of stuff, but they only choose to use a few simple, proven techniques. Real success comes from what you decide to ignore.
Okay, so we've just busted 3 huge myths. The question now is, what's the right way to actually begin your trading journey? What should you really be focusing on?
Well, a lot of beginners, they look for a shortcut, right? They sign up for these tip sheets that just tell them what to buy. But this chart, wow, this is a brutal reality check. This was a buy recommendation. And a year later, the stock was down 89%. And the service, they never once gave any advice on when to sell and cut that massive loss.
And this leads to a pretty blunt and honestly very memorable warning from our source. Tips are for waiters. Tip sheets are not for traders. Chasing hot tips isn't a strategy. It's just a recipe for losing your money.
So the real path forward, the way to actually do this, isn't about finding some guru to just give you all the answers. It's about learning the process for yourself. That means you need to prioritize coaching over just getting tips. It means building that foundational knowledge, learning how to actively manage your risk, and really mastering just a handful of simple techniques. It's all about learning how to trade, not just being told what to trade. So what's the big takeaway from all of this? A successful start has nothing to do with finding the next hot tip or becoming some full-time genius overnight. It's about building a solid foundation for yourself based on the right principles. It's about understanding what your real objective is and, maybe most importantly, embracing the incredible power of simplicity. Now that the myths are busted, are you ready to stop following and start trading?
Today, we're diving into a trading strategy that feels, well, a lot more like a fishing trip than a visit to Wall Street. It's a totally counterintuitive way to think about picking stocks. Okay, so let's just jump right in. You've got this vast ocean, right? Literally thousands of stocks floating around out there. How on earth do you find the winners? It's the big question that every single trader has to face. Well, according to trader and author Daryl Guppy, maybe we're looking at this whole thing wrong. He says it's not some complicated financial puzzle we have to solve. Instead, he wants us to reframe it as a fish-finding expedition. Now, that might sound simple, but that little shift in perspective is incredibly powerful. But before we can learn how to fish, we have to understand the common traps that so many people fall into. And that brings us to our first big idea, the myth of the edge, and why that constant search for some secret advantage almost always fails. See, most traders fall into one of two camps trying to get that so-called edge. On one side, you've got the people who follow hot tips. This is basically just an act of faith, right? You're surrendering all responsibility. Then, on the other side, you've got what we can call the arrogance camp. These are the folks who truly believe they're smarter than the entire market. And they're always hunting for that one perfect secret indicator that nobody else has found yet. The problem with just following hot tips isn't just that it's risky. It actually stops you from getting any better. It completely undermines the discipline you need to develop real analytical skills and to, actually manage your trades when things get tough. And that arrogant approach, I mean, just think about it for a second. It's based on the pretty wild assumption that you, working all by yourself, are going to spot something that entire teams of highly paid, super-skilled analysts have all somehow missed. It's a bit of a long shot, to say the least. So, if secret tips and magic formulas don't work, what does? This is where things get really interesting. It leads us to a completely different approach, the Burley strategy. It's all about luring success to you instead of constantly hunting for it. This quote from Guppy just nails the shift in mindset perfectly. He writes, "Smart fishermen are more cunning. They let nature do the work for them. You see, they don't chase the fish, they attract them." So what in the world is Burley when we're talking about the stock market? Well, think of things like specialist financial publications. The source material uses Shares magazine as a perfect example. These publications act like bait in the water. They attract a big crowd of interested traders to a specific group of stocks. And this creates a predictable effect that we can actually observe. Okay, now this is the absolute key to the whole thing, so listen close. The goal is not to believe the magazine's analysis. You're not supposed to buy into their hot stock pick. Not at all. The real goal is to leverage the statistical impact of the crowd that the magazine attracts. You are trading the crowd, not the story. And this is the number that makes it all work. 80%. This is the statistical edge that the entire strategy is built on. So what exactly does it mean? Well, if we look at the chart, we can see exactly where this number comes from. The data shows that stocks that are already in a clear uptrend when they get featured in a publication have an 80% probability of continuing that trend for the next 2 months. Now, it's not a crystal ball, it's no guarantee, but that is a powerful statistical tailwind to have at your back. So how do you actually apply this? The process is surprisingly simple. First, you spot the Burley by identifying which stocks are being talked about in these publications. Second, you check the current. You have to verify that the stock is already in an established uptrend, meaning its price has been consistently climbing. And finally, you cast your line. You trade with the trend, knowing that probability is on your side. It almost sounds too simple, doesn't it? A system with an 80% probability of success. But this is where our story takes a really fascinating turn. Let's look at the human factor, because there's a surprising twist. To put this all to the test, Guppy ran a workshop experiment. He had 9 different groups across Australia. And get this, they were all given the exact same list of stocks from the exact same magazine issue. They were taught the exact same Burley strategy. Everybody had the exact same information. So, their results had to be identical, right? I mean, if the system is the same and the information is the same, the outcome should be the same, shouldn't it? Not even close. The results were wildly different. As you can see right here, returns varied from a low of just 6.33% in one group to a high of 16.19% in another. That's a massive difference. So what was going on? The difference wasn't the system. The system worked. The difference was the people applying it. Personal bias snuck in and influenced which stocks each group chose to trade and, just as importantly, how they manage those trades. And this slide is the proof. Even with the same exact system, the groups picked different stocks. Only a single one, TAP, was chosen by everybody. Every other decision was unique, driven by the collective bias of each group. Some were feeling optimistic, others were more conservative. And this brings us to the most important takeaway from this whole exercise. Let's talk about finding your real edge. It all comes down to this single quote. It is not the information you have that is important. It is what you do with the information that counts. Every single one of those groups had that same 80% probability working for them. Their results were determined by how they chose to act on it. So your true trading edge isn't some secret indicator or a hot tip. It's internal. It's your skill in consistently applying a strategy. It's your discipline in managing risk and sticking to your plan. And maybe most of all, it's your self-awareness, your ability to recognize and manage your own biases. And that leaves us with a final question to think about, not just in trading, but in pretty much any big decision we make. What is the biggest bias affecting your decisions? Today, we're going to talk about a single fundamental belief about the stock market. It's a belief that a lot of us have, and honestly, it might be quietly draining your portfolio. We're going to explore a completely new way of thinking, one that can shift you from being just a passenger to being an active traveler, totally in control of your own investment journey. So let me just ask you this. What do you think is the single most fatal belief an investor can have? It's not about picking the wrong stock. Not really. It's not about getting your timing wrong. It's something much, much deeper. It's a basic misunderstanding of what your role in the market actually is. And by the end of this, you'll know exactly what I'm talking about. All right, let's start with this idea that's super common, and it's pretty comforting. It's this idea of what it means to own a share of a company. It's the story we all tell ourselves about being a partner in some great business. And look, this belief is nothing new. It goes way, way back to the very first joint stock companies. You had these brave investors who would pool all their money together to fund these super dangerous voyages to the Spice Islands. Now they were true partners. They funded the ship, they shared in the amazing profits, or, they shared in the shipwreck. And that romantic idea, it's stuck around ever since. I mean, why wouldn't it stick around? The whole idea of being a partner is incredibly attractive. You share in the risks, sure, but you also get to share in the rewards. You feel like you're part of something huge, something important, and that your voice actually matters. It's a really powerful story, but that's all it is, a story. And this is where we need to get real for a minute, because holding on to this old-fashioned idea isn't just a little bit wrong. The source material we're looking at argues it's a dangerous, maybe even a fatal illusion. What's really fascinating is when you put this feeling of being a partner up against the cold, hard reality of power. Because a true partner, a real partner, doesn't just own a piece of paper. They have actual, genuine influence. Think about it. A true partner can help make management decisions. They can have a real say in who gets hired and fired. They get to help set the whole strategic direction for the company and can actually sway the big, important decisions. They literally have a seat at the table. So let's just be brutally honest here. Can your 100 shares in some multi-billion-dollar company do any of that? Seriously, can you pick up the phone, call the CEO, and suggest a new business strategy? The reality is, in almost every case, if you try to agitate for any kind of real change, you'll be fought tooth and nail by the very people you think you're in a partnership with. And this chart just lays it out perfectly. On one side, you've got a powerhouse like Warren Buffett. When he invests, he often gets a seat on the board. He has an enormous influence on decisions. He is a true partner. And then there's us, the typical shareholder. We get to vote at the annual general meeting. We can write a letter to the board. There is a gigantic gap in actual real-world power. And hey, this isn't just some theory. Check out this real-world example from the insurance company AMP back in 2003. When they needed to raise a bunch of money, who did they go to? Not their small shareholders. Nope. They cut a deal with the big institutions, all behind closed doors. The people they called their partners, the everyday investors, they were left out completely and then offered a much worse deal. That one event showed exactly who the company saw as its real partners. Which brings us right back to that question I asked at the beginning. According to our source, this is it. Believing you're a partner when you have absolutely no real power is one of the most fatal beliefs you can hold. Why? Because it makes you hold on when you should sell, it makes you trust when you should be skeptical, and it leaves you feeling betrayed by a partner who, let's face it, never really saw you as one in the first place. Okay, so if the whole partner idea is a broken model, what's the alternative? Well, the source suggests a much more powerful and, frankly, more useful way to think about it. Just picture the market as one giant highway. And this right here is the big question. If you throw out this whole deceptive idea of being a partner, what role are you actually playing? The answer, my friends, is incredibly liberating. You are a market hitchhiker. Just think about that for a second. A hitchhiker stands by the side of the road, right? And they flag down a car that is already going in the direction they want to go. They don't know the driver, they definitely don't control the car, and they have no idea where that car's final destination is. They are simply along for the ride, for as long as it's going their way. So here's the absolute key. Your goal isn't to grab the steering wheel. It's just to get from your point A to your point B. Sometimes, like that line on the left, you get really lucky and catch one long, smooth ride all the way there. But let's be real, more often your journey is going to look like the one on the right. It's a whole series of shorter trips. You get out when one ride is over or when it changes direction, and then you just find another one. Now, this shift in how you see yourself from partner to a hitchhiker, it's not just some philosophical mumbo-jumbo. It actually simplifies your entire strategy down to just a couple of clear, simple, actionable rules. This is where all your power is. As soon as you accept that you can't control the company, you can't control the management, you can pour all of your energy into the only two things you actually have control over, deciding when you get in the car and deciding when you get out. That's it. So the strategy becomes incredibly simple. Step 1, find a ride. That means you only pick stocks that are already moving up, what traders call an uptrend. You're just looking for a car that's already going in your direction. Step 2, get off. The second that stock's trend changes and it's not going your way anymore, you get out. No second guessing, no emotional attachment. You just exit and wait for the next ride. Let's go back to that AMP chart one more time, but now let's look at it with our new hitchhiker eyes. Okay, if your goal is to travel north, to make money, why in the world would you try to hitch a ride with a car that is so obviously, so consistently driving south? A hitchhiker would never, ever do that. And yet investors do it constantly, and they call it buying a bargain. Okay, let's bring this all home. By letting go of that partner illusion and really embracing the hitchhiker mindset, you completely change your relationship with the market. You take back control of your own journey. This is what it all boils down to. You're not some powerless partner. You are an agile traveler. You accept you don't control the driver, the management. You're just along for the ride. And the most important part, you have the absolute freedom to get off at any time for any reason. That freedom, that is your greatest strength. So now you've got the rules of the road. You understand the mindset of a traveler, not a powerless partner. But that leads to the next big question, doesn't it? If the market is a highway full of different vehicles, how do you get good at spotting the fastest cars? How do you pick the best ride? All right, let's jump right in. When you think about what makes a trader successful, what's the first thing that pops into your head? For a lot of people, it's this idea of some kind of hidden secret. Like some exclusive piece of information or a crazy expensive trading tool that gives them this unbeatable edge. But what if I told you the biggest secret has nothing to do with the market and everything to do with what's going on right inside your own head? And boom, this quote from Daryl Guppy it nails it. It cuts right to the chase. The real game isn't about outsmarting the charts. It's about mastering ourselves. It all comes down to how we handle the two most powerful emotions that drive every market: greed and fear. And this slide just lays it all out, plain and simple. On the left, you've got the myth, the idea that you need some secret knowledge, some exclusive tool, some informational edge. But the reality is that true success comes from things you just can't buy. It comes from trading skill that you build over time, the emotional discipline to actually stick to your plan, and a psychological edge over your own impulses. So that's the big takeaway here. The real edge in trading isn't something you download or subscribe to. It's you. It's something you have to build inside yourself. It all comes down to your decisions, your discipline, and how you react when the pressure is on. Okay, so let's really put this idea to the test. Let's run a little thought experiment. Imagine a world where every single trader is looking at the exact same chart with the exact same indicators, and they all enter a trade at the exact same price. Now, if information was the only thing that mattered, everyone should get the same result, right? Well, let's see about that. We're about to find out together. Welcome to what we're calling the test. We're going to walk through an exercise where the playing field is perfectly level. There are no secrets, no hidden info. You just get to see how your own decisions stack up. The rules here are super simple. We've got one stock, one chart. We all hypothetically buy in at exactly 32 cents. Now, from that point on, the only thing that changes is you. You get the same data as everyone else at the same time, and you have to decide when, or even if, you should get out. It's a pure test of your judgment. Okay, so let's dig into the trade itself. How did we even land on this entry point? Well, it wasn't a random guess, that's for sure. It was based on a pretty common, specific trading strategy. This chart shows the setup perfectly. What we're looking at is a classic breakout. See that horizontal line? Think of it like a ceiling that the stock price just kept hitting its head on over and over. Our entry, at 32 cents, happens the moment the price finally smashes through that ceiling. That's a huge signal that the trend might be reversing from down to up. It's a standard by-the-book entry. And it wasn't just that one signal. We had other data backing it up. See that spaghetti-looking cluster of lines at the bottom? That's an indicator called the Guppy Multiple Moving Average. All you really need to know is that when those lines squeeze together and start pointing up, it suggests that both short-term traders and long-term investors are starting to agree. They think the price is heading higher. It's basically another big green light for the trade. So we're in the trade. Everything's looking good. The signals are aligned. But as anyone who's ever traded knows, the market never just sits still, does it? Now comes the hard part, managing the trade. And it's time for you to make your first critical decision. 6 days go by. The initial excitement of that perfect entry is gone. Now we've got new data, a new looking chart, and a brand new choice to make. Just look at this comparison. On the left, you've got that clean, beautiful, promising entry point. And on the right, well, that's the reality 6 days later. The price has moved, sure, but the picture isn't quite as clear anymore, is it? Let's zoom in on that new data. And here's where things get messy. The data is no longer screaming buy. The indicators are starting to give us mixed signals. See how that top line, the RSI, has pulled back a bit, and the moving averages are kind of flattening out? That clear, powerful upward momentum we had, well, it's taken a pause. Now, is this just the market taking a quick breath before the next big move up, or is it a warning sign? The chart itself doesn't give you a clear answer. So this is it. This is your first decision point. The data you're seeing is totally objective. It's the same for everybody. But how you interpret it, that's all you. So what's your move? Do you exit the trade, maybe protect what you've got? Or do you stay in, trusting your original analysis? It's your call. Okay, whatever you just decided, whether you decided to stay in or get out, is absolutely fascinating. Because now we're going to shift gears. We're not analyzing the chart anymore. We're analyzing you. And this is where the real lesson begins. And listen, this is the most important point of this whole explainer. There is no single right answer here. I guarantee you, profitable traders could be on both sides of this decision. The real question, the one that actually matters, is why. Why did you make the choice you made? Was it based on a clear, disciplined trading plan, or was it based on something else? And that's the question that really defines a trader's entire journey. So ask yourself honestly, did you decide to exit because you were afraid of losing the little bit you'd gained? Or did you decide to stay in out of greed, just hoping for that massive win, maybe ignoring some of the warning signs? Your answer to that question reveals whether you're being driven by cool, clear-headed analysis or by those same timeless, powerful forces we talked about at the beginning, greed and fear. And understanding that difference, deep down, that is the real secret. You know, what if I told you there's a test that could totally change your trading game? A test so simple a kid could do it, but so powerful it could help you dodge huge losses and pick absolute winners. Okay, let's just dive right in and pull back the curtain on stock chart analysis with this one surprisingly simple technique. So to really get this, we first need to kind of reframe how we think. And we're going to use an analogy. Expert trading, well, it's a lot like expert fishing. Think about it for a second. A really good fisherman doesn't just wander out and throw a line in anywhere, right? No, they go to the right spot, they use the right bait, and they use a bigger hook, so they're not wasting time on the little fish. They're trying to land a good catch. Well, a trader does the exact same thing, just filtering the market for the best opportunities. The goal isn't always to catch a monster or, get a 100% return. It's about consistent catches that put food on the table. And maybe most importantly, when the weather turns bad, they're okay with losing a hook, not the entire boat. Yeah, this really isn't about luck or just having a gut feeling. It's all about process. An experienced fisherman has a routine, right? A whole series of tests they run through before they even leave the dock. A successful trader needs that exact same thing, a solid, repeatable process to cut through all the noise. So what does a routine like that actually look like in trading? Well, it's a framework called the 7 Sacred Tests. Think of it like a trader's personal toolkit for picking the absolute best opportunities from a huge sea of possibilities. So the whole process involves finding the right stock, testing its trend, its character, the price, your position size, and then finally, its performance. Now, they're all super important, but for now, we're going to zero in on just one. The second test. It's really the foundation for everything else, and honestly, it's brilliantly simple. And this is really the core of our explainer today, the eyeball test. It doesn't need any complex indicators or fancy software. Nope, just your eyes and the ability to see what's right there in front of you. The whole concept is just beautifully simple. At any given moment, a stock chart is only doing one of 3 things. It's going up, it's going down, or it's going sideways. That's it. And for our purposes, as traders who follow trends, we are only interested in one of these, a clear, undeniable uptrend. So here's the crucial point. The eyeball test is supposed to be a quick, intuitive judgment. You just look at the chart and you decide, is the price overall going up? It's all about stripping away all the noise, all the opinions, and just making a simple, objective call. But here is the crazy part. The more experienced you are as a trader, the harder this simple test can actually be. We bring all our biases, right? Our knowledge about a company, what we read in the news. All of this experience can actually blind us to this simple message the price is screaming at us. And this brings us to this amazing idea called the Tim Tam test. The idea is you show a chart to a little kid and you ask them, up, down, or dunno. And their payment? A chocolate cookie. See, they have zero bias. They have no emotional connection to the stock. They just see the lines on the page. And that totally unbiased opinion, well, it has the potential to save you thousands of dollars. Okay, that's enough theory. Now it's your turn. You get to be the unbiased kid. I'm going to flash a few charts up, and I want you to make a snap decision. Based only on that eyeball test, would you even consider buying this? Yes or no? Ready? Let's do it. All right, here's chart A. Just a quick glance. Is the overall trend going up? What's your immediate gut reaction? Okay, next up, chart B. Does this one pass the eyeball test? Is this a trend you'd want to jump on, trade, or pass? Let's take a look at chart E. What is the price action telling you here? Just a simple yes or no. And last one, chart G. Take a look at that overall direction. Would you put your money here? All right, time's up. You've made your calls based on nothing but a pure, unbiased visual check. So let's get to the debrief and see how this one simple test could have played out in the real world. So let's look at the results. Chart A, that was a clear reject, and passing on that one would have saved you from a 63% loss. Ouch. Charts B and E, both were pretty clear uptrends, and they went on to deliver profits of 154% and 87%. And chart G? Yeah, rejecting that downtrend was definitely the right move. In this right here just perfectly illustrates the whole point. On the left, you've got chart E, a nice, clear, smooth uptrend. On the right, chart A, a clear downtrend. I mean, when you take away all the noise, the choice becomes so obvious, doesn't it? The difference between a huge win and a painful loss can be this visually clear. So, what were these mystery charts? Well, chart G, the one in that obvious downtrend, that was the blue chip giant BHP Billiton. And the two big winners, charts B and E, they were lesser-known stocks, Timber Corp and Great Southern Plantations. And this is exactly why being objective is everything. Knowing a company's famous name can create this dangerous bias that makes you want to see an uptrend that just isn't there. So, after that first simple eyeball test, the stocks that passed were put through the rest of the 7 tests. And at the very end of that tough filtering process, only a single stock was left standing as the #1 pick. That stock was Timber Corp. And the final result of that one carefully chosen trade? A 154% profit. That is the incredible power of a disciplined, objective process that all starts with the simplest test you can imagine. So, look, if you take only one thing away from all this, let it be this. Your personal opinion of a stock does not matter. What you think a stock should be doing is totally irrelevant. The only thing that counts is what the market is actually doing, and that whole story is written right there in the price chart. So I'll leave you with this to think about. What new opportunities might you see, and what huge mistakes might you avoid when you finally stop telling the market what you think and just start to listen? You know, we've all been there, staring at our portfolio, watching that one stock, the one we were so sure about, just keep dropping day after day. It's so frustrating, it can drive you crazy, and honestly, it's one of the biggest puzzles in investing. Why is it so incredibly hard to just sell a losing stock? So in this explainer, we're going to get into that feeling. We're going to look at a stock that pretty much represents a universal and, let's be real, often painful investing experience that we all share. Okay, so take a look at this weekly chart. This isn't some made-up example. This is the real slow-motion car crash of someone's capital over 3 long years. And here's the craziest part. thousands of smart, totally rational people held onto this stock all the way down, just convinced it was going to turn around. So I'll ask you straight up, if you had bought this thing near the top, what would have kept you from selling? What's the story you would have told yourself as the price just kept grinding lower and lower? Well, what's really fascinating is just how creative we get with our excuses. I mean, do any of these sound familiar? Oh, but it's a quality stock, it's a blue chip, or they're an industry leader, or my favorite, it's so low now it has to bounce back soon. And of course the classic, I'm in it for the long term, which, is often just a code for, I really can't afford to admit I was wrong and take this loss. But here's the thing, all those excuses are just symptoms of a bigger problem. If we want to find a real solution, we have to dig a little deeper. We need to understand the psychology behind it all. Because this isn't about bad luck, it's about our own brains. And hey, the first thing we've got to get out in the open is this: you are not alone. I promise you there isn't a single investor on this planet, no matter how experienced they are, who hasn't held on to a loser for way too long. It happens to literally everyone. So let's just get rid of any sense of shame right now. And this is the absolute key right here. This is not an intelligence problem. Really smart, successful, highly educated people do this all the time. It's an emotional problem. It's a behavioral habit that just gets in the way of success. And like any bad habit, we got to find strategies to manage it. All right, now let's dive into one of the most fascinating parts of this whole puzzle. It's this deep paradox. The very same traits that make people incredibly successful in their careers and in business can be the exact things that cause them to fail in the market. The core idea you just have to get into your head is this: the financial market is not just another part of your business career. It's a totally different world, and it has a completely different set of rules. For example, think about determination. In business, it's heroic, right? We love stories about entrepreneurs who just refuse to give up. But in the market, that same determination becomes a huge liability. Your willpower doesn't change a stock's price. The market rewards humility, the ability to say, I was wrong, not stubbornness. Or what about hard work? In business, more effort usually leads to better results. But the market, it completely breaks that link. You could research a company for 100 hours, but if the price is going down, well, it's going down. Success in this game really just boils down to two simple things: when you buy and when you sell. And finally, there's single-mindedness. That's what helps you build a company from nothing. But in the markets, it often just turns into stubborn, bloody-mindedness. We get obsessed with our idea of what a company should be worth, and we totally ignore what the price is actually telling us. We have to remember, we don't trade the company's story, we trade its price. So, if the very things that make us successful everywhere else can lead us astray here, what are we supposed to do? Well, fortunately, there's a simple but absolutely brilliant tool you can use to trick your own brain into seeing things more clearly. Look, the truth is, we can't just wake up one day and decide, okay, I'm not going to be biased anymore. It's just baked into who we are. But we don't have to eliminate it. We just have to outsmart it. All right, look closely at chart A. What do you see? Our natural bullish bias sees a nice, clear uptrend. The price pulled back to the trend line, it bounced, and it looks like it's ready to keep going higher. It feels like a buying opportunity, right? A simple trend continuation. Okay, now let's look at chart B. Here we see something different. A long downtrend that has finally been broken. The price is starting to make higher lows, and our optimistic brain just screams, this is it! A brand new uptrend is starting. Get in early. So here they are, side by side. Two charts, and both of them are whispering these really bullish ideas into our ear. One looks like a solid trend just continuing on its way. The other looks like an exciting new trend just beginning. So which one is the better trade? And this is where the trick comes in, and it's brilliant. They are the exact same chart. Chart A is just chart B flipped completely upside down. Just let that sink in for a second. Our built-in optimism, our natural desire to be a buyer, made us look at the exact same price data and see two completely different and contradictory things. In one direction, we saw a continuation. In the other, we saw a total change. That right there is our bias, live and in action, just clouding our judgment. So where does all this leave us? What's the real lesson here? Well, it all comes down to the single most important trade you will ever make in your entire career. The goal isn't to become a totally different person. It's just harm minimization. It's about recognizing these destructive patterns and then using simple tools like flipping a chart upside down to remove the emotional trigger. It's about changing how you see the market, not fundamentally changing who you are. Because in the end, it's not about finding the perfect trading system or the next hot stock. Success really rests on this one powerful, simple truth. It all comes down to our ability to manage ourselves. The toughest opponent you will ever face in the market isn't some big hedge fund. It's the person looking back at you in the mirror. And that is the one trade that's truly worth mastering. Okay, picture this. Two pro traders looking at the exact same chart. One sees a golden opportunity, the other sees a massive red flag. How does that happen? Well, today we're going to dig into that, and we're putting you right in the middle of a real trade to figure it out. I mean, it's the biggest question in trading, right? We're all staring at the same lines, the same indicators. So why on earth does one person see buy while someone else is yelling sell? What's the missing piece of the puzzle here? Well, it turns out the answer isn't really on the screen at all. It's inside our own heads. Every single trading decision gets filtered through this constant push and pull between fear and greed. To really see how this plays out, let's jump into our first decision point. All right, so here we go. You're in the trader's seat now. You've got a live trade going, it's moved in your favor, and now this pops up on your screen. The question is pretty simple. Do you take your profits and get out? Okay, let's take a look at what we've got. Over on the left, that's the price itself. You can see it had a nice run up, but now it's kind of stalling out. And on the right, these are our technical indicators. The RSI, that measures momentum, it's pulling back from its high point. The MACD histogram, which can hint at trend changes, is looking a little weak. And see these ribbon-like lines? Those are the Guppy moving averages. They're starting to squeeze together, which, that often happens when a trend is running out of gas. As you can see, there's nothing here that's screaming one thing or the other. It's complicated. So what's your gut telling you? What's your call? Are you looking at this and seeing weakness, thinking, I should lock in these gains? Or do you see this as just a little pause before the next leg up and decide to hang on for a bigger win? Go ahead, make a mental note of what you do right now. Okay, you've made your choice. Now let's see how you stack up against a whole bunch of other traders who are in this exact same spot. This chart shows the percentage of people who decided to exit. What do you think that number is? 1%. That's it. Can you believe that? Out of everyone looking at this same chart, only a tiny, tiny fraction saw enough reason to get out of the trade. The other 99%? They decided to stay in. So what did that 1% get for their decision? Well, they locked in a solid 6.25% return and walked away. And that brings up the big question, right? Were they just being fearful, or did they see something brilliant in the charts that 99% of other traders completely missed? To really understand this, we've got to get inside the head of a trader at that exact moment. Let's break down the technical arguments for both sides of this trade. Because for every single signal that was screaming get out, there was another one whispering stay in. And that's the thing about trading, isn't it? It's almost never a simple black or white decision. This table here really lays out that internal conflict perfectly. Okay, so the folks who wanted to exit, they were pointing to a classic sell signal, the MACD histogram crossing below zero. Plus, those moving averages were tightening up, suggesting the trend was losing steam. But the stay camp, they were focused on the fact that the price was still safely above their stop loss. And they saw the short-term averages kind of bouncing off the long-term ones, which to them was a sign of real underlying strength. And this is what makes this so fascinating. Both sides had totally valid reasons. Neither one was absolutely 100% correct. It all just boiled down to which pieces of conflicting evidence a trader decided to pay attention to. But for the 99% who decided to stay in the trade, the story was far from over. A few days go by, and the chart now presents a whole new, and maybe even trickier, decision. So the price did actually rally a bit, but then it pulled back, and then it bounced again, and that new price action lets us draw in a new, pretty clear trend line. But here's the kicker. Look where the price is now. It's testing that exact trend line. If it breaks below that, well, that could be a huge reversal. And if we go back and look at our indicators, yeah, the picture is still a total mess. Some signals are suggesting the trend is getting weaker, but others are still neutral or even kind of bullish. The easy, clear answer we were hoping for, it never showed up. In fact, things are even more confusing now. So, the ball is back in your court. The trade has changed, you've got new data, but it's just as conflicted as it was before. What do you do now? Do you finally get out, or do you trust that trend line to hold? What's your next move? You know, this whole exercise, it wasn't really about finding the right technical answer. It was designed to show you something much, much deeper about trading. Something you could call the real secret to the game. And this quote from the source material just says it all perfectly. There is no right answer. This is one of the characteristics that makes trading so difficult to master. The challenge isn't just about reading a chart. It's about being okay with making big decisions when you're never fully certain. Mastering trading is about learning how to thrive in that gray area. So the real lesson here is this. Becoming a successful trader isn't really about finding some magic indicator. It's about knowing yourself. It's about truly understanding how much risk you can handle. It's about managing that internal battle between your own fear and your own greed. And maybe most importantly, it's about having the discipline to stick to your plan, no matter how loud the noise gets. Because at the end of the day, the chart is always going to give you mixed signals. The real secret isn't finding some hidden message on the screen. The secret is what you choose to do when faced with all that uncertainty. What you decide to do next, that's what defines you as a trader.
Trend lines. You've probably heard of them, right? They're one of the very first tools that every trader learns. But what if I told you that the way most people use them is just fundamentally wrong? I mean, it leads to nothing but frustration, confusion, and a whole lot of missed opportunities. So today we're going to dive into this and really demystify how to use trend lines not as some kind of crystal ball, but as an incredibly powerful tool for planning.
To really get this, let's start with a story, an analogy. I want you to imagine you're out on the water, fishing. You've got two lines out, and then all of a sudden, bam, you get a hit on both lines at the exact same time. It's chaos. You've got literally a split second to make a choice. One fish is just making a beeline for a tangled mess of mangrove roots. You know that's going to be a nasty fight, probably a tangled line, maybe even lost gear. The other fish, though, it's heading for open, clear water. You can only pick one. So, which one do you go for?
It's a no-brainer, right? The smart move is always the fish in open water. It's the simpler situation, it's the more manageable one, it's the trade where you have the highest probability of success because you can actually see what you're up against. This isn't about giving up on the other one. It's about choosing the battle you're most likely to win. And believe it or not, that is exactly what a trend line should help you do.
Okay, so keeping that fisherman in mind, let's just make sure we're all on the same page about the absolute basics. How do we actually draw these things? Honestly, it's probably simpler than you think.
All right, let's get the textbook definition out of the way, nice and quick. In an uptrend, you're just connecting the lows, creating a sort of floor of support.
And in a downtrend, you guessed it, you do the exact opposite. You connect the highs, and that creates a ceiling of resistance. Simple enough?
So for an uptrend, it's really just a two-step dance. First, you spot that general upward movement. Second, you just draw a kind of best fit line that connects as many of those key low points as you reasonably can. That's our starting point.
And this is where the trouble always begins. It's the single biggest mistake that I see traders make with this tool. They stop seeing it as just a simple guideline, and they start treating it like some kind of prophecy.
Now just take a look at this slide. This shows the problem perfectly. We've got a clear uptrend, no doubt about it. But you could pretty reasonably draw at least 4 different trend lines on this exact same data. And this is where all the confusion kicks in.
This is the question that sends traders down a complete rabbit hole. They get obsessed with finding that one single, perfect line that's going to tell them exactly where the price will bounce next. And you can try to make a case for each one. You could say, well, line 1 is the general trend, or line 4 is for a short-term trader. Line 3 is, well, it's pretty much a guess, isn't it? Line 2 looks like the most solid one, right? It connects a bunch of lows. But that real question is still hanging there. Which one is the magic predictor?
The answer is none of them. None of them are going to predict the future. And this belief, this idea that one of these lines holds the secret code, that's the trap. It's what makes traders feel faked out when the price dips just below their perfect line, only to rip higher again. It sends them on this hopeless quest for a perfect tool that just doesn't exist.
Okay, so if it's not for prediction, then what on earth is it for?
This right here, this is the core insight that changes everything. This reframes the trend line from some mystical object into a really practical, useful tool.
Let's just let that sink in for a second. The trend line does not predict the future. Its whole purpose isn't to tell you what will happen. Its power lies in something much, much more useful than that. So let's actually look at what happened next on that chart. See how the price just slices right through lines 4 and 3 like they're not even there? But then, look at how it interacts with line 2. It kind of dances around it for a while before the trend finally gives up. What does that tell you? No single line was a perfect predictor.
And this slide just lays it all out, perfectly illustrating the difference. Line 3, the one based on just 2 points, that was a failed prediction. It gave a false exit signal way too early. But line 2, the one that connected lots of historical lows, that acted as a fantastic planning tool. It didn't predict the exact top, nobody can, but those several days of closing below it gave a clear, manageable signal that the character of the trend was changing. It gave the trader time to react based on a plan. So here's the crucial point. A trend line's real job is to define the current balance of probabilities. That's it. As long as the price is staying above a well-drawn uptrend line, the probability favors that trend continuing. The moment it closes below, well, the probability shifts. It's an alert system, not a prophecy.
This shift, this jump from seeking prediction to assessing probability, that's the absolute key to using trend lines effectively and, frankly, without going crazy. It's all about creating a plan for what you will do when the probabilities change.
This should be your new mantra. Seriously, every single time you draw a trend line, you're not trying to guess the future. You are drawing a line in the sand for your trade management plan.
So what does that actually look like in practice? Well, it means that a close below your line doesn't mean your line was wrong. Not at all. It's just a signal. It's the market tapping you on the shoulder and saying, hey, the game has changed a bit. And that's your cue to execute your plan. And you have to remember, every line you draw is temporary. It's just a hypothesis that you are constantly testing against new price action.
This is the ultimate question. It's what you need to ask yourself every single time you pull up a chart. Are you staring into a crystal ball hoping to see the future? Or are you a strategist, defining your battlefield and planning your response no matter what happens?
Let's go all the way back to our fishermen. The choice was never about guessing which fish was bigger or better. It was about choosing the situation that was clearer, simpler, and more manageable. And that is exactly what a trend line offers when you use it correctly. A tool to help you define that open water, giving you a clear plan to land your trade successfully.
Hey, if you're a trader, I know you've spent hours, maybe even hundreds of hours, drawing lines on charts, right? But what if I told you that the way most of us use this super fundamental tool, the trend line, is actually completely wrong? Today, we are going to pull back the curtain on the surprising truth about trend lines. And trust me, this simple shift in perspective could totally revolutionize your trading.
So let's just dive right in with the big question. Do these lines that we so carefully plot on our charts, do they actually have the power to predict where the market is headed? I bet for a lot of you, the gut reaction is, yeah, of course. That's what they're for. And look, that's what we've all been taught. That's the conventional wisdom. But what if that very belief is the trap that's holding you back? It's a misunderstanding that can lead to this endless cycle of frustration and losses because it totally misses the real reason we should be using trend lines in the first place.
Yeah, this leads us straight into what you could call the trend line trap. It's this non-stop chase for the perfect line. You know, the one that's going to magically tell you the market's next move. But as we're about to see, obsessing over that pinpoint accuracy, it's a complete and total distraction from what really matters.
To really get this, we have to understand that any trade using a trend line is actually made up of 3 separate parts. First, you've got the market itself. Second, you've got the line you draw on the chart. And third, and this is the part everyone forgets, you've got your trading plan. The trap is focusing only on the first 2 and completely ignoring the third.
So let's really dig into that classic misconception. It's all rooted in this idea that our trend line's job is to perfectly define the market, and from there, predict its every twist and turn.
This is the way most of us think, right? We see the price moving, we draw a nice, neat line to match it, and then we tell ourselves, okay, this line now has some kind of predictive power. The whole game becomes about using that line to ride the market.
But here is the simple, almost comically brutal truth.
The market, with its millions and millions of participants all doing their own thing, it has absolutely no idea your trend line even exists. It doesn't see it, it doesn't care. It is a completely one-sided relationship.
And hey, don't just take my word for it. As one expert put it, using a trend line as a tool for prediction gives an easy target to anyone who wants to criticize technical analysis. And honestly, they'd be right. When we treat it like a crystal ball, we're just setting ourselves up for failure.
Okay, so if that's the wrong way to think about it, what's the right way? This is the big turning point, right here. We need to completely reframe this. It's not about the market. It is about your plan.
Here it is, the new paradigm. The true purpose of a trend line is to define our own analysis of a stock so that we can create a concrete plan for how to manage the trade. You see, it's a tool for us, not a rule for the market. The goal is no longer about predicting the chart, it's about managing ourselves.
So look at this. On the left, you've got the old way, using the line to try and ride the market. And on the right, you have the powerful new model, using the line to ride your plan. See how the whole dynamic just flips? The power isn't in the line anymore. It's in your strategy that's built around it.
And that brings us to maybe the single most important sentence you'll hear today. The relationship that actually matters isn't between the trend line and the market. It's between the trend line and your plan. Period.
Okay, that all sounds great in theory, but what does this actually look like in the real world? How does this whole plan, not prediction idea really change how we look at a chart? Let's make it practical.
So let's get real for a second. Take a look at these two charts. Chart A has a super clean, simple trend. Chart B, on the other hand, is a bit choppier, more ambiguous. Now, which one of these is the better trading opportunity? See, instead of asking which one's going to go up more, we need to ask a whole different set of questions. Which one is easier to manage? Which chart gives you a crystal clear signal for when to get out? Which one removes that temptation to second-guess yourself? And maybe most importantly, which one protects your discipline? The answer is Chart A, and not because it's guaranteed to make more money. Nobody knows that. It's because it offers a clear, simple management solution. There's one obvious line, and if the price breaks below it, your decision is already made for you. No debate, no hesitation. So this means your goal as a trader completely shifts. It's no longer about finding the stock you think is easiest to predict. It's about finding the stock that's easiest to manage. Your trend line becomes a filter for clarity and simplicity.
And this brings us to the ultimate lesson in all of this. The true edge in trading, it's not a perfect indicator. It's not some magic line. The real edge is your discipline, your ability to actually follow your plan no matter what. In the end, your actions are the only thing that determine your success.
This idea is captured perfectly in one trader's reflection on a successful trade. They said, the success of the trade was not related to the trend line, it was related to the plan based on the trend line. That's the light bulb moment. Success came from perfectly following the plan, not from drawing the perfect line.
So here's the final choice you have to make. You are so much better off with a so-called imperfect or inaccurate trend line, but a plan that you follow to the letter. That's way better than having a perfect, beautiful-looking trend line with a plan that you just ignore when things get tough. Discipline brings consistency. Perfectionism just brings chaos. If you only take one single thing away from our time together today, please let it be this. Your discipline is infinitely more valuable than your prediction. One is actually within your control, the other is just an illusion.
So from now on, the next time you draw a line on a chart, I want you to stop and ask yourself this one simple question. Am I doing this to build a better prediction, or am I doing this to build a better plan? Seriously, the answer to that question could change everything for you.
All right, let's talk about one of the most powerful and, frankly, one of the most dangerous patterns in all of trading. It's a move that looks like an unstoppable rocket ship, but here's the secret. It has a built-in self-destruct timer. This is the parabolic trend. And today, we're going to figure out how to master trading's biggest curveball. Okay, let's dive right in. Take a look at this chart. This is a stock called Noni B. You see this absolutely insane accelerating climb? It's just going vertical. And then, bam, it collapses. So sudden, so brutal, it's like the floor just completely vanished. This right here is the aftermath of a parabolic trend. It's the kind of thing that can make you a fortune or wipe you out in the blink of an eye. So that brings us to the big question, right? Was this just a random, unpredictable market crash, a total bolt from the blue? Or, and this is the important part, was there a warning sign, a clue hidden in plain sight, baked right into that chart that could have told you almost the exact moment the party was going to end? Well, that hidden warning sign is exactly what we are going to decode today. So let's get right into it. We're going to start by figuring out what this curveball actually is and what makes it so fundamentally different from every other trend you've ever seen. So, what exactly is a parabolic trend? Well, the secret isn't just that the price is going up. It's that the speed of the price rise is increasing. It's accelerating. You should think of it as a chart of pure human emotion. It perfectly captures that moment when rational buying flips into a frenzy, a mania of crowd excitement. And that's why you can never ever define it with a single straight line. Now, this is what's so cool. This slide peels back the curtain and shows you the hidden architecture behind that smooth curve. See, it's not one continuous move. It's actually a series of shorter and shorter trend lines, each one getting steeper and steeper. Every new line is like another jolt of adrenaline, another surge of excitement that just can't last. The beautiful curve you see, it's just the shape that connects this frantic climb. And this right here is where the rules of the game totally change. In a normal uptrend, the rule is simple. Price stays above the line. Easy. But with a parabolic trend, that rule goes out the window. The price has to stay to the left of the curve. But here's the absolute game changer. A normal trend can go on for months, even years. A parabolic trend, by its very nature, it has a precise, mathematically defined time limit. A time limit? On a stock trend? I mean, that's an absolutely ridiculously powerful idea for any trader. It's like having an expiration date printed right on the chart. So the obvious next question is, how do we find it? Let's take a look at how you can spot this deadline before it hits. And we're back at the scene of the crime, the Nonibi chart. But look at it now, with that parabolic curve drawn in. You can see it, right? The price just hugs the left side of that curve as it climbs. It's respecting the pattern. But as that excitement gets more and more frantic, the curve gets steeper and steeper until, boom, it goes completely vertical. That vertical line isn't just part of the pattern. That is the deadline. It's the moment in time where the trend literally cannot continue. So if you remember nothing else from this, burn these two things into your brain. First, these trends end badly. The collapse is almost always fast and violent, often with the price gapping way down. And second, they have a defined time limit. This isn't some vague price target. It's a specific point in time where the probability of a total collapse just goes through the roof. And hey, don't just take my word for it. Listen to how the author of our source material, Daryl Guppy, puts it. He says, this probability is so high that at times it resembles prediction. Now, when a veteran market analyst uses language that strong, you know you're dealing with one of the most reliable signals you can find. Okay, so this is probably the biggest question you have right now. How do I know if I'm actually looking at a true parabolic curve or if it's just a really aggressive but still normal straight line trend? That's a great question, so let's clear that up right now. This chart is the perfect example. On the left, someone tried to force a parabolic curve onto this chart. But look closely. See how the curve completely misses those significant low points where the price actually found support? It just doesn't fit the data. But now, look at the chart on the right. A simple, straight-edge trend line. It connects those lows perfectly. See, the chart tells you which tool to use, not the other way around. Think of this table right here as your field guide. For both trends, your starting point is the same. You want your line to touch as many significant lows as possible. But after that, everything changes. Is it a single straight line or is it a curve? Does the price stay above the line or to the left of it? And of course, the killer difference. The straight line can go on forever. The parabolic curve gives you a non-negotiable time limit. All right, ready to level up? Let's add one final layer here, a slightly more advanced concept. But understanding this is what really separates the pros from the amateurs. We need to talk about something called the ex-dividend twist. You know how this usually works, right? A stock goes ex-dividend. Its price is automatically adjusted down by the amount of that dividend. So for a normal straight line uptrend, you do the same thing to your trend line. You just offset it downwards by that exact same value. It's a clean, logical, price-based adjustment. Makes sense. But, and this is a huge but, you absolutely cannot do this with a parabolic trend. It's a massive mistake. Look what happens when you try to just nudge the curve down. You're not just adjusting for price, you are fundamentally changing the shape of the curve. You're artificially pushing its time limit, that vertical endpoint, further out into the future. That's a completely invalid move. So why? What's the big deal? It's because a parabolic trend isn't just a pattern of price. It's a pattern of time and accelerating crowd excitement. That ex-dividend date is a known mechanical event. The crowd has already accounted for it. When you start messing with the geometry of the curve, you're breaking the analysis because you're ignoring the very psychology that created the pattern in the first place. So, we've broken down the mechanics, the warnings, the common mistakes. But now I want you to reframe this whole idea. Understanding the parabolic trend isn't just about avoiding a disaster. It's about giving yourself a trading superpower, an edge that most other people in the market completely miss. And here's how you use that superpower. It's 3 simple steps. 1, identify the curve. Is the trend clearly accelerating? Are prices staying nice and tight to the left side? 2, find the time limit. Project that curve forward and pinpoint the exact day it goes vertical. Put a big red circle on your calendar. And 3, plan your exit. That time limit becomes your objective, data-driven, non-negotiable signal to get out and protect your profits before the inevitable collapse. So in the end, we've seen that this incredibly powerful pattern isn't driven by earnings reports or big news stories. It's driven by pure, raw human psychology, by crowd excitement. Which kind of leaves us with one final, pretty powerful question. What other huge market behaviors, driven by the same predictable human emotions, are just hiding there in plain sight, waiting for you to find them? Welcome to The Explainer. Today we're going to tackle one of the absolute toughest questions in trading, and we're going to do it by putting you right in the driver's seat. You know the moment. You're in a winning trade, things are looking good, but the market's starting to feel a little shaky. What's the move? All right, so let's jump right into a scenario. Imagine this is your trade right here. You're up a nice, solid amount, but you're starting to see some mixed signals. That little voice in your head is screaming, cash out now, but there's also that nagging fear. What if I leave a ton of money on the table? So the whole point of this trading test is to dig into something really fascinating. Why is it that different traders looking at the exact same information can come to completely different conclusions? Yeah, we're basically doing a deep dive into the psychology of hitting that sell button. And look, let's just be super clear right from the get-go. There is no single right answer here. What we're going to see is how some traders decide to exit early, lock in those profits. Others will try to ride the trend for even bigger gains. And some might just wait a little too long. All right, let's get into it. Here's the information you've got to work with. I want you to forget everything else you think you know. For the next few minutes, this is your entire world. Okay, first up, here's the price chart. You can see we've had a really nice uptrend going on, but take a close look at what's been happening lately. See how the price has dipped just below that rising trend line? Now, also notice that horizontal line there, the CBL stop loss. That's your safety net, your absolute exit point. And we haven't hit that yet. And now, here are your technical indicators. Up top, you've got the RSI that measures momentum, tells you if something's overbought or oversold. Below that is the MACD histogram, which is great for spotting changes in that momentum. And down at the bottom, the Guppy Multiple Moving Averages, which kind of show the relationship between short-term traders and the long-term investors. Now, these tools are supposed to give us clarity, right? But as you're about to see, they can be interpreted in a whole bunch of different ways. So this is it. Take a second. Look at the price chart, look at these indicators. What's your decision? Are you taking the profit and running for the hills? Or are you holding on, hoping this is just a little blip on the radar? Seriously, go ahead and pause right here and make your call. Okay, you got your decision locked in? Good. So what do you think most people did when they were faced with this exact same setup? Well, the answer, it might actually surprise you. So in the original test that this is all based on, only 6% of the people taking it decided to sell the trade. Right here, at this exact moment. I mean, think about that. Just 6 out of every 100 traders bailed. And this pretty much shows you what happened for them. For that tiny 6%, it was a fast, profitable exit. And hey, a 15.63% return, that's nothing to sneeze at, for sure. They played it safe, they took the win, and they moved on. But was it the best possible decision? So why did they sell? What was the big trigger? Well, it was that classic technical signal we saw back on the first chart. The price closed below the trend line. For them, that one signal was enough. Game over. But this, my friends, is where psychology starts to totally overpower pure, cold, hard analysis. And this leads us right into a really important idea: confirmation bias. You see, as soon as those traders saw that one bearish signal, that break of the trend line, their brains just started looking for other reasons to back up the decision they'd already made in their gut. So this is the really critical thing to get. You have to understand the difference between these two things. Are you looking for confirmation, which is basically just finding proof for what you already believe? Or are you doing objective verification? That's where you look at every piece of data on its own for what it is, whether you like what it's telling you or not. Okay, so now let's flip the coin. What about the other 94%, the ones who stayed in? What were they seeing that the sellers missed? Let's dig into the reasons for staying the course. Now this is where it gets really interesting, because this chart lays it all out, side by side, the reasons to sell versus the reasons to stay, based on all those indicators we saw. Over on the right, yeah, you've got the arguments to get out, the stuff that's 6% focused on. But over on the left, well, that tells a whole different story. So the traders who stayed, they were focused on the bigger picture, right? The underlying strength of the trend. They saw that the main safety net, that countback line stop loss, wasn't even close to being hit. They also saw that the long-term moving averages were still pointing straight up, which is a great sign the major trend is still healthy. Even that little dip in the short-term averages, to them, it just looked like the market was catching its breath before the next leg up. For this group, the evidence to stay was overwhelming. So, based on this much more balanced, objective look at things, the conclusion from the person who actually ran this study was to hold the position. And the key takeaway here is just accepting that there's no absolute 100% right or wrong answer. But the weight of the evidence, when you looked at all of it, really did point towards staying in the trade. But of course, the market doesn't care about our analysis, right? It just keeps moving. So what happened to that 94% who held on? Well, let's fast forward a few weeks to the next big decision point, because this trade is not done yet. This is a great little side-by-side. On the left, that's our first decision point, remember? We were up about 15%. And on the right, that's the chart a few weeks later. You can see right away the price has moved up a lot. The profits are way bigger now, which means the stakes are too. And here's your new set of data. The indicators have changed. You can see the moving averages are fanning out. That's a classic sign of a strong trend. But, and it's a big but, look at that RSI. It's pushing up into what we'd call overbought territory. Now that kind of momentum is awesome while it lasts, but it can also be a huge warning sign that a reversal is coming. So yeah, the signals are getting trickier and the decision is definitely getting harder. So here we are, back at another crossroad. With all this new, more complicated information, you've got to make the call again. What do? Do you finally cash out and take these much, much bigger profits? Or do you trust that trend and let it ride? And all of this brings us to the real heart of the matter, the main takeaway from this whole exercise. We've put you in the hot seat, we've looked at the data, we've talked about the psychology, so what is the real secret to making the right call? Well, the secret isn't some magic indicator. It's not a hidden setting on a chart. The real secret is building a process, a system that forces you to be objective. Think of it like a framework, or even just a simple checklist that makes you weigh all the good signals against all the bad ones before you let your emotions take over. It's all about how you manage your own biases, like that confirmation bias we talked about, and how you learn to see the data for what it actually is, not just what you want it to be. And that really leaves us with one final crucial question you should ask yourself about your own strategy. When you look at a chart, are your tools actually guiding your decisions toward a logical conclusion, or are they just confirming the emotions, the fear, the greed that you're already feeling? The answer to that one question, well, that could make all the difference in the world. Welcome to The Explainer. Today, we're going to talk about something fascinating, the hidden language of market trends. We're going to decode the personality of a trend, moving way beyond just simple up or down signals to really understand its true character. The goal here is to give you a powerful new edge to see what the charts are really trying to tell you. Okay, so let's start with a core idea. Not all trends are created equal. You got to think of them like people. They have distinct characters. Some are reliable, steady. Others are volatile and, frankly, pretty dangerous. The key to successful trading is knowing how to tell them apart. You know, on one hand, you've got this steady plotter. This is the kind of trend that just builds your profits slowly, reliably, day after day. But then you have the parabolic trend. It shoots up like a rocket, gets everyone super excited, but so often it just ends in a total disaster when it collapses. And this is the whole ball game, right? Identifying the true character of a trend, figuring out if it's dependable or if it's hiding some nasty weakness, that's what separates a smart trade from a financial disaster. It's all about understanding the psychology that's driving the price.
So, what's the problem? Why do so many people get this wrong? Well, the standard tools that a lot of traders rely on can be so misleading, especially at the most critical moments. It basically turns a huge decision into, well, a coin toss.
Let's look at a real-world dilemma. Check this out. Here are two charts, both at a critical decision point based on a classic moving average signal. Now, one of these is about to skyrocket 63%. The other is about to collapse by 17%. Can you honestly tell which is which? Looking at these, it's pretty much impossible, right? If you're just using a standard 10 and 30-day moving average, both chart A and chart B are screaming the exact same signal. The lines are coming together, which suggests a change is coming, but they give you absolutely zero clue about what's likely to happen next. And here's what happened. Chart A, which was Chiquita Brands, went on that 63% rally. Chart B, Caprol Aluminum, totally collapsed, losing 17%. Choosing correctly here was pure luck. It wasn't about judgment, because the indicator just didn't give us enough information. So if the standard tools are failing us, what's the alternative? What if there was a better way to see inside the trend and really understand the forces that are pushing it? Well, there is. And this is where we can get a much, much clearer view.
Let me introduce you to the Guppy Multiple Moving Average, or GMMA for short. Now, this isn't just another indicator. It's designed specifically to define the character of the trend. It does this by showing us the relationship between the two dominant groups in any market, the short-term traders and the long-term investors.
The way it works is actually pretty brilliant. It uses two distinct groups of moving averages. The first group is a tight little bundle of short-term averages that tracks the thinking of traders, the people who are in and out looking for quick changes. The second is a wider group of long-term averages, and that shows us the conviction of investors, the people moving the big, patient money. So how does this actually work in practice? Well, the magic is in the interaction between these two groups. That's what gives us this incredible insight into the market's collective mind. This is where we start to see the trend's real character pop out. Okay, so the first key pattern you want to look for is something called compression. This is when a group of moving averages squeezes together really, really tightly. It's a signal that the people in that group have reached an agreement on the stock's value. They think the price is right, and that agreement often comes right before a major move. And the flip side of that coin is expansion. This is when those averages spread apart, and the space between them gets wider and wider. This signals conviction and momentum. A big separation shows that the trend is powerful, and it's really well supported by that group, whether it's traders or investors.
So let's go back to those charts from earlier and see how applying this way of thinking completely transforms that coin toss decision into an informed, high-probability trade. This is how we move from just guessing to having genuine insight.
All right, let's look at our first case study, Commonwealth Bank. Now, it's been in a long downtrend, and a breakout signal appears. But is it for real, or is it a trap? The GMMA is going to help us see with confidence that this is actually the start of a major new uptrend. First, take a look at Area A. You see that clear compression in the short-term group of averages? That's our traders. This tells us they believe the price has fallen too far. They're starting to see it as cheap, and they're beginning to buy, probing for a change in the trend. Now, look at Area B. This is the crucial signal we've been waiting for. The long-term investor group also compresses and starts to turn up. This is a massive shift in market sentiment. It shows that the long-term capital, the big money, now agrees with the traders and is starting to buy into this new trend. And then in Area C, we see a small price dip. The short-term traders are taking a little profit. But look at that long-term group. It barely even flinches. The investors use this little dip as a buying opportunity, which confirms the huge strength and support behind this new uptrend. Okay, now for a totally different story. This is Commonwealth Serum Labs, and it's a perfect example of how the GMMA can act as a powerful warning system, helping you avoid what looks like a classic but very false breakout. At these two spots, A and B, the price clearly breaks above the downtrends line. A simple indicator might flash a big buy signal, but the GMMA, it tells a completely different and way more accurate story. Just look at that long-term investor group. It stays wide, it stays well separated, and it's pointing decisively down. There is zero conviction from the long-term capital. In fact, what's happening is investors are using this little pop in price as a chance to sell at a better price. That's a massive red flag telling you to stay away. So that's really the crucial point here. The GMMA lets us see the full story. It reveals the character of the trend by showing us the relationship between the traders and the investors. And that transforms a trade from a simple guess into a truly informed judgment call. So let's just recap what we've learned. Not all trends are the same. They have character. Simple indicators can really fail you at those critical moments. The GMMA gives us a window into the market's mind by separating traders from investors. Compression tells us there's agreement, and expansion tells us there's conviction. Understanding that dynamic gives you a real, tangible trading edge. You know, ultimately, the GMA is a way to validate signals by showing you the market's true opinion. It helps you see when the crowd is genuinely behind a move, and when it's not. So the question I want to leave you with is this. What other crucial stories are your charts not telling you? And what could you see if you just started looking for them?
You ever stare at a stock chart, the one that's just zipping up and down like crazy, and just think, what is actually going on here? Like, who's really behind the scenes pulling the levers? Well, today, we're going to pull back that curtain. We're going to look at the two, let's call them personalities, that are the real engine behind every single move the market makes. You ready? Let's get into it.
I mean, we hear it constantly, right? Bulls versus bears. It's this epic battle. The optimists who think prices are going up against the pessimists who think they're going to tank. But honestly, it's kind of just scratching the surface. It's a huge oversimplification. See, that describes an attitude, a feeling. It doesn't tell you a thing about what people are actually doing.
And here's why that matters. A person's attitude can flip on a dime. You can be super bullish in the morning and turn completely bearish by the afternoon. That changes. But what doesn't change is their fundamental game plan, their approach. The real story, the one we're going to unpack, is all about the behavior of the two main groups that make up the entire market.
And here they are, our two main characters. On one side, you've got the investor. This is your long game player, right? The steady hand, totally focused on the real underlying value of a company. And on the other side, the trader. They're all about the short game. They're hunting for those little gaps between price and value to make a quick buck. These two, with their completely different goals, they are the ones who give the market its split personality.
All right, so let's dig into our first personality, the investor. You can really think of them as the architects of the market. We're often talking about huge funds, managing billions and billions of dollars. They're the ones building those deep, powerful currents that end up defining the long-term trends. And their entire playbook, their whole strategy, really boils down to one key concept: portfolio weighting.
So what in the world is portfolio weighting? Well, you can think of it as the rule book for the big money players. It's not about gut feelings. A fund manager might have a mandate, a strict rule that says we must have exactly 5% of our entire fund in gold stocks. It's not a suggestion, it's not a whim, it's set in stone to manage risk. And that rule dictates what they do, no matter if they're personally feeling bullish or bearish on gold that day. They have to follow the plan.
In this chart, it shows you exactly how this plays out in the real world. Let's take a look at Lihir Gold here. Okay, imagine two big funds. We'll call them Fund A and Fund B. Now, Fund A, they're a little behind. The price of gold is rising, and they're underweight. They have to buy to meet their 5% target, so they're urgent. They might have to jump in and pay a higher price, say $1.47. But Fund B, they're already sitting pretty. They have their gold exposure. They're not desperate at all. They can be patient, sit back, and say, you know what? We'll only buy more if we can get a bargain, maybe down at $1.40.
So what's the big takeaway here? What does all this mean? It means that these investors together act like a giant shock absorber for the market. You've got one fund buying high at 147, another buying low at 140. They're soaking up all the selling pressure across this huge price range. And that collective action, that's what gives the market its stability. It confirms the strength of a trend. They are, quite literally, the foundation.
Okay, So that's the investor. Now let's flip the coin and talk about our second personality, the trader. And if the investors are that deep, powerful ocean current, well, the traders are the choppy, fast-moving waves right on the surface. They're playing a totally different game with a completely different mindset.
For a trader, it's all about one thing: price versus value. That's the whole game. They look at a stock and ask two simple questions. One, what's the price on the screen right now? And two, what do I think this thing is actually worth? That gap, that little space between price and value, that is their entire universe. That's where the profit is.
And here is a fantastic example in action. Okay, let's say a whole bunch of traders, all working independently, run their numbers on Telstra, and they all come to the same conclusion. This stock is worth $6.71. But then they look at the market price, and it's trading at just $6. That's a massive discount. It's a blinking red light that says opportunity. But here's the catch. They all see it at the exact same time. And if you look at the sellers, there just aren't enough shares to satisfy all that demand. Suddenly, you've got a battlefield.
And this is where things get wild. It's a bidding war. So trader A puts in their order at $6, but sees there are a ton of other buyers ahead of them. The fear of missing out, FOMO, kicks in. They panic. So what do? They jump the line. They bid higher, say $6.11, to make sure they get their shares. Well, that sets off a chain reaction. Trader B sees the price jump and bids $6.31. Someone else sees that and chases it up to $6.51. It's an absolute frenzy. Yeah, it started with analysis, but it's being fueled by pure emotion now, a desperate scramble not to be left behind. And it keeps going, pushing the price up, 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 until it finally hits that perceived value of $6.71.
Okay, so we've met our two players, right? The slow and steady investor and the fast and furious trader. So, what happens when these two worlds collide? Well, that intersection is where the magic happens. It's where we get those classic cycles of ups and downs, the volatility that really defines the market's day-to-day story.
Now, this next idea is absolutely crucial. It's the key to everything. When price and value merge, volatility falters. Think about that. The second the stock price hits that magic number, 671 in our Telstra example, the entire reason for that crazy buying frenzy just evaporates. Poof! The profit opportunity is gone. And just like that, the entire game flips on its head.
So let's walk through this cycle. First, you have the buying frenzy, right? Price is way below value, so traders are competing like crazy, driving that price up. Then you hit the peak. Price now equals value at 671. The reason to buy is gone. So what happens next? The early birds, the ones who got in low, they start to sell to lock in their profits. That little bit of selling pushes the price down, which then triggers the next wave of traders to sell, to protect their profits. And all of a sudden, you've got a selling cascade, pushing the price all the way back down. And that cycle, that frantic loop of buying, peaking, and selling, that, my friends, is volatility.
So if you need a simple way to picture all this, just think about the ocean. The traders, with their constant hunt for those price-value gaps, they're the ones creating all the choppy, volatile waves you see on the surface. But it's the investors, with their huge, slow-moving pools of money, who are creating the powerful underlying tide that's really determining where everything is ultimately headed.
Okay, so that's the theory. But why does any of this actually matter to you? The answer is this isn't just some interesting idea to think about. This is a super practical tool, a framework you can use to make sense of what you're seeing on any chart, any day of the week.
From now on, when you see a really sharp, fast move up or down, you can stop and ask yourself, okay, is this just trader activity? Is this a short-term wave? And when you see a slow, steady, resilient trend that just won't quit, you can ask, is this being supported by the deep pockets of investors? Is this the tide? It just gives you a completely new and powerful lens for reading the market's story.
And really, that brings us to the final, most important question. The question for you. When you look at the market, when you decide to get involved, which one are you? Are you the tide or are you the wave? Are you focused on that long-term value, helping build that deep current? Or are you riding those short-term waves of volatility? Now, there's no right or wrong answer here, but knowing which game you're playing, that's the first step to really understanding not just the market, but maybe a little bit more about yourself too.
Okay, let's talk about a situation that every single trader has been in. You find a stock that's just soaring, and that little voice in your head asks, have I completely missed the boat on this one? It really is the million-dollar question, isn't it? Is this trend a golden opportunity just waiting for you to jump in, or is it a trap that's about to spring? How can you possibly tell?
You know, a standard bar chart like this one can be incredibly deceptive. You see a huge run-up, and your gut just screams momentum trade. But, as we all know, those things can collapse just as fast as they appeared. So, what's the smarter way to play this?
Well, what we really need is a better tool. We need a way to see inside the trend, to really understand its personality. Think of it like getting an X-ray of the market. And that tool is the Guppy Multiple Moving Average, or GMMA for short.
So, what is this GMMA thing exactly? Well, it's a visual indicator, and it's made up of two different sets of moving averages. One set follows what the short-term traders are thinking, and the other set reveals what the long-term investors are feeling. And this separation, it's absolutely crucial.
The real secret sauce of the GMMA is right here, in this separation. You've got the short-term averages, that's the traders, the fast money, the folks looking for a quick profit. And then you have the long-term averages. These are the investors. They are the foundation, the ones providing the real underlying strength to the trend. And figuring out how these two groups are getting along, well, that's the key to everything.
All right, let's put this into practice with our first case study. We're going to look at a classic, super steep trend and see what the GMA can tell us.
So here it is, David Jones, or DJS. Now, based on this chart alone, a lot of us would probably just move on, right? It looks way overextended, it looks risky, like it could just fall apart at any second. But are we missing something important?
Now look at this. This is what's so cool. On the left, you've got confusion and risk. But on the right, as soon as we apply the GMA, we get instant clarity. All of a sudden, the hidden dynamics of the trend are just laid right out in the open for us to see.
So let's break this down a bit. Look how widely separated those long-term averages are. That's the investor group. That tells us there's strong buying support. And the traders' averages? They're moving in a nice parallel pattern, which means there's not a lot of speculative selling going on. The stable gap between the two groups just confirms it. This is a healthy, really well-supported trend. And here's the punchline. Despite looking so dangerous on a simple chart, the GMA analysis shows us that this is actually a well-supported, low-risk situation. It's telling us that the traders and the investors are totally in agreement, and that, my friends, is a very powerful signal.
Okay, so we've seen a fast mover. Now let's check out a different kind of trend, the long, steady climb. These can be just as tricky to read.
This is Boral, ticker BLD. And yeah, this bar chart is kind of messy. The price is pulled back, and it's really hard to tell if this is just a little dip, a buying opportunity, or if the whole trend is starting to break down. We definitely need more info to feel confident here.
And here we go again. The second we apply the GMMA, it just cleans up the entire picture beautifully. All that choppy, confusing price action gets smoothed out, and we can immediately see the true character of what's happening right under the surface.
So what's the GMA telling us here? Well, that investor group is well separated, moving in this broad parallel pattern. That's a sign of incredibly steady support. The trader group is showing these gentle wave-like patterns. The source material has a great description for this. It says it's like waves constantly lapping at the coastline during a rising tide. That's just a perfect way to describe low volatility. This whole picture illustrates an ideal, low-risk trend.
All right, we've seen a couple of good trends, but the GMA is just as good, if not better, at warning us to stay away from the bad ones. Let's look at our last case study and see how the GMA can be an early warning system. So, this is Australian Gas Light, AGL. And just a first glance at this chart, it feels uncomfortable, doesn't it? The rallies are sharp, yeah, but the pullbacks are just dramatic. And the question is always the same. Is this current dip a place to buy, or is it the beginning of the end for this whole trend?
And when we put the GMA on it, wow, the answer is just undeniable. The indicator exposes this fundamental weakness that was totally hidden by all that chaotic price action. This is not a healthy trend.
Let's just pinpoint these warning signs. The investor group is all compressed and narrow. That shows weak support from nervous investors. And the short-term trader group, it just keeps diving down, again and again, testing the trend's strength. All this volatility just confirms that the trend is unstable and super vulnerable to a collapse.
So the verdict is in. For a trend trader, this stock completely fails the test. The GMA isn't just telling us about the trend's character here, it's waving a giant red flag, warning us about the serious risk involved.
So what is the big takeaway from all this?
Let's bring all three of these stories together and look at the big picture.
This table just summarizes everything perfectly. Look at the clear difference in the DNA of each trend. With our low-risk trends, DJS and BLD, that investor group is wide and parallel, just screaming strong, steady support. But then you look at the high-risk AGL trend, and that investor group is narrow and weak. It's a completely different character, and the GMMA makes that distinction crystal clear.
And that really brings us to the core idea, which is captured perfectly in this quote from the source material. The GMA gives us a much deeper level of information about the very nature, the character, and the stability of the trend.
And this, right here, is the ultimate takeaway. Look, any indicator can tell you if a price is generally going up or down, but successful trading, it requires more. It's about looking past simple direction and truly understanding the character and the stability of that move.
So I'll leave you with this to think about. The next time you're looking at a chart, don't just ask yourself where it's going. Ask yourself, what is its true character? Thanks for tuning in.
All right, every trader knows this feeling, right? You're watching a stock, it's in a great uptrend, and then, boom, it suddenly dips. And the big question hits you. Is this a golden opportunity, a chance to buy in cheap? Or is it a trap that's about to snap shut on you? You know, if you get that call wrong, you could end up paying top price right before the whole thing collapses. So today, we're going to dive into a really cool tool that's designed to help you tell the difference. So let's get right into it. This is the question, isn't it? When you see that price start to fall, how do you know if you're about to snag a bargain or if you're walking straight into a bull trap? Honestly, getting this right is pretty much the whole game. It's the difference between a sweet profit and a really, really painful loss. And if you're just looking at a standard bar chart, like this one for Timber Corp, the answer is, well, it's not clear at all, is it? You can see the uptrend, sure, but you can also see that really sharp drop. Is the trend still strong? Is this just a temporary blip? The chart itself is kind of giving you mixed signals, and it just leaves you guessing. And the stakes here are incredibly high. The source material just nails it with this quote, calling it a cash in someone else's pocket nightmare. I mean, what a perfect way to put it. That's exactly what happens when you think you're buying a dip, but you're actually just catching a falling knife. So this is the core of the problem we're trying to solve. How in the world do you tell the difference between a little bit of temporary price weakness and the kind of terminal weakness that means the trend is over, the party's done? That's the mystery we're going to crack today. And the key to decoding this whole puzzle is an indicator called the Guppy Multiple Moving Average. We'll just call it the GMMA. It's specifically designed to cut through all that noise on a standard chart and give you a much deeper, much clearer picture of what the trend is really doing. So what is this thing? At its heart, the GMMA is an indicator that splits the market into two separate groups. It actually plots the behavior of short-term traders on one set of lines and the behavior of long-term investors on another. And it's in that separation, well, that's where all the magic happens. The best way to think about it is like the ocean. The traders, they're like the waves on the surface. They move fast, they're choppy, they react to every little piece of news. But the investors, they're the deep, powerful ocean current. They move a lot slower, but they have all the real force, and they're the ones who really decide which way everything is headed. The GMMA lets you see both of these forces at the same time. And here it is in action. You can see it so clearly here. That top bundle of lines, the one that's moving around a lot, those are the traders, the waves. And that bottom, slower moving group of lines, that's your investors, the deep current. The whole secret is understanding the relationship between these two groups. Okay, so theory's one thing, but the proof is in the pudding, right? Let's put this thing to the test. We're going to walk through 3 different real-world scenarios of price weakness and see how the GMMA gives us clarity where other tools just don't. All right, let's open up our first case file, a classic minor pullback. This is something you see all the time. A stock is in a really strong uptrend, and it just has a small, maybe a little bit scary dip in price. And wow, this side-by-side really says it all. On the left, you've got that confusing bar chart we saw earlier. But look at the GMMA chart on the right. Same stock, same time period. All of a sudden, it's like someone turned the lights on. The picture becomes crystal clear. Let's break down what we're actually seeing. Okay, the most important thing to look at here is the investor group, those bottom lines. See how they're spread apart, nice and parallel, all moving up together? That is the textbook sign of a super strong, healthy trend. There's no compression, which tells us the long-term investors are not worried at all. They're confident. That little price dip is just the traders messing around, and you can actually see the buy signal when their lines start to turn back up. So, the verdict from our GMMA analysis is simple. This was just a temporary pullback. That deep current, the underlying trend, is still powerful and completely healthy. This was a buying opportunity, not a reason to hit the panic button.
Now let's kick it up a notch. Our second case is a lot more dramatic. A significant price collapse. The kind of drop that would look really, really threatening on a normal chart. So on the bar chart on the left, this thing looks pretty ugly. You've got what looks like a double top, and the moving averages are crossing over. A classic sell signal, right? A lot of traders would see that and be out the door. But, once again, the GMMA on the right is telling a completely different story.
So here's the key. Yeah, the traders are clearly freaking out. Their lines are diving. But look at the investor group. They've moved sideways a bit, but critically, there's almost no compression. The investors aren't panicking. They're holding the line. The traders' averages dip into that investor group and then bounce right back out. That tells you the trend found strong support exactly where it needed to. So, the verdict on this one? It was definitely a major scare, no doubt about it. But it was driven entirely by the short-term traders. The foundation of the trend, the conviction of those long-term investors, it held firm. The deep current kept flowing. Okay, for our last case file, we've got the false alarm. This is a tricky one. This is where a classic technical signal is screaming sell, but it's actually just a trap designed to scare you out of a perfectly good position. Take a look here. That bar chart shows a clean, undeniable break of that uptrend line. For a ton of analysts, that's it. Game over. That's an automatic sell signal, no questions asked. But when we pull up the GMMA, we see that trend line for what it really is. Just a line on a chart. And what's amazing here is just how completely unfazed the investor group is. I mean, look at them. That price drop doesn't even put a dent in their direction or how far apart their lines are. They are holding steady. In fact, this pattern tells us they are probably using this weakness as a chance to buy even more. The GMA confirms it. That trendline break was a total fake out. So, the final verdict here? A false alarm. The underlying trend never even flinched. The GMMA gives us the confidence to just ignore that misleading signal and maybe even use this little dip as a fantastic new entry point. So when you put this all together, what you have is a new analytical edge. By using the GMMA, you can go way beyond just looking at price and get a real understanding of the trend's character, because you can see what the two most important groups in the market are actually doing. And you can apply this yourself with a really simple three-step test. First, just look at the long-term group, the investors. Are their lines stable, well-separated, and looking confident? Second, look at the short-term group, the traders. What are they up to? Are they getting panicked? And third, and this is the big one, analyze the relationship. Is the traders' panic actually making the investors nervous? If the answer is no, then that trend is probably rock solid. So the next time you see a price drop, the GMMA helps you answer the most important question of all. Are you listening to the short-term, choppy noise of the traders, or are you listening to the deep, powerful underlying conviction of the investors?
All right, let's get right into it. Every single trader knows this feeling. A stock has been tanking for weeks, maybe even months. Then, all of a sudden, it starts to bounce. And the big question hits you. Is this it? Is this the real bottom, the start of a brand new uptrend? Or is it just a trap, a sucker's rally before the next painful drop? You know, getting that call wrong is expensive. So today, we're going to break down exactly how you can tell the difference. Ah, yes, the old saying, don't catch a falling knife. But man, is it tempting. The idea of snagging a great stock at its absolute lowest price, getting in right before the rest of the market catches on, that's like the holy grail of trading, isn't it? But let's be honest, most of the time, that bargain ends up costing us. So, how can we do it smarter? How can we spot those bottoms with a whole lot more confidence? Okay, take a look at this chart. At point A, the price pops right above that downtrend line. It looks like the perfect breakout. But then, it fails. It collapses. Then, a little later, at point B, it happens again. Another move that looks so promising, but it just falls apart. You see, a standard chart like this gives you hope, but it doesn't give you a lot of clarity. We need a better way to see what's actually happening beneath the surface.
And that is where this tool comes in. It's called the Guppy Multiple Moving Average, or for short, the GMMA. The best way to think about it is like putting on a new pair of glasses, a lens that lets you see the real character of a trend in a way that a simple price chart just can't.
Now, don't let that fancy name scare you off. It sounds complicated, but the idea is actually super simple. The GMA is just two groups of moving averages. One group, the fast one, shows you what short-term traders are thinking, and the other group, the slow one, shows you what long-term investors are doing. It's basically a picture of the market's psychology.
And I love this metaphor the source materials uses. Think of the short-term traders as an axe. They're fast, they're noisy, they're chopping away, creating these quick price swings. But the long-term investors, they are the tree. They represent that deep, powerful underlying trend. And for the trend to really change, that axe has to be strong enough to actually chop down the tree.
So using this GMMA lens, we can run a really simple 3-point check on any potential breakout. First, we look for compression. Are the investors on board? Second, we look at penetration. How strong is that trader rally really? And finally, we look at the pullback. What happens when the momentum fades? Okay, let's put this framework to work.
So let's rewind and go back to that BRL Hardy chart. Let's see how this 3-point diagnosis could have saved us from jumping into those two rallies that looked so good but were actually total fakeouts.
And here you can see it side by side. On the left, that's the chart that tricked us before. It's ambiguous. But on the right, bam, you overlay the GMMA and it's like somebody flipped on the lights. All that weakness that was hidden before is suddenly crystal clear.
Okay, signal number 1 is all about compression. And what do we see here? The exact opposite. Look at the long-term averages, our tree. See how wide apart those lines are at both points A and B? That wide spread is a huge red flag. It's telling us the downtrend is still really strong. The investors aren't buying this little bounce. They're actually using it as a chance to sell. Now for signal number 2, penetration. Look at what the axe, the short-term traders, is doing. They're trying to rally, sure, but they can barely even make a dent in that wall of sellers. It's a really weak swing that just bounces right off the tree. This tells you there's no real power, no conviction behind this move up.
And here's the final nail in the coffin. Signal 3, the pullback. After that second rally at point B fails, look what happens. The price doesn't just drift lower, it absolutely collapses to a new low. That's pure panic selling, and it confirms, without a doubt, that the sellers are still in complete control. Any hope for trend change is officially dead.
So the diagnosis is clear as day. We had no investor compression, really weak penetration, and a lower pullback. All three signals were screaming failure. The GMMA showed us this was a classic sucker's rally and gave us a very clear warning to just stay away.
Okay, so that's what a trap looks like. But what about the real thing? What does a genuine breakout look like through this lens? Well, for that, let's turn to our next case study, Iluka Resources, and we'll apply the exact same 3-point check.
Now, if you just glance at this Iluka chart, you might think it looks a lot like the last one, a slow recovery after a big drop. But once we apply our GMMA lens, a completely different story unfolds. We can see a fundamental change in the character of the trend is starting to happen.
And here it is, the first critical signal. Check out the long-term investor group. See how the lines are squeezing together? They're compressing. This is the complete opposite of what we saw before. This compression tells us that the investors are changing their minds. The big money is shifting from selling to buying. This is a very bullish sign.
Next up, signal 2, penetration. Now the traders' rallies, the axe, are actually swinging with force. They're pushing up into and even through that investor group. The axe is getting sharper with every swing. Each rally is pushing a little bit higher, showing us that the buying momentum is really starting to build.
And here is the final confirmation, signal number 3, the pullback. Look closely after each little rally. The second pullback, right there at point 2, is higher than the first one. This is absolutely crucial. It means buyers are getting eager. They're not letting the price fall very far before they jump back in. That's a clear sign that confidence is growing. So with Iluka, all three of our signals are pointing in the right direction. We have investor compression, we have deeper penetration, and we have higher pullbacks. The diagnosis? This is a high probability breakout. The GMMA gives us the confidence to see that the whole character of this trend is changing for the better.
Okay, let's wrap this up by turning everything we just learned into a simple, actionable checklist that you can use anytime you're trying to figure out if a trend change is the real deal. Here it is, your 3-point checklist. It's this simple. First, look for compression. Are the long-term investor bands getting tight? Second, look at penetration. Are the short-term rallies getting stronger and pushing higher? And third, check the pullback. Are the dips shallow? Are buyers creating higher lows?
If you get a yes on all three, you might be looking at a real breakout.
Because, when it all comes down to it, it boils down to this one core idea. Traders can make a lot of noise. They can get the party started. But it's the investors, the big money, who are the true driving force behind any sustainable trend. The GMMA just helps us see who's really in charge.
By looking past just the price and seeing the relationship between these two groups, you get a massive edge. You can avoid those suckers' rallies and position yourself for the real moves. So the next time you see a stock starting to bounce, you'll know what to ask. Which force is really in control here, the traders or the investors?
Let's talk about breakout trading. It's one of those moments in the market that's both super exciting and, well, completely nerve-wracking. A stock that's been doing nothing suddenly breaks its pattern, and you've got to decide, and decide fast. If you get it right, the profits can be absolutely massive. But if you get it wrong, well, that's exactly what we're here to talk about avoiding.
Okay, let's just dive right in. Take a look at this chart. Imagine you've been watching this stock for months, just stuck in a rut, going nowhere. Then, boom, it breaks out with this huge surge. But just as you're getting excited, it pulls back, right to this spot. This is the decision point. So what's the play? Are you buying in, thinking this is just a little dip before it really takes off? Or are you staying on the sidelines, worried that the whole breakout was a fake out and it's about to collapse? That right there, that's the core problem we're going to solve together in this explainer. Yeah, this is what we call the breakout dilemma. And we're not just going to guess, we're going to tackle it with a really specific tool that's designed to cut right through all the noise and show us what's really going on beneath the surface. So first things first, a quick definition. Breakout trading is pretty simple, right? It's just trying to catch a stock at the exact moment it makes a big move away from its old pattern. The real challenge, though, is that so many of these breakouts are false alarms. They look incredible for a minute and then they just fizzle out, trapping anyone who jumped on board. So the key, the absolute key, is figuring out if a breakout is the real deal. And to do that, we're going to use this powerful indicator called the Guppy Multiple Moving Average, or GMMA for short. This tool is built to answer one single crucial question. Is this just a temporary blip, or is this the actual beginning of a strong new trend? So how in the world does the GMMA do that? Well, its genius, really, is that it splits the entire market into two different groups, and each group has its own personality, its own psychology. Understanding these two groups, that's the secret. And you can see those two groups right here on the chart. First, you've got the short-term group. These are your traders. Think of them like scouts. They're nimble, they're out front, they're always testing the waters. Then you've got the long-term group. These are your investors. They're like the main army. They move a lot slower, but their support is what actually wins the war. And here's the crucial difference. The traders, they're all about the short term. They're speculative. They lead the charge. The investors, on the other hand, are thinking long term. They're way more conservative. They don't lead the charge. They confirm it. See, a breakout that's only led by traders is weak, but a breakout that's confirmed by investors, now that's strong. Okay, so we know who the players are. But how do we actually read what they're doing? Well, our source material gives us a handy 4-part checklist to read these signals and figure out how strong any breakout really is. Let's walk through it. All right, here are the 4 clues. First, we look for compression in that long-term investor group. That means they're all starting to agree on a fair price. Second, we check the direction of that compression. Is it starting to point up or down? Third, we actually expect a collapse from the short-term trader group as that initial excitement wears off. And finally, number 4, we look for a fast bounce, which proves the buyers are serious. Okay, enough theory. It's great, but let's apply this to a real chart. We're going to go back to that first pattern we looked at, that slow burn breakout that came after a long sideways slog. And here we are, right back at our original problem. The stock breaks out, looks great, and then pulls back to that make or break point. Looking at this plain chart, it's honestly a coin toss. It could go either way. There's just not enough information here to make a call with any real confidence. But now, watch this. Let's overlay the GMMA. All of a sudden, the picture becomes crystal clear. Just look at the long-term investor group. That's the bottom set of lines. Even while the price is dipping, this group is spread wide apart and pointing firmly up. That's the hidden strength of the trend, right there.
To really hammer this home, let's compare the failed little rally in Area A with our current pullback in Area B. See, back in Area A, the investor group was totally flat and squeezed together. They had zero interest. But now, in Area B, they're fanned out and heading north. They are completely on board, and that provides a kind of safety net for this pullback. So let's run through our checklist. Are the investors on board? Oh yeah, their lines are wide and pointing straight up. Is the trader pullback a total panic? Nope, it's pretty orderly. And what about the bounce that follows? It's fast and strong. The verdict? The GMMA is practically screaming that this is a high probability buying opportunity. This is not a trap. This is the real deal. All right, that was a breakout from a slow grind, but what about something more dramatic? Let's take a look at the classic and often terrifying V-shaped recovery. So here's the MA app stock. It was in a nasty downtrend, and then wham, it just reverses on a dime and shoots straight up. These moves are so fast, they can be really scary to trade. You're always worried that the second you jump in, it's going to fall right back down, and there's usually no nice gentle pullback to give you a safe entry. But once again, the GMMA gives us the clarity we desperately need. Look at what happens to the investor group right at that turning point. They go from being spread apart and pointing down to getting super compressed and turning up, and it happens in a flash. This is a massive, powerful signal that the whole character of the stock has changed. So analyzing this one is a bit different. The investor group didn't just stay strong. It did a complete 180, signaling some really aggressive buying. And look, the traders are also moving up in a strong, orderly way. When you see both groups moving in perfect sync like this, the source material is clear. Don't wait for a pullback. This is a powerful trend you want to get on board with right now. So we've looked at two totally different kinds of breakouts. What's the one big takeaway here? What's the single most important lesson that connects everything we've just seen? It really all comes down to this one simple idea. Traders lead the way, but we only follow when investors are showing increased willingness to become buyers. The fast money, the traders, they might start the party, but it's the slow, smart money, the investors, that tells you if that party is going to last all night. And that kind of leaves us with one final thought. You know, tools like the GMMA are fantastic. They give us this amazing picture of what the market is doing. But what they're really showing us is a picture of group psychology. They show us the exact moment when the collective belief shifts from fear to greed, or from confusion to conviction. Which really makes you wonder, how much of a trend is just technical numbers on a chart, and how much of it is just a story about human belief finally taking hold? You know, we all have the same dream, right? Buy low, sell high. Simple. But here's the thing. Buying is only half the story. The real moment of truth, where the money is actually made or lost, is knowing when to get out. So let's get into it. How do we spot a failing trend before it completely torpedoes our profits? Just think about it for a second. What's the one decision that you agonize over the most? It's not finding a new stock to buy, is it? No way. It's figuring out when to sell. Are you getting out too soon, leaving a ton of cash on the table, or are you holding on way too long, just watching those beautiful green numbers turn red? And look, the raw math is kind of scary. On any trade you make, there's one way to win, profit, and two ways to not win, breaking even, or worse, losing money. The odds are literally, from the get-go, stacked against you. Which is exactly why a smart exit strategy isn't just a nice to have, it's everything. It's how you survive. Okay, so here's our game plan. We're going to start by talking about the exit dilemma itself. Then we'll get into our main tool for the day and how it helps us read the two different groups of people in the market, traders and investors. From there, we'll look at 3 huge warning signs of a failing trend and then wrap it all up with what you need to do to be prepared. See, the thing is, we buy for one reason, and one reason only. We think the price is going up. But we sell for a bunch of reasons, right? We could be taking a profit, we could be cutting a loss, maybe we think it's a false breakout. And because it's so complicated, there's no single perfect indicator. We need something a little more diagnostic. And that's really the heart of it. We're not looking for a crystal ball here. We can't predict the future. What we can do is find a tool that acts like a doctor, giving us a clear diagnosis of the trend's health right now. That way, we can make a much smarter decision about what our next move should be. And that tool, our diagnostic tool, is the Guppy Multiple Moving Average, or GMMA for short. I want you to think of it like an MRI for the market. It lets us see what's happening beneath the surface, to really understand the relationship between the two groups that are driving every single trend. So what is this thing? Well, simply put, the GMMA uses two separate groups of moving averages. You've got a short-term group and a long-term group. And by watching how these two groups dance with each other, we can understand the real character of a trend in a way that just looking at a price chart could never tell us. And this is where it gets really intuitive. Just think of them as two different types of people. The short-term group, that's the traders. They're the fast movers, the speculators, the ones who jump on things first. Then you have the long-term group, the investors. They're the foundation, the true believers. They provide the deep-seated conviction that keeps a trend going. For a trend to be healthy, you need both of these groups to be on the same page. All right, first warning sign. So what happens when the price of a stock takes a little dip? Well, in a strong, healthy trend, our traders, the leaders, they should jump right back in, right? They see it as a buying opportunity. But what if they don't? What if they hesitate? Well, that's what we call a bounce failure, and it is a massive red flag. Okay, take a look at this chart. Those wide, slow-moving lines at the bottom, that's our long-term investors. They still seem pretty happy. The trend looks solid to them. But now look at the short-term trader group, the thin lines. After the price drops, they dip down into the investor group, and then they just fall apart. See how they get squeezed together inside that circle? There's no bounce back. The leaders have totally lost their confidence. And that's really the whole story. The moment that short-term group fails to bounce back with enthusiasm, that's your early warning. The investors might be blissfully unaware, but the folks who lead the market are already heading for the doors. That tells you the trend is in some serious, serious trouble. You know, not all trends end in a dramatic crash. Some just fizzle out. It's like a slow leak in a tire. This is the slow collapse, where a trend just gradually rolls over, and it's so dangerous because it tries to trick you into thinking it's just a pause, but the GMA can spot this a mile away. This chart here is a perfect textbook example. Just watch what happens over a few months. Over in Area 1, you see a dip and a pretty good bounce. But then, in Area 2, the dip goes a little deeper, and the bounce, it's not as strong. By the time we get to Area 3, the traders are pushing way down into the investor group. And that last little attempt at a rally in Area 4, it's a total failure. Each bounce is just weaker than the one before it. So let's break that down step by step. First, the trend loses its upward momentum and just starts going sideways. Then, you see the rallies getting weaker and weaker. Next, the dips from the traders start pushing deeper and deeper into investor territory. And the final nail in the coffin is that last pathetic little bounce that just completely fails. That's the confirmation this trend is out of gas. And this is a really critical point. It's not just about the traders getting weak. The fact that they can push so far down into the long-term group tells you something else. The investors aren't buying the dip anymore. They're losing interest. And if the investors aren't supporting the price, the entire foundation of the trend is about to crumble. All right, now for the scenario that gives every trader nightmares, the waterfall. The sudden, sharp, stomach-in-your-throat collapse. It's fast, it's scary, and it feels like total chaos. But even in a crisis like this, the GMMA gives us amazing clarity. Check out this chart. A key trend line breaks, and then it's just a cliff dive. I want you to notice two things here. First, see how the short-term trader lines are spread really far apart as they fall? That's not an organized retreat. That is pure panic. They are selling at any price they can get. And second, look as they slice right through the investor group. There is not even a hint of a bounce. It is a straight shot down. So even if you're the most optimistic person in the world hoping for a quick rebound, this pattern is screaming at you. The behavior of both groups, the desperate traders and the collapsing investors, is a code red. The GMMA is telling you in no uncertain terms, this trend isn't just weak, it's completely broken. Okay, so we've gone through the symptoms of a dying trend. We know what to look for. Now, what's the prescription? How do we actually use this information? Well, it all starts with understanding what the GMMA is, and, just as importantly, what it is not. Let me be crystal clear here. The GMA is not a magic 8-ball. It doesn't predict the future. Its job is to help you understand the character of the trend right now by showing you the relationship between the speculators and the long-term believers. It won't give you a perfect exit signal, but it will tell you when the environment is changing, when to tighten up your stops, and when you absolutely need to be prepared for things to get ugly. At the end of the day, any tool is only as good as the person who's using it. The GMMA will lay out the evidence for you in plain sight. It will show you the bounce failure, the slow collapse, the waterfall drop. It gives you the warning signs. The real question, the only question that matters is, do you have the discipline to listen to what it's telling you?
You know that feeling, right? When a market trend just goes vertical. It is an absolutely thrilling ride. But as you know, that thrill can turn into pure terror in a heartbeat. You're in a bubble, it's this huge opportunity, but it's also a potential disaster just waiting to happen. Every single trader faces this moment. So the question is, how do you actually navigate it?
There's this old Chinese trading proverb that just says it all. Disaster comes from greed. And that really gets to the heart of it, doesn't it? The real challenge isn't just reading the chart. It's fighting that urge to hold on for just one more tick, that one temptation that can wipe out weeks of profits in an instant.
So this is the million-dollar question. When you see a chart that is just shooting for the moon, are you looking at a life-changing trade or a catastrophic trap? Well, the answer is always in the details, and we are about to show you exactly what to look for.
Okay, so here's our game plan for this explainer. We're going to give you the tools you need. We'll kick things off by figuring out how to spot a true bubble. Then, we'll dive deep into the 3 different types of bubbles you'll encounter. After that, we'll show you how to decode the charts using a really powerful tool. And finally, we'll wrap it all up with a simple framework to help you make much smarter decisions.
First things first, not every chart that looks like a rocket ship is actually a bubble. To trade them safely, you absolutely have to understand the real anatomy of a market frenzy. Here's the key definition you need to burn into your brain. A bubble isn't the trend itself. It's that final, speculative burst that builds on top of a trend that's already there. You know, think of it like a pot of water boiling over. The bubbles lift off the surface, and then they collapse right back down to it.
Just look at the visual difference right here. On the left, with TIFF, you could see this established trend down in Area A, and then the bubble just blasts off from there in Area B. But look at the chart on the right, MCR. That massive rally is the trend. There's no stable base underneath it. Getting this distinction right is absolutely critical.
Okay, let's just lock this in so it's crystal clear. A true bubble is built on a trend that's already there, and when it pops, it collapses back to it. A momentum rally, on the other hand, creates the trend, and its pullback just sets up a new, higher base to start from. Understanding this difference is really your first line of defense.
All right, so now that we can spot a bubble, we need to understand what kind of beast we're dealing with. See, not all bubbles are created equal. They fall into 3 very distinct categories, and each one has its own personality and its own risks.
So, we're going to break down the speculative bubble, which is a pure momentum play. Then we have the in-trend bubble, which is really just a bit of froth on top of a healthy trend. And finally, the most dangerous of them all, the end-of-trend bubble, which signals a total collapse is coming. You've got to approach each one differently. Now, to tell them apart, we need a specific tool for the job, the Guppy Multiple Moving Average, or GMMA. Simply put, it's just a collection of moving averages that helps us see the relationship between short-term traders and long-term investors. And believe me, that relationship is the key to decoding these patterns.
All right, let's start with type 1, the speculative bubble. This is the one that traders are always hunting for. It's a pure momentum-driven trade, and it's a very distinct strategy.
Take a look at this chart. Trendline A, down here, shows the potential longer-term trend. But the real action, the part that gets the heart pumping, is all on that super steep trendline B. It's a fast, aggressive move. Traders love this stuff because of its speed and leverage. It's exciting, for sure. But you absolutely need a crystal clear exit plan.
Now, for this bubble type, the GMA is not your first signal. Your main exit signal is a simple break of that steep trend line, trendline B. You then use the GMA for confirmation. When the fastest moving averages, the 3- and 5-day, also turn down, that confirms it. The party's over, it is time to get out. Okay, next up, our second type, the in-trend bubble. This one is way less dangerous. In fact, it's really just a brief moment of excitement happening inside a strong, healthy uptrend.
This chart is a perfect illustration. Just look at the foundation here. The long-term moving averages are smooth, they're parallel, and they're rising steadily. The bubble is just that little burst of excitement you see at the top. The underlying trend is rock solid.
The GMMA makes this super obvious. The long-term group of averages, it barely even budges. It stays stable and parallel. The short-term averages, yeah, they pull back after the bubble pops, but they rebound quickly, and the separation between the two groups stays consistent. That tells you everything you need to know. The trend is still strong.
And finally, we have the most dangerous one of all, the end of trend bubble. This is the one that doesn't just pop, it takes the entire trend down with it. This is where fortunes are lost.
This chart is a textbook example of what can go wrong. Notice how the underlying trend in Area A was still developing. The long-term averages were spreading out, they weren't stable and parallel like we saw before. The foundation was weak, so when that bubble in Area B collapsed, it didn't just return to the trend, it shattered it completely. The GMMA gives you all the warning signs you need. First, that expanding long-term group shows an unstable trend. That's red flag number 1. Second, notice how fast the short-term averages cross over. That's traders dumping the stock in a panic. And finally, the long-term averages themselves start to roll over. That's the final nail in the coffin. The trend has failed.
So, after all of this, what's the key takeaway? Well, it really comes down to understanding the true purpose of a tool like the GMMA.
Look, the GMMA is not a magic signal generator. It doesn't predict what's going to happen next, and it does not tell you when to get in or out all on its own. That's just not its job.
Its real power, its superpower, is as a confirmation tool. It gives you a window into the market psychology by showing you that relationship between the short-term traders and the long-term investors. It provides the context you need to validate a signal from another indicator, like a simple trendline break.
So here it is, your takeaway checklist. Step 1. Identify your primary exit signal. Step 2. Look to the GMMA to confirm what's really happening with the strength of that underlying trend. And Step 3, the hardest part of all, you have to act with discipline.
And that brings us full circle, doesn't it? The tools and the charts, they can give you all the clues you need to tell the difference between a temporary pullback and a catastrophic collapse. But in the heat of the moment, when your money is on the line, the final question is always the same. Can you master your own greed?
Today, we're jumping into a really fascinating case study about the psychology of trading. It's a story all about one single trade, but two very, very different outcomes, and the powerful mental trap that lies between them. All right, let's start with a number, 15.63%. Now, that's a pretty decent profit on a trade, right? In fact, in this test case, a whole group of traders saw this exact number, felt pretty good about it, and decided, you know what? Time to cash out. Now contrast that with this number, 43.75%. Yeah, this is the potential profit those same traders left on the table. Kind of makes that first number look a little small now, doesn't it? So what's the difference? What on earth happened between that first early exit and this much, much bigger potential gain? That's the big question we are going to unpack right now. It all kicks off with a classic dilemma for traders. You know the moment. A trade is finally going your way, and you have to make that one crucial choice. So here's the setup. A stock is in the middle of this powerful rally. Prices are just shooting up. And this right here was a real test of nerves for the traders. Do you take the profit you've got on the table and just run for the hills? Or do you hold on and wait for a clear, definite signal that the trend is actually over? So what did most people do? You guessed it. They took the profit and ran. Faced with all that uncertainty, they went for what felt like the safe choice, the early exit, locking in that 15.63% gain. But why? What is it that drives so many of us to make that same decision? Well, the answer comes down to two of the most powerful forces in any market. And this quote from the source material just says it all. In this case, it was all about fear. The fear of that nice, tidy profit suddenly vanishing into thin air. And once that fear takes hold, it really starts to cloud your judgment. And this is where things get really interesting. Because once that fear-based decision was made, maybe not even consciously, the traders walked right into a classic psychological pitfall, the confirmation trap. So the traders who bailed early, they looked at this exact same chart, and wouldn't you know it, they found all the proof they needed to justify their fear. All of a sudden, they started seeing bearish signals absolutely everywhere. So what were they seeing? Well, they pointed to the price dipping below a trend line. They spotted what they called bearish signals in the MACD histogram. They even started drawing new trend lines on the RSI just to find something that looked like weakness. But here's the kicker.
They were selectively interpreting all this data, ignoring all the times these same indicators gave them conflicting signals just a little while before. This little mental shortcut has a name: confirmation bias. It's our very human tendency to go looking for and to favor any piece of information that confirms what we already want to believe, and of course, to ignore all the evidence that contradicts it. I just love this line from the source material because it describes the process so perfectly. They weren't looking for objective truth. They were hunting for reasons. The decision to get out was already made emotionally, in their gut. The technical analysis just became a tool to make that feeling seem rational.
So if that emotional approach was so flawed, what was the alternative? This brings us to a disciplined, systematic way of looking at the very same chart.
So let's take fear completely out of the equation for a second. What did the trading system, the objective preset rules, actually say to do?
Okay, so take a look at this table. It just lays out the difference so brilliantly. On the left, you've got all the signals for staying in the trade, and on the right, the signals for getting out. And as you can probably see, that stay in column is just packed with strong, objective evidence.
Let's just break it down. The Guppy Multiple Moving Average was showing a strong, healthy trend. There was no moving average crossover, which is a key exit signal. The main trend line, still totally intact. And maybe most critically, their predefined stop loss, the countback line, was never even hit. The system was basically flashing green lights all over the place. And this really is the core lesson here. A good, objective system isn't supposed to be open to interpretation. If you can adjust an indicator just to suit your mood, whether you're feeling fearful or you're feeling greedy, then it's not a reliable tool. It's just a way to confirm your own bias.
Now, let's fast forward. The traders who followed their system stayed in the trade, and they watched their profits grow. But the market had another, even bigger test in store for them.
And then this happens, a massive, almost vertical price spike. And the question in your head immediately becomes, is this a bubble? Is this a final dangerous blow-off top that's about to pop? The fear comes rushing right back in, maybe even stronger this time.
So now you have two completely opposite ways to interpret this exact same event. Your gut might be screaming that this is a sign of extreme weakness, a final gasp before a crash. But the trend follower might see it as a sign of incredible strength, a powerful surge that you should stay with. This brings us right back to our central theme, doesn't it? At this moment of extreme pressure, what do? Do you abandon the plan and act on that powerful gut instinct? Or do you trust the system and wait for your planned, predefined exit conditions to actually be met? Which leads us to our final critical question. It's a question that every trader, every investor, and really every decision maker should ask themselves before the pressure is on. You do have a plan, don't you? You know that feeling, right? You're watching a stock just fall day after day, and then bam, it pops. It breaks that ugly downward trend line, and you think, this is it, time to jump in. But then, just as fast as it appeared, it's gone. The price collapses and the downtrend is back on. That kind of whipsaw is not only frustrating, it can be super costly. Well, today, we're going to learn a powerful technique to help us spot the difference between a real breakout and a dangerous fakeout.
So, check this out. This is the classic scene, right? A stock's been in a clear downtrend, and then you get this one price bar that manages to close just above the trend line. It looks like the big break we've been waiting for, and man, the temptation to hit the buy button right here is huge.
But this is the million-dollar question, isn't it? Is this a genuine signal that a new uptrend is about to kick off? Or is it just market noise, a trap designed to suck in eager buyers before spitting them out? Let me tell you, acting on this signal alone is a low probability bet. The market is just littered with these false starts. So how do we get some real confirmation?
Well, this is where we bring in our secret weapon. It's a specialized tool for verification, and it's called the countback line. Think of it like your own personal breakout detective, helping you find that conclusive evidence you need before you put your hard-earned money on the line.
So what exactly is it? The countback line, or CBL for short, is really just a simple calculated line that acts as a short-term hurdle. The whole idea is that for a real trend change, the price can't just break its old trend. Nope, it needs to prove it has some real muscle by clearing this brand new resistance level that we've just drawn.
And this tool is incredibly versatile. It's definitely not a one-trick pony. The CBL gives us 4 super critical pieces of information:
First, it verifies the trend change. It gives us a precise entry signal. It shows us a logical place to put our stop loss. And you can even use it to protect your profits as an exit tool. It's pretty much a full trade management system all rolled into one little line. All right, so how do we actually build this thing? Let's go ahead and put on our detective hats and walk through the simple 3-step process for drawing the countback line. We're going to dust this chart for prints and find the evidence we need. Here's our crime scene, a pretty typical price chart after a downtrend. You can see the price is trying to make a comeback. Our job is to find 3 specific price bars. We're going to label them A, B, and C, and use them to draw our line. Step 1 is the easy part. You just find bar A. This is simply the price bar with the absolute lowest low in the recent move down. That's our starting point, the anchor for this whole thing.
Now for step 2, and this is where the count back part of the name comes in. From bar A, you just move to the left on your chart, 1 bar at a time, looking for the very first bar that has a higher high than bar A. Once you find it, you label it bar B. That's our second piece of evidence.
And finally, step 3. You just repeat the process. Starting from bar B, you keep counting back to the left until you find the next bar with a high that's higher than bar B's high. This is our bar C. You take the high price of bar C, and you just draw a horizontal line straight across to the right. And that's it. That's your countback line. Okay, the line is drawn, but it doesn't mean a thing until we get a signal. And this part is absolutely critical, so listen up. A valid signal is a price bar that closes above the line. I'll say it again. It has to close above the line. If it just touches it or pops above it for a minute during the day, that doesn't count. The closing price is the only thing that matters. This is the secret to avoiding those nasty false starts. Of course, in the real world, charts are rarely that clean and simple. I mean, let's be honest, they're often messy with some confusing price action. So let's take a look at how to handle this more complex evidence without getting thrown off the case. Let's see how this works. On the left, we've got a super simple case where bars A, B, and C are all right next to each other. But on the right, well, that's a bit more complex. Between our important bars, we have several of these inside days. You know, days where the high is actually lower than the previous bar's high. The rule here is simple. You just ignore them. You just keep counting back until you find a bar with a higher high. So in this case, our 3-bar calculation actually spans a full 7 days of trading. So what if you have a couple of days with the exact same low price? Which one do you use for bar A? Well, the rule is crystal clear. You always start the calculation from the most recent one. So even if there was another equal low a few days before, you anchor your whole calculation to the one that just happened. And what about equal highs? You guessed it, the exact same logic applies here. A bar only counts as a B or C if it has a higher high than the one we're counting from. If its high is just equal, it doesn't count. You just ignore it and keep on counting back until you find one that's definitively higher. Okay, now we get to the most important part of this whole explanation. This is how you put all the pieces together to crack the case and find those really high probability trading signals. Now, remember, the count backline is a verification tool. It is not a standalone signal generator. This slide right here shows the #1 mistake people make. We have a valid CBL signal. You can see the price closed above our line. But look, it's still clearly stuck below the major downtrend line. This isn't a trend break, my friends. It's a trap. Using the CBL by itself like this is just not reliable. This is what we're looking for. This is the A+ high probability setup. This is the ultimate confirmation. We have a price bar that has closed above the major downtrend line, and it has also closed above our countback line. When you see these two things happen together, that's when we can have real confidence that the breakout is the start of a real, sustainable move higher. So let's just break it down one last time. A standalone CBL signal is a low probability play because it totally ignores the bigger picture, the major trend. It's often just a trap. But the confirmed signal, the one that combines the CBL with a trendline break, that's a high probability signal. Why? Because it respects the major trend structure. That, right there, is the difference between a potential trap and the real breakout we're all hunting for. And you know, at the end of the day, that's what this is all about. No tool, no indicator, no system can predict the future with 100% certainty. It just can't be done. The goal of a tool like the countback line isn't to be a crystal ball. It's to be a detective, gathering evidence, piece by piece, to systematically shift the odds in our favor. So the final question is, are you just going to keep guessing,
or are you going to wait for the evidence to build your case?
Hey everyone, today we're going to break down a really powerful, rules-based trading technique called the countback line. Think of it as a complete toolkit designed to take the emotion and the guesswork out of your trade entries so you can start trading with a lot more confidence.
You know the feeling, right? We've all been there. You see a stock that's been beaten down, it's been in a downtrend, and then it starts to show signs of life. The price starts ticking up, and that's when the big question hits, the one that causes all the anxiety. When do I get in? If you jump in too early, you risk getting caught in a fake out. But if you wait too long, you could miss the entire move. It's a tough spot.
And this chart right here, this shows the classic mistake. In the heat of the moment, it's so tempting to chase that first big spike up, what we see here as the initial high. But breakouts are rarely a straight shot to the moon. They usually have that sharp first rally, and then they pull back into what the source material calls the best buying zone. Chasing that peak is almost always a recipe for instant regret.
So how do you escape that emotional seat-of-your-pants trading? Well, what if you had a tool? A simple, mechanical tool that could give you a clear sign that the trend might actually be changing. And even better, define a precise entry point and help you manage your risk from the get-go. Well, that tool is exactly what we're talking about today. It's called the countback line, or CBL for short. It's a technique specifically designed to bring some discipline and structure to what's often a really chaotic part of trading. So let's break down what it is and exactly how it works.
At its heart, the countback line is actually super simple. It's just a line you draw on your chart, and it's based on recent price highs that happened during the downtrend. Its whole job is to act like a tripwire. So when the price finally manages to close above this line, that's your alert. That's the signal that the downtrend might be losing steam, and a reversal could be starting.
And take a look at this. It shows the concept perfectly. That horizontal line, the countback line, is drawn from the highs of those earlier price bars. Now the entry signal, which is marked here as A, isn't just the price poking its head above the line. The key is that it has to be a decisive close above it. That's the trigger. That's what tells you, okay, time to pay attention.
Okay, so we've got our signal, but what is it really telling us? What's going on with the market psychology when that trigger gets hit? Let's take a look at what this confirmation really means for us as traders.
You see, a close above the CBL is so much more than just a line on a chart. It suggests that the sellers are getting exhausted and, more importantly, that smart money, we're talking big institutional capital, is probably starting to step in and support this new move up. For you, this means you can have a much higher level of confidence that this isn't just some random blip, but a real potential break in the trend.
Getting a great entry signal feels fantastic, but we all know it's only one piece of the puzzle. A trade without a risk management plan isn't really a trade at all. It's just a gamble. And this is where the real power of the countback line comes in. It doesn't just get you into the trade, it helps you stay safe once you're in it.
And this is what's so cool about the CBL method. It gives you two critical built-in safety nets, a calculated stop loss to protect your cash if you're wrong, and something called a maximum chase line to keep you from overpaying if you're right.
So calculating your stop loss is a really straightforward three-step process. It's all about methodically identifying a logical support level. First, you find the highest point of the new move up. From there, you just count back in 2 stages to find the specific price bars that will set your risk level. Let's actually walk through it visually. All right, here's step 1. After you've entered the trade, the price makes a new high. This bar, the one labeled here as number 1, is your starting point. It's the peak of that new momentum, and it's the anchor for our whole risk calculation.
Now, for step 2. From the bottom of bar number 1, you just look to your left on the chart. Now here's the key. You completely ignore any bars that have a higher low or even an equal low, like bars A, B, and C here. You're looking for the very first bar you come across that has a lower low. That one becomes your significant price bar number 2.
And finally, step 3. You just repeat the exact same process. From the low of bar number 2, you move left again until you find the next bar with the lower low, and that's bar number 3. You draw a horizontal line right from the low of that bar, and there you have it. That's your stop loss. That's your line in the sand. If the price closes below this level, the new uptrend has likely failed, and it's time to get out.
Okay, so we've got our downside protected. But what about protecting us from ourselves? You know that feeling, that fear of missing out, or FOMO? That's where the maximum chase line comes in. It's a calculated upper limit designed to stop you from chasing a price that's moved too high, too fast.
And the logic here is actually pretty clever. First, you find the pivot low. That's the absolute bottom of the previous downtrend. Then you measure the percentage gain from that low all the way up to your countback line entry signal. Once you have that percentage, you just project that same percentage upward from the CBL. That gives you your maximum chase line.
Let's make this really concrete with a quick example from the source material. So just imagine that the distance from that pivot low up to your CBL entry trigger was a 20% move.
Okay, this table breaks down the math perfectly. If the pivot low was 10 cents and the CBL entry was at 12 cents, that's a 2 cent or 20% difference. So then you take that same 20% and apply it to your entry price of 12 cents. 20% of 12 cents is 2.4 cents. You add that on top and it sets your maximum chase line, your max entry price, at 14.4 cents. Now this doesn't mean the stock can't go higher, but it acts as a warning, suggesting that buying above this level right after a breakout really increases your risk of getting caught in a pullback.
So let's pull all of this together. What's the ultimate takeaway here? What's the real value of using a system like the countback line in your trading?
The bottom line is this: the countback line isn't just some single, isolated signal, it's a complete integrated framework. It helps you confirm a trend change, it gives you a crystal clear entry signal, it defines your risk with a hard stop loss, and it protects your profits by keeping you from chasing. In short, it helps you trade with a clear, disciplined plan instead of just relying on gut feelings and emotions.
And this quote from the source material just sums it all up perfectly. Paying too much doesn't kill the trade, but it does reduce profits. So waiting for a temporary retreat increases the profitability of the trade. The goal isn't just to be in a winning trade, it's to maximize the potential of that trade. And avoiding overpaying is a huge part of that.
So, I'll just leave you with this one question to think about. How could implementing a clear, rules-based system for your entries and your exits, whether it's this one or a different one, how could that fundamentally change your entire approach to the markets?
All right, let's talk about a really powerful rules-based trading tool called the countback line, or CBL for short. It's designed to take all the emotion and guesswork out of one of the hardest parts of trading, knowing exactly when to sell. You know the feeling. The moment you hit buy, your mind immediately jumps to two things, right? First, how do I keep this from turning into a massive loss if it goes against me? And second, if it starts going up, how do I make sure I protect those profits and not let them just vanish? Well, that's exactly where the countback line comes in. It's a technique that gives you a clear, calculated price level, a line in the sand so you know when to act. It's all about taking the stress and the gut feelings out of managing your trades. Okay, so let's dive into how this thing works. First up, we're going to look at how the CBL acts as your initial safety net. Right after you buy a stock, its only job is to protect your capital. So, at the very beginning, the CBL's job is purely defensive. It sets a precise price. If the stock drops to that price, you're out. No questions asked. The whole point is to make sure a small, manageable loss doesn't snowball into a really painful one. And the best part? The calculation is so mechanical, it's beautiful. It's the same simple three-step process every single time. You just find the highest bar, then count back to find two specific lower points. That's it. It's that simple. Okay, let's walk through this on a real chart. We find the highest bar. That's bar 1. Easy. Then we look left for the first bar that has a lower bottom. Boom, that's bar 2. Now here's the important part. As we keep looking left, we skip bars A and B. Why? Because their bottoms aren't lower than bar 2's. The rule needs a new lower low. We finally find that at bar C. The bottom of bar C now becomes our stop-loss line. But the CBL is not just about playing defense. Once your trade starts working and you're in the green, its entire purpose flips. It goes from protecting your capital to protecting your profits. And this shift is absolutely crucial to understand. The CBL starts below your entry price, where your trade is technically a loser because your capital's at risk. But as the stock moves up, you recalculate the CBL and it moves up too. Eventually, it crosses above your entry price. Now it's a completely different tool. It's actively locking in your gains. And look at this. This is that magic moment. The stop line, calculated using the exact same three-step rule, is now sitting above our entry point, that little dot. At this point, you've locked in a profit. It is physically impossible to lose money on this trade. You've officially switched from defense to offense. This is where the real power kicks in.
Every time the stock hits a new high, you just recalculate the line. This creates what we call a trailing stop that automatically follows the price up. It's like a ratchet. Just click, click, clicking higher, locking in more and more profit with each new peak. And you don't have to sit there second-guessing yourself every day.
Okay, but we all know that charts aren't always neat and tidy. What happens when the price suddenly jumps, creating those gaps in the chart? Well, the CBL has a very clear rule for that too.
Gaps can totally throw you off. You see that empty space on the chart and it's easy to get confused. But you don't have to worry. With the countback line, there's one simple, very powerful rule that cuts right through the confusion.
And the rule is this. The CBL only cares about the current trend. That's it. Whatever happened before that gap, in some previous trend, it's irrelevant. Your calculation has to stay within the price action of the new trend you are currently trading. This comparison makes it so clear. Look at the left. That's the right way to do it. There's a gap, but the calculation just ignores it and finds the necessary price bars within the current trend. On the right, that's the mistake people make. The calculation jumps across the gap into a totally different older trend. The rule is simple, stay in your lane, and your lane is the current trend.
So, we've learned the rules, and they are incredibly powerful. But now, let's talk about the real expert move, knowing when it might actually be smart to ignore a CBL exit signal.
So when you get that sell signal from your CBL, the advanced trader pauses and asks a different question. They ask, is this trend actually over? Or is this just a temporary dip, a little pullback, and what is still a very strong ongoing trend? In other words, could this be a buying opportunity in disguise?
To answer that question, we need a second opinion. We need to zoom out and check the trend's overall health. And for that, we can use a fantastic tool called the Guppy Multiple Moving Average, or GMMA. Think of it like a health check for the trend. It looks at the bigger picture to tell us if the underlying trend is strong and healthy, or if it's getting weak.
Okay, the GMMA is basically just a cluster of moving average lines. But it splits them into two important groups. The short-term group shows you what the fast money traders are thinking. The long-term group shows you what the big money long-term investors are thinking. And here's the key. You watch that long-term group. When those lines are spread really far apart and heading up, that's the market screaming that this is a powerful, healthy trend. If you see that, a little dip in the short-term lines is probably just noise, not a real reason to panic.
So here is the expert play. If your countback line gives you a sell signal, but you look at your GMMA and see that the long-term trend is rock solid, you can make the decision to ignore the CBL signal. You hold your position, trusting the bigger trend. And for the really aggressive traders, that little dip becomes a brand new opportunity to buy more. All right, let's bring all this home and do a quick recap of what we've learned about this incredibly useful trading tool.
You see, the countback line is so much more than just a simple stop loss. It's really a complete system that guides you through the entire life cycle of a trade. It helps you confirm you're getting in at the right time, it sets that crucial safety net for your capital, and then it literally transforms into an automated tool to lock in your profits as the trend goes your way.
And that really leaves us with the core challenge of becoming a great trader. It's one thing to master a mechanical, rule-based tool like the CBL. That's the science of it. But the real art, and this is where expertise comes in, is developing the judgment to know when the bigger picture, the context, tells you it's time to break that rule. So the question to leave you with is the skill knowing the rules, or is it knowing when to confidently set them aside?
All right, today we're jumping into a super specific and honestly a pretty tough challenge for any trader. What in the world do you do with an IPO? We're going to break down a really cool technical method called the countback line, which is designed to bring some sanity to all that chaos.
I mean, think about it for a second. This is the core problem, right? A stock goes public and it's a total blank slate. You've got no price history, zero established trends, no support or resistance levels to even look at. All the usual tools you'd pull out of your toolbox, totally useless. So how are you supposed to make a smart decision when you're basically flying blind? That's the puzzle we're going to solve.
So here's how we'll tackle it. First, we'll really lay out the IPO trading puzzle. Then I'll introduce you to the countback line and how it solves that puzzle. After that, we'll get really practical with a how-to on reading the first 3 days of trading action. Then comes a super important rule. I'm calling it, don't fumble the stop. And finally, we'll wrap up with how else you can use this and the main things to remember.
Okay, let's start by really defining the problem we're up against.
This is all about trying to navigate in completely uncharted territory.
Yeah, this really sums up the headache, doesn't it? No history means you can't spot trends. No trends, no support or resistance. You're stuck in this weird limbo, trying to figure out what's real market demand versus just a bunch of pre-launch hype. And like the source material says, your entire technical toolkit is basically sitting on the bench.
So this is where you have to make a huge mental shift. This whole game isn't about trying to predict the future or finding the next stock that's going to go to the moon on day one. Nope, it's about one thing and one thing only: managing your risk when you have next to no information.
And that right there leads us to the solution. I want you to think of the countback line as your personal tripwire, a safety mechanism for when you're walking through this fog of uncertainty.
So what is this thing exactly? Well, it's a specialized tool that uses just the first 3 days of price action, that's it, only 3 days, to give you objective, data-driven rules for where to get in and, way more importantly, where to get out. It's literally built for these kinds of low-information situations like an IPO.
You know, the easiest way to think about it is just as a 3-day rule. Forget the hype, forget the news stories. You're just going to sit back, watch what happens for 3 days, and let the price action itself tell you what the market actually thinks of this new company. It cuts through all the noise.
Okay, theory time is over. Let's get into the nuts and bolts. How do we actually use this thing? We're going to walk through the 3 most common scenarios you're likely to see right after a stock lists.
First up, the dream scenario, right? The one everyone hopes for. The stock lists, and for 3 straight days, it just keeps making higher highs. This is a beautiful, clear sign of positive momentum right out of the gate.
And using the rule here is just incredibly simple. You see those 3 bars, A, B, and C? That's your pattern. All you do is take the low point of that 3rd bar, bar C, and you just draw a line straight across. That line is now your trailing stop loss. You can jump into the trade on day 4, and you already know exactly where your safety net is.
Okay, now for the flip side. Let's be real. A lot of IPOs just sink like a stone right after they list. So here, we see 3 days in a row where each day's low is lower than the day before. The market is basically shouting that it's not impressed.
So what's the move? The logic completely flips. We spot our 3 bars with lower lows, but this time we use the high of the 3rd bar to draw our line. And listen, this is not a stop loss. It's an entry line. We don't buy, we just wait. We only even consider entering this trade if and when the price finally proves it has some strength and closes above that line. It's our signal that maybe, just maybe, a reversal is happening.
And finally, we have the scenario you'll probably see most often, and it's the trickiest, the sideways drift. The price is just choppy, it's all over the place, there's no clear direction. The stock is just figuring itself out.
In this situation, your best friend is patience. You just ignore all that initial choppy mess. You wait for what's called a trigger bar, a day that finally breaks out and makes a new high, like bar 3 you see here. Only then do you even start the calculation. And notice, we're not using those first few messy bars. We look for the 3 most recent significant bars, A, B, and C, and we set our stop loss based on the low of bar C.
Okay, so we know how to set the stop loss in all 3 scenarios, but now we have to talk about what is, without a doubt, the single most important rule in this entire strategy. Once that stop is in place, you've got to protect it.
Just look at this comparison very closely. On the left, you've got a valid stop loss, set by bars A, B, and C. It's doing its job protecting your profit. But then, after a crazy day, you could technically do a new calculation using bars 1, 2, and 3, which would actually put your stop loss lower. Now that might seem logical, but I'm telling you, it is a trap.
And the source material on this is just crystal clear. I'm going to read this quote directly because it is that important. The stop loss should not be lowered. It is designed to protect capital and profits. Just let that sink in for a second. The second you lower your stop, you're increasing your risk, and you've just defeated the whole purpose of using this technique in the first place.
So here's the bottom line, the crucial takeaway. Your exit signal is always a close below the highest, most recent valid stop-loss line you've drawn. You just ignore any new calculation that tries to tell you to lower it. You protect your capital, you protect your profits. That's the discipline, that is the rule.
All right, let's wrap this all up with the key takeaways and check out just how flexible this technique really is. Because it's not just for IPOs on a daily chart.
And this is what's so cool. This slide shows you how scalable the idea is. The exact same logic,
The 3-bar rule, how you place your stop loss, it works just as well on much shorter time frames. This example here is using a 5-minute chart. That makes it an awesome tool for day traders who need to manage a position they've already opened. So let's just boil it down to the core principles. Number 1, let the price action, not the hype, be your guide. 2, use that 3-bar rule to create some objective control for yourself. 3, and you've heard me say it a few times, never, ever, ever lower your stop loss. 4, your number 1 job is to protect your capital. And finally, number 5, remember that these rules are fractal. They work on a 5-minute chart just as well as they do on a daily chart.
And that kind of brings us to the final thought here. This entire method, when you really look at it, isn't about finding the next hot stock. It's a disciplined system for managing risk when you have very little to go on. It's about survival, it's about protecting your capital so you can stay in the game. And that really makes you wonder, what does that say about what truly matters if you want to have long-term success in trading?
You know, it's the best problem a trader can have, but it's also one of the toughest. You've made a fantastic trade, you're deep in the green, and now you're facing that million-dollar question, when do you sell? This is exactly where logic can just go right out the window and raw emotion takes the driver's seat. So let's dive into this classic dilemma with a really fascinating case study.
All right, I want you to put yourself in this situation for a second. You've done your homework, you've been patient, your analysis was spot on, and now you're staring at a massive 68% gain. Your finger is just hovering over that sell button. What is your gut screaming at you to do right now? Do you lock it in or do you let it ride?
And this isn't just some hypothetical. Nope. This is the actual chart we're going to break down. Just look at that incredible price spike, what some traders will call a blow-off top. Those profits are very real. They're sitting right there on the table. And the temptation to just grab them it's immense. This is the moment of truth.
Now, to really understand what happens next, we have to look beyond the chart and actually peek inside the trader's mind. Because really, every single decision from this point forward is just a huge battle between two incredibly powerful emotions, fear and greed.
And this is where you can literally see that psychological battle playing out in the data. Look at this. As the trade's return skyrockets on the right, notice what else is happening on the left. The desire to get out, to sell, it climbs right along with it. The more money is on the table, the stronger the urge to take it becomes.
This quote just nails a really strange paradox in trading. We tend to think of greed as wanting more, but a completely different kind of greed takes over when we have a lot to lose. Suddenly, it's not about gaining more, it's about this intense fear of giving back the profits you've already made. And that fear, well, it can be totally overwhelming.
So you're feeling that fear. You really, really want to sell. What do? Well, you turn to your charts, to your technical indicators, looking for an objective answer, right? But what you often find isn't objectivity, it's justification. And that, my friends, is the indicator trap.
And here is the really dangerous part. Once we've emotionally decided what we want to do, which in this case is to sell, our brain stops being a neutral analyst. It becomes a defense attorney. It literally starts hunting for any reason it can find to confirm the decision we've already made deep down. So, with that I want to sell bias firmly in place, let's go look for some evidence, shall we? Okay, we're seeing two common indicators here, the RSI, which measures momentum, and the MACD. And what do we find? Well, look at that. The RSI is turning down from the overbought zone. That's a classic sell signal. And below it, the MACD histogram is clearly getting weaker. Case closed, right? Time to sell. But hold on. What if we looked at this exact same chart, this exact same information, from a completely different perspective? What if we looked at it through the eyes of a disciplined trend follower? Suddenly, the story changes completely. The RSI peak is actually higher than the last one. That's a sign of strength. And the MACD histogram, yeah, it's weakening, but it's still above the zero line. And most importantly, the longer-term trend is totally intact. According to the original trading plan, there is absolutely no signal here to exit. And this brings us right to the core of the conflict. Using the exact same indicators, we've just built two completely opposite cases. One is driven by an emotional reaction to that big price spike, and the other is driven by the cold, hard logic of a predefined trading plan. I mean, just take the Guppy Multiple Moving Average. The trend follower sees a strong, separated trend. That's a clear reason to stay in. But the emotional seller, they see a bubble that's starting to turn down, a reason to run for the hills.
It's the same thing with the RSI and the MACD. The data isn't changing one bit. The only thing that's changing is our interpretation of it. We can make these indicators tell us any story we want to hear.
So, which path was the right one? What happened next? Well, the answer might actually surprise you, and it leads to an even more important question.
And there it is. In the days right after that massive spike, the price did exactly what the sellers feared it would. It pulled back. It fell. So the traders who grabbed their 68% and ran for it, well, they're feeling like absolute geniuses. They timed it perfectly. So they made the right call. End of story, right? Or is it? I mean, making one good decision feels great, but does that actually mean you have a winning strategy? And this is the author's big challenge to everyone who took that defensive exit. See, it's easy to sell, but if the main trend is still going up, the really hard part is having the discipline to get back in. And most people who sell based on fear, they never do. They just become spectators, watching the real trend unfold without them. And this really brings us to the ultimate takeaway here. A successful trading plan isn't about making one perfect call. It's about having a system, a framework for all your decisions, not just when to get out, but when to hold. And, maybe most importantly, when to get back in. Anything less isn't a strategy. It's just a reaction. So, as we wrap this up, I'm going to leave you with this thought. And this isn't just about trading, by the way. This applies to any big decision that's clouded by fear and hope. The next time you face a choice like this, just ask yourself one simple question. Am I being an analyst, or am I just looking for an accomplice for my own emotions? All right, today we're going to dive into something that sounds, well, just plain wrong. But I promise you, it's one of the most powerful risk management tools out there. We're going to see how losing 30% on a single trade can actually be a really smart move. So get a load of this quote. A 30% loss is acceptable? I know, that probably goes against every single instinct you have as a trader. But stick with me, because by the end of this, you'll see not only how it's possible, but why it's absolutely key to surviving long-term. So how do we make sense of that? Well, to unlock that puzzle, we need to understand that every successful trade is built on 3 key figures. Think of it as a system for controlling your risk before you even hit the buy button. And here they are, the big 3. First, you've got your entry price. That's simple. It's where you get in. Second is your stop-loss price. This is your pre-planned escape hatch, the point where you say, okay, I was wrong, and get out. And third, and this is the one that changes everything, is the number of shares you buy. You'll hear this called your position size, and it is the most important variable of them all. But here's the thing. These 3 numbers aren't just floating around on their own. They all stand on one single rock-solid foundation. It's a rule that should be the bedrock of every single trade you ever make. And this is it, the 2% rule. It's so beautifully simple. No matter what, you will risk no more than 2% of your entire trading portfolio on any one trade. Now listen carefully. This is not about the size of the trade. It's about the size of your potential loss. That's a huge difference. Okay, to make this really hit home, let's just imagine our total trading capital is a nice round $100,000. This is our whole pie, the entire account we're working with. So if we apply our 2% rule to that 100 grand, it means the absolute most money we are ever allowed to lose on one single trade is $2,000. That's it. That number, $2,000, becomes our unbreakable limit. Just look at this. See that tiny little sliver down in the corner? That's our $2,000 risk. And that big column next to it? That's our whole portfolio. So yeah, the loss on the stock itself might be a big percentage, but compared to our total capital, it's just a tiny, completely managed sliver. And this brings us right back to that crazy idea from the beginning. How can we possibly be okay with a huge percentage loss on a stock? It's because we're not focusing on that number. We're shifting our focus entirely. You see, most people get absolutely spooked by the number on the left. A 30% drop? That just sounds like a disaster. But a pro trader who uses this rule, they're only looking at the number on the right. They know their maximum dollar loss is capped at $2,000 no matter what that percentage says. One is an emotional gut punch, the other is a calm, calculated business decision. Okay, I know what you might be thinking. This sounds great in theory, but how does the math actually work? How do you connect that scary 30% drop to a small fixed dollar loss? How do we make this a reality? All right, let's break it down step by step. We're going to walk through a real-world example from the source material using a stock called Adelaide Brighton, ticker ABC. This will show you exactly how those three figures and the 2% rule all work together to put you in complete control. So, first things first, we're not just throwing darts at a board, right? We look at the chart. We're not guessing. The chart itself gives us a logical place to get in, and more importantly, a logical place to get out, a support level. If the price breaks below that level, our whole idea for the trade is probably wrong. So just like that, the chart gives us our first two figures. Okay, let's lay out all our key numbers. We've got our total capital of 100 grand. The chart tells us our entry is $1.04, and our stop loss, our get out point, is at 95 cents. And of course, our 2% rule caps our maximum dollar risk at $2,000. These are all the ingredients we need for our recipe. And now for the magic. The distance between our entry and our stop is just 9 cents. That's our risk per share. So how many shares can we buy? Simple. We take our total maximum risk, $2,000, and we divide it by our risk per share, 9 cents. And the answer is 22,222 shares. And there it is. That's our third figure, our position size. But wait, here's a real pro move. You don't have to take the maximum risk. That position would cost over $23,000. What if you're not quite that confident, or you just prefer a smaller position? Let's say you only want to put $20,000 into this one idea. This is where you get even more control. So by choosing to invest a bit less, around $20,000, we naturally buy fewer shares, 19,200 of them. The risk per share is still 9 cents. That hasn't changed. But when you multiply that by our smaller number of shares, look what happens. Our total dollar risk at stake drops to just $1,728. See that? Our rules said we could risk up to $2,000, but by being smart and choosing a smaller position size, we reduced our actual risk to just over $1,700. That's not even 2%. It's more like 1.7% of our capital. That is real risk management in action. So you see, at the end of the day, this isn't just about plugging numbers into a calculator. It's a complete shift in how you look at the market. It's about moving from gambling on what you think will happen to professionally managing the probabilities. So if you only take away a few things from this, let them be these three. First, your risk is always defined by your total portfolio, not the single trade. Second, use the chart to tell you where to get out, not your gut feelings. And third, and most importantly, remember that how many shares you buy, your position size, is your ultimate control knob for risk. And that brings us right back full circle to this powerful idea. That 30% loss, it's just noise. It's irrelevant. The only number that actually matters for your survival as a trader is that small, controlled percentage of your total capital. If you can master this one concept, you've mastered the very core of defense in trading. So I'll leave you with this question to really think about. Look at your own strategy. If your very next trade goes completely wrong, and it will happen, is it built to be just a small, manageable business expense? Or could it be a catastrophic blow? Because the answer to that question will determine if you're still here trading a year from now. All right, let's talk about something that sounds so simple, but is actually one of the hardest things to get right as a trader, the stop loss. So many of us struggle with it, but you know what? By the end of this, you're going to have a real game plan. So let's just be real for a second. Is the stop loss your best friend, the tool that protects your capital, or is it your absolute biggest headache, constantly kicking you out of trades right before they take off? If that sounds familiar, trust me, you are definitely not alone. Okay, so let's get right into it. The whole issue with stop losses really boils down to what you could call the Goldilocks problem. It feels almost impossible to get it just right. I mean, think about it. If you set your stop too tight, you get whipsawed by the smallest, most normal market dip. You do everything right, you take that small loss, and then you just have to sit there and watch in agony as the price skyrockets without you. But if you set it too loose to give it room to breathe, you end up giving back way too much profit, or even worse, taking a massive hit when the trend really does turn against you. It's this no-win situation that makes a lot of people just throw their hands up and stop using them altogether. And you know, all that frustration, it usually comes from one single fundamental error. Let's call it the mid-air mistake. It's this trap of just picking a random stop-loss level that has no real basis. The source material puts it perfectly. It's just a figure plucked out of the air. You know, when you decide your stop is going to be 5% or maybe a fixed $100, it feels disciplined, right? But that number, it has absolutely zero connection to what the price is actually doing on the chart. And this slide right here, this shows the problem perfectly. See that little floating dollar sign? That's your random stop, just hanging out in midair, totally disconnected from reality. The actual floor, the real support level, is down there, based on the chart's history. A stop that's just plucked from thin air isn't anchored to anything, so it can't really protect you. So if just guessing a number is the problem, what's the solution? Well, we have to completely change how we think. We need to anchor our stop loss to the logic of the chart itself. We need a chart-based anchor. And that anchor, that is the support level. Just think of it like a historical price floor. It's a spot on the chart where, in the past, buyers stepped in and overpowered the sellers, making the price bounce. That bounce, that pause, that's our opportunity. That's our logical place to stand. And this leads us to one of the coolest, most powerful ideas in trading. When a price finally breaks through an old resistance level, an old ceiling, that same level very often flips and becomes a brand new, super reliable floor of support. It's a total game changer. Okay, this is where it all clicks into place. Once you really get that your stop loss has to be based on a logical support level from the chart, it totally transforms how you think about risk, and maybe most importantly, how much money you can actually put into a trade. So let's check out two different trades here. In trade 2 on the left, our entry point is kind of far above that solid support level. Now look at trade 3 on the right. Here, the entry is right on top of that exact same support level. But here's the key thing. In both trades, the logical place for the stop loss is exactly the same, just underneath that support line. And this is the point you have to burn into your brain. The market creates that support level. That floor is there whether you decide to trade or not. Where you get in doesn't change the structure of the chart one bit. Now, let's just say for both of these trades, you've decided ahead of time that the absolute most you are willing to risk is $2,000. That's your line in the sand. That number doesn't change. So for that far entry, trade 2, the distance from your entry down to your stop loss is pretty big. To keep your risk locked at $2,000, you have to buy a smaller number of shares. But now look at the close entry in trade 3. The distance to that same stop loss is tiny. What does that mean? It means you can buy a much larger position, a lot more shares, and still have the exact same $2,000 of risk. And that's the big aha moment. You let the distance to your logical stop determine your position size, not the other way around. Now, I know what some of you may be thinking. What about volatility? A lot of people use stops that are based on how much the price has been swinging around lately. So how does that stack up against using a solid chart-based support level? Well, let's break it down. A chart-based support level is a major structural feature of the market. It's like a landmark that tons of other traders are watching and reacting to. A volatility-based stop, on the other hand, it's just a temporary calculation of recent noise. It's fleeting. It changes constantly. So that really brings us to the main event, right? When a price starts to drop, which of these two forces is going to win out? The long-term structure or the short-term noise? This chart gives us a pretty clear answer. You can see the price starting to fall, and those swings, that's the volatility. But look what happens. The drop is stopped dead in its tracks by that strong support level. That historical floor just soaks up all the selling pressure and contains that short-term choppiness. So while volatility tells you how bumpy the ride is, it's the underlying structure, the support and resistance, that usually defines the road itself. In the battle between market structure and random noise, structure almost always comes out on top. So here it is, your action plan boiled down into 3 simple steps. Number 1, find a logical chart-based support level. Number 2, place your stop-loss order just a little bit below that level. And number 3, this is the crucial part, calculate your position size based on that stop, so that if you get stopped out, your loss is exactly what you planned for. And the real beauty of doing it this way is that you build yourself a safety cushion. By letting the chart tell you where to put your stop and letting your stop tell you how much to buy, you guarantee that if a trade goes wrong, the hit to your account is controlled, it's predictable, and most of all, it's survivable. You've just turned risk management from pure guesswork into a solid formula. Which really just leaves us with one last question to think about. The next time you go to put on a trade, ask yourself this. Is your stop loss just some random number you plucked out of the air, or is it a calculated part of a real game plan? Because honestly, the answer to that question can make all the difference in the world.
You know, we're going to dive into something really fascinating today. We're talking about the idea that the single greatest threat to your trading success, well, it isn't the market, it's actually your own mind. It's a danger we literally create for ourselves.
So let's just start with this question right here. What if the biggest risk to your hard-earned capital has nothing to do with market crashes or bad news, but everything to do with what's going on between your own two ears? The source material we're looking at suggests our own psychology can completely sabotage our most brilliant strategies.
Okay, first things first, we've got to wrap our heads around this one crucial concept. As a trader, you are not a static person. You're constantly evolving. Trading isn't some destination you arrive at. It's a journey of continuous change.
Think about it. Your experiences, both in the market and just in life, your age, your maturity, even major life events, they all change who you are. And what that means is that a trading strategy has to evolve not just with the market, but with you. The simple rules that worked perfectly when you were a beginner might actually become a liability once you're an expert.
All right, so let's talk about something you've probably heard a million times, the classic 2% rule, right? The textbook theory that says you should never, ever risk more than 2% of your total capital on a single trade. On paper, it sounds flawless. It sounds like the perfect recipe for discipline.
So this chart here, this is basically the textbook dream. As your account grows, that 2% risk also grows in raw dollar terms. Maybe it starts at $500, then it's $1,000, then $2,000. The theory just assumes that your ability to take that loss scales up perfectly right along with it. You just follow the rule, no matter the dollar amount. Simple, right?
Well, this is exactly where that perfect theory just smacks right into the messy wall of human psychology. Because in the real world, most of us, we just don't work like that. We all have a hidden tripwire, a psychological red line that's based on a raw dollar amount.
Okay, now look at this. This is what really happens. See that flat horizontal line? That's a trader's actual dollar tolerance. It doesn't really go up. So as their account grows, the 2% rule starts demanding they risk more and more until eventually they cross that psychological line. And suddenly, hitting that stop loss isn't so simple anymore. Discipline starts to crack.
I mean, just look at these two side by side. The contrast is just stark. On the left, you've got this clean, logical, robotic progression. And on the right, that's the messy, emotional reality of a human being staring at a loss that feels way too big. And that gap right there between theory and reality, that's where traders get into some serious, serious trouble.
So what is this magic number? This psychological tripwire? Well, according to the source material, for a lot of traders, it's right around here, $1,000. It's this huge mental barrier. A loss of, say, $950 might feel awful, but it's manageable. But the second it crosses that four-figure line, a totally different part of your brain kicks in, and fear starts calling the shots.
So this is the big question, right? How do you even know when you've hit your own hidden limit? The clues can be pretty subtle at first. We get really good at making excuses and fooling ourselves. But there are some crystal clear warning signs that your psychology is starting to take over your strategy.
I want you to be honest with yourself for a second. Do any of these hit a little too close to home? You start putting off an exit, telling yourself, oh, it'll come back. You start ignoring your own stop loss because suddenly it feels too tight. Or, and this is the worst one, you just freeze. You're paralyzed as a loss gets bigger and bigger, way past your comfort zone. See, these aren't strategy problems. They're psychological tells.
And if you think this is all just theory, listen to this. This quote from the source material is an incredibly powerful, real-world example. After going through a major life trauma, a flood that wiped out everything, the author's capacity for risk just collapsed. He didn't even realize it at first, but his trading records told the story. Life changes us, and that change will absolutely show up in our trading.
Okay, so we've laid out the problem. This big, scary disconnect between the risk we think we can handle and where our brain will actually let us handle. The good news? We can absolutely fix it. So, how do we align our strategy with the reality of how our minds actually work?
You know, the typical advice you hear is, oh, just reduce your position size. But that doesn't really solve the core issue, does it? If you have a big account, even a smaller position can still represent a dollar amount that's way over your psychological limit.
The real solution, the better solution, is to focus on the dollar risk itself and make sure it never goes beyond that number you can act on without even hesitating.
And this leads to a really smart, practical strategy. The solution shown here is to mentally split up your capital. It's almost like a psychological trick. Instead of seeing your portfolio as one giant lump sum, you break it down into different buckets for different trading styles, like maybe one for standard trading and another for more speculative plays.
Let's actually run the numbers so you can see how this works. It's pretty brilliant. So you've got 150 grand. The 2% rule says you can risk 3 grand on a trade. But remember, your mental limit is only $1,000. So what do? You split the capital. You say, okay, $50,000 is for my speculative trades. Now it's 2% of 50,000. It's $1,000. It perfectly exactly matches your psychological tolerance. You've literally engineered your strategy to fit your own brain, which makes staying disciplined, well, it makes it a whole lot easier.
And that really is what this all boils down to. The big takeaway here isn't just a new strategy. It's a call for some serious self-awareness. It's not about what the textbooks say you should be able to risk. It's about what you, as a constantly evolving person, actually can risk without freezing up. So the question is, do you truly know your number?
You know, every trader knows this feeling. You get into a position, you see the numbers start to move, and all of a sudden, it's not just about the money anymore, is it? It's a full-on psychological battle, a fight between your plan, your greed, and your fear. So in this explainer, we're going to break down that internal conflict to really get at the psychology of the perfect trade exit.
So let's just start with a quick question for you. When you're in a winning trade, what's the dominant emotion you feel? Is it that rush of excitement as you're thinking about taking a profit? Or is it that nagging regret, thinking, oh, I should have acted sooner? Or maybe it's that rising panic as you watch those hard-won profits start to shrink. Whichever one it is, trust me, you are not alone. This is the emotional roller coaster every single trader rides.
You see, the source material for this explainer suggests that every trade we make actually takes us through 3 distinct psychological shifts. It's kind of like the emotional life cycle of a trade, and if you can understand these stages, you are well on your way to mastering your exit strategy. Okay, so it all starts with profit temptation. You know, that little voice in your head telling you to cash out the second a trade turns green. Then comes the second and honestly the most painful one, the regret of if only. That's when you're just kicking yourself for not selling at the absolute peak. And finally, if things turn against you, you enter the struggle with loss, where your emotions and your logic are in a cage match to try and save the position. We're going to unpack all 3 of these using a real-world case study.
So let's zoom in on that second transformation, because it's a big one, the intense pain of if only. This is where your discipline gets tested like never before, and it's where a lot of traders, frankly, make their biggest mistakes. Let's take a look at a chart that I bet will feel pretty familiar to a lot of you.
All right, so look at this. At its absolute peak, this trade was showing a potential return of almost 69%. Awesome, right? But for the traders who held on and followed their stop-loss signal, the actual exit happened much later, for about a 40% return. Now let's be real, that is still a fantastic gain, but psychologically, it feels like a loss. That 28% gap between what could have been and what actually was, well, that's the valley where regret is born.
And this is where it gets so dangerous. Once you've seen that bigger number on your screen, it is incredibly hard to think straight. Greed just barges in. You start running all these if-only scenarios in your head, thinking about the money you could have made. And when you're in that emotional state, making a rational, clear-headed decision becomes, well, let's just say it's next to impossible.
So the big question is, how do we escape this trap? The answer isn't some secret indicator or a magic formula. It's a really fundamental shift in your mindset. It's all about letting go of this need for a perfect exit, and instead embracing the power of a good enough one.
I love this quote from the source material because it's just so true. It tells us that this kind of variability isn't just likely, it's absolutely guaranteed. You will never hit the absolute peak on every single trade. It's just not going to happen. Some exits will be amazing, and others, well, they'll feel a bit disappointing. The real goal isn't perfection on any one trade, but consistent, solid performance across all of them.
And this chart just visualizes that idea perfectly. I mean, look at it. If every one of these dots is a trade exit, just notice how few of them actually hit that top line, the so-called perfect exit. The vast majority, they're clustered together in a range just below it. This right here is what successful, realistic trading actually looks like. It's a cluster of good results, not some desperate hunt for one single point of perfection.
And this brings us to a really concrete, actionable goal. The data points to this. Aim to have your exits cluster within 10% of the absolute high. Think of that as your new definition of a win. It's not a random number. It's a data-driven target that helps define what good enough looks like and frees you from the psychological trap of chasing perfection.
Okay, so we've got our mindset shift. That's huge. But what happens when we're facing that third transformation? The struggle with a declining trade and the technical indicators start telling us a messy, conflicting story. Let's dive in and see what that looks like.
So on the left, you can see the indicators when the trend was healthy and strong. Everything's looking good. Now look over at the right. The whole situation has deteriorated. You can see the long-term group of moving averages has rolled over. It's starting to compress. That momentum that was pushing the trade up, it's fading fast. The charts are basically yelling at us that something fundamental has changed.
And here is the core dilemma. Our main exit signal, the countback line, is now kind of ambiguous. It signaled an exit, but then the price bounced. At the same time, a whole bunch of other tools, indicators that measure trend strength and momentum, like the Guppy MMA and the RSI, are all screaming, "Get out! Exit now!" So, what do? Do you stick to your original plan, or do you listen to this growing chorus of warning bells?
But wait, here's the twist. The source reminds us that some of these very same indicators that are now yelling exit also gave false signals earlier in the trend. If you'd listened to them back then, you would have missed out on the biggest part of the move. You know, as the author says, just as a broken watch is right twice a day, so too can a broken indicator be right every now and then. So the real question is, can you really trust them this time?
And all of this brings us to the final and most important part of this whole discussion. We've talked through the emotions, the mindset shift, and the mess of conflicting data. The theory is over. Now, it's your turn to make the call.
So here's the chart as it stands right now. The price is pulled back, it bounced a little bit, but it still looks weak. Your exit signal was triggered. The other indicators are all bearish, so is this just a temporary pullback before another huge surge higher? Or is this the final warning sign before a much bigger drop?
So, the final question is all for you. Knowing what you now know about the perfection trap, understanding that powerful emotional pull of if only, and seeing all these conflicting signals right there on the screen, what's your next move? Do you hold on and hope for a rebound? Or do you get out, protect the profit you have, and accept a good enough result? Your answer really says everything about your own trading psychology.
So today we're going to talk about a trading method that pretty much flips everything you've probably heard on its head. And what's really fascinating is that it wasn't cooked up by some Wall Street genius. Nope. It was created by a world-touring professional dancer who needed a simple way to trade powerful trends from basically anywhere on the globe. All right, let's jump right in by taking a good hard look at probably the most common piece of advice in all of finance. I mean, how many times have you heard it? Buy low, sell high. It's everywhere, right? It sounds so simple, so logical. But what if that very instinct, that hunt for a bargain, is actually what's keeping you out of the biggest, most explosive moves in the market? Just look at this chart. It really shows the problem perfectly. As you move from left to right, every new price peak looks expensive at the time. But as the trend just keeps on pushing higher, what looked pricey a month ago suddenly looks like a bargain in hindsight. If you were sitting on the sidelines waiting for a dip, you would have missed this entire incredible run. And that brings us to the core idea behind the Darvas method. Forget bargain hunting. The whole philosophy is to buy high and sell higher. You're not looking for what's cheap. You're looking for what's strong. You buy a stock that's already proving it has momentum, and you ride that wave. So where on earth did such a counterintuitive idea even come from? Well, the backstory is almost as cool as the system itself. So the guy who came up with all this, Nicholas Darvas, he wasn't glued to a trading desk. He was a performer, constantly traveling the world. He couldn't sit there watching the ticker all day. He needed a system that was completely mechanical, one he could manage with just daily prices sent to him by telegram, no matter where he was. And this is his brilliant central idea. Darvas saw an uptrend not as just some line going up, but as a series of boxes, like a staircase climbing higher and higher. The goal isn't to predict the staircase. It's just to get on a step and let the trend carry you up to the next one. And that box is everything. It's basically an imaginary container that you draw around the recent price action. The trend is defined only by how these boxes behave, You're completely ignoring all the classic stuff like moving averages or trend lines. Okay, so let's get into the nuts and bolts. How do you actually build one of these boxes? The rules are incredibly strict, and that's the whole point. First, let's talk about the sealing of the box. It's a very specific 3-step process. Step 1, a stock hits a new high. Great, that's your potential top. But it's not confirmed until step 2 happens. It has to be followed by 3 straight days where the high is lower than the previous day. Once that 4-day pattern is complete, boom, the ceiling of your box is locked in. Now for the bottom. It's pretty much a mirror image, but there's a key detail. You can't even start looking for the bottom until the top is officially set. Once it is, you find the lowest low made during that time. That's your potential floor. And it gets confirmed only when it's followed by 3 straight days of higher lows. Then, and only then, is the floor of your box locked in. And what's so powerful about this is that it's completely mechanical. There's zero room for interpretation. No gut feelings, no, well, it looks like it's turning around. You just follow the rules, draw the box, and that's it. It was designed specifically to take all the emotion out of the equation. So now that we know how to build the box, let's see how this all comes together into an actual trading strategy. And you know what? The trading rules are just as simple and elegant as the box rules. The buy signal is easy, the price breaks out above the top of the newest box. And your sell signal, which is also your stop loss, is just as clear. The price drops below the bottom of that same box. That's it. This is a fantastic real-world example of the system in action. You can see the boxes climbing up like stairs. The entry gets triggered at 20 cents when the price pokes its head above that box. As new higher boxes form, the stop-loss level automatically moves up with them, locking in your gains. And the trade is finally closed out at 30 cents when the price breaks the floor of that last box. Now, here's what's so cool about this. See that little dip? A classic trend follower might have panicked and sold there, but because the price never actually broke the floor of its Darvas box, the system just tells you to hang on. It filters out all that market noise and keeps you in the trade longer, letting you catch a much bigger piece of the move. And that last point really gets to the heart of what makes this approach so different. It's designed to be used all by itself. This is probably the most radical part of the whole system. When you trade with the Darvas box, you're supposed to ignore literally everything else. No drawing trend lines, no checking moving averages, you don't even look at volume to confirm a breakout. The box is your entire universe. It tells you when to get in, and it tells you when to get out. End of story. Of course, times change. Markets today are way faster and more volatile than they were in the 1960s, so traders have adapted the original method. You can see here, some modern versions might use the daily closing price for exits, just to avoid getting shaken out by a quick midday drop. Some even use complex ideas like ghost boxes to create a more dynamic stop loss. The core logic is still there, but it's been tweaked for today's market conditions. But even with all these modern tweaks, the fundamental idea is exactly the same. It's all about trusting the price action, which is neatly defined by these simple boxes, and having the discipline to ignore all the other noise. Ultimately, the story of Nicholas Darvas and his incredible system is a huge reminder to question the things we just accept as true. It leaves you with a really interesting thought, doesn't it? What other rules of the market might you be following just because you've always heard them? Welcome to The Explainer. You know, today we're going to dig into a really classic trading strategy, one that actually comes from the 1950s. And it's all about tackling a simple question, but one that can literally make or break your entire portfolio. So here's the thing every single trader has to ask themselves at some point. A stock hits a brand new peak. Is this a genius move, the perfect time to buy, or are you just walking straight into a trap? Well, that exact problem, that's what the Darvas box technique is all about. It's a way to figure out if you're looking at a real, powerful uptrend or just a temporary blip before a big drop. And get this, it was created by Nicholas Darvas, who is actually a professional dancer. He developed this box method as a super clear, rule-based system. The whole idea is to confirm a stock's real strength before you put your money on the line, you know? It's about taking emotion right out of the equation. Okay, now look at this because it's absolutely crucial. The strategy's reliability really changes depending on the time frame. If you start with a solid 12-month high, we're talking an 80% success rate. But look what happens when you shorten that to 6 months or 3. It drops off. This tells you one thing loud and clear. The quality of that first high, it's everything. All right, so how do we actually build this thing? It's basically a two-step process. And step one is all about building the top of the box, what traders call the resistance level. Now, this part is super specific. You gotta follow it exactly. It's a 4-day pattern. First, you spot that new high. We'll call that bar 1. Then you just watch. For the next 3 trading days, the high for each of those days has to be lower than the high of bar 1. It's that simple, but that's strict.
And here's a perfect picture of it. See that bar 1? That sets the ceiling. The next 3 bars bounce around a bit, but the key thing is none of them poke through that ceiling. Once you have that 3-day confirmation, boom, the top of your box is officially locked in.
And I mean it when I say this rule is strict. There are no exceptions. If, on any of those 3 follow-up days, the price even touches that high or goes higher, the whole thing is off. You have to scrap it and start the count all over again from that new higher peak.
Okay, so we've got the top, the resistance line all confirmed. Now we can flip our focus and build the bottom of the box. This is our support level. And the logic here is pretty much a mirror image of what we just did. You find the absolute lowest point the stock hits on or after bar 1. We'll call that bar A. Then you watch for the next 3 days, and you're looking for the low of each of those days to be higher than the low of bar A. It's about finding the floor. Now, finding this bottom, it doesn't always happen right away. You might set the top of your box, and then the price just kind of drifts for a few days before it finally hits that true low point, bar A. And even then, you still have to wait for those 3 consecutive days of higher lows to confirm it. And there you have it. The box is complete. We've got our top, we've got our bottom. What we've really done is draw a clear line in the sand, right? This box shows us the stock's current trading range. It's basically the battlefield between the buyers and the sellers. So we've built the box. That's great, but now what? I mean, this isn't just a pretty picture. The whole point of the box is that it gives us crystal clear signals on when to actually make a move. And you're going to love how simple this is. If the price breaks out above the top of the box, that's your buy signal. It's like the market is telling you the bulls have won. Now that bottom line, that's your safety net. That's your stop loss. If the price ever drops below that line, the trade has failed. You get out, period. Let's look at it visually. On the left, you see the price punch right through the top of that box. That's your green light to get in. But on the right, it breaks down and falls through the bottom. That's your clear signal to exit the trade and protect your money. No guesswork involved. All right, the basic idea is pretty straightforward, right? But like anything in trading, the devil is in the details. So let's talk about a few pro tips and, more importantly, some common pitfalls that can really trip people up. Okay, a few key things to remember. First, once that box is fully built and confirmed, the price can touch the top or bottom lines all at once. That doesn't change anything. The box is locked in until there's a real breakout. And second, be really careful with automated charting tools. They might draw a perfect-looking box, but if they start from the wrong high, it's totally useless. This right here is probably the biggest mistake I see people make. Look at Trader A. They started their box from a legitimate, true new high for the year. Perfect. Now look at Trader B. Their box looks right, the structure follows the rules, but it's totally useless. Why? Because they didn't start from that all-important new period high. So the main takeaway here is this. A box that looks right but starts from the wrong place is a trap. The entire strategy, the whole thing, hinges on that very first data point. You have to validate that initial high. And hey, one last little pro tip for you. This is kind of a special case. Sometimes, especially in the crazy volatile markets we see today, that first bar, bar 1, is so huge that its high and its low actually set both the top and the bottom of the box on the very same day. The rules for confirmation still apply, it just means the box can form a whole lot faster. When you boil it all down, what Nicholas Darvas really created was a system to filter out all the noise and emotion. It's designed to take one of the scariest decisions in trading, buying at a new high, and turn it into a calm, logical, rule-based decision that you can feel way more confident about. You know, it's kind of funny. In a world full of super complex algorithms and high-frequency trading, a simple, disciplined box from the 1950s can still offer so much clarity. So I'll leave you with this question to think about. Could this simple, old-school box be exactly what you need to bring a little more discipline to your own trading?
Welcome to The Explainer. Today we're diving into a fascinating story, a trading strategy from the 1950s that's still got traders talking. It's called the Darvas Box, and it's a classic for a reason. So let's kick things off with a question I'm sure every single one of you has asked at some point. You're watching the market, you see a stock starting to climb, and the big question is, right? How do you know if you should jump in or if you're just going to get burned?
Well, believe it or not, the key might just come from a secret developed back in the 50s. And get this, it wasn't from some Wall Street whiz kid. It came from a world-famous ballroom dancer named Nicholas Darvas. Yeah, a dancer. This guy famously turned a pretty small stake into a fortune, and he did it all while touring the world using just telegrams and the daily paper. Kind of wild, right?
So what exactly is this Darvas box? Let's get right into it because the core idea is actually super visual and, honestly, pretty intuitive once you see it. Okay, so at its core, the Darvas box is just a way to spot a stock that's, well, taken a breather during a strong climb. Think of it like this. A stock hits a brand new high. Awesome. Then, for a few days, it kind of chills out, bouncing around a bit, but never quite hitting that new peak again. The highest point it reached during that chill-out period, that's the top of your box. The lowest point, that's the bottom. And when the price finally punches through the top of that box, boom, that's your signal. That's the breakout that suggests the upward journey is about to kick off again.
Now, Darvas was super disciplined about this. He had a strict set of rules. Rule number 1, and this was a big one, he would only look at stocks hitting a new 12-month high. See, he wasn't trying to find cheap, beaten-down stocks. Nope, he was a momentum guy. He believed that stocks showing strength would just keep getting stronger. And his decisions, they were based purely on price, nothing else. No news, no earnings reports, just the highs and lows on the chart. Oh, and one more absolutely crucial piece. For a breakout to count, he needed to see a big spike in trading volume. For him, that was the proof that the big players, the institutional money, were jumping in on the action.
All right, so when this whole thing comes together perfectly, it's a beautiful thing to see. It literally looks like an elegant staircase climbing straight up to Profit Town. Let's take a look at what a perfect breakout actually looks like.
And there it is, a textbook example. Check out this chart. It's a stock Darvas actually traded, called Giant Wire. You can see it clear as day, right? The staircase. The price shoots up, pauses to form a box, then breaks out and does the exact same thing again, but higher up. Each one of those boxes acts like a new floor, a new base of support for the next move up. This is the holy grail for a Darvas trader.
But here comes the reality check. I mean, if it were really this simple, we'd all be millionaires, right? The truth is that beautiful, clean chart hides just how tricky this can be in the real world. Okay, so we've seen the perfect setup, but let's be real, most charts are messy. They don't look like that pristine example. And Darvas knew this better than anyone. In fact, he spent most of his time looking for reasons to reject a stock. And that's the real secret here. The key to his method wasn't just finding the good breakouts, it was being ruthless about filtering out all the bad ones.
You know, his real genius wasn't in drawing the boxes, it was in knowing which ones to throw in the trash. He basically had this mental checklist of red flags, like, is the stock jumping around like crazy, super erratic? Nope, that's unstable, pass. Is the new high just hitting its head on an old peak from a few months back? Uh-oh, that's a ceiling, that's resistance, not a true breakout. What about a stock that's been sleepy for months and then suddenly goes vertical? That's a huge red flag, often a sign of a bubble about to pop. His whole philosophy was basically, when in doubt, stay out.
Okay, this is where it gets really interesting, seeing these red flags in the wild. On the left here, you've got aliquot asset. See that? That's the classic price spike we just talked about. A stock that was doing nothing suddenly goes straight up. That is a hard pass. On the right, with Asdrill, the stock is pulled back. Now you might think, hey, a new box is forming. But the smart move, the Darvas move, is to wait. You don't guess, you wait for confirmation.
And here are a couple more classic traps you've got to watch out for. Look at Balmoral Group on the left. It's not actually making a new high. It's just tapping an old one. And see how gappy the chart is? That screams low volume, no liquidity. You can't have a real trend without people actually trading the stock. Then over on the right, IWL just keeps smacking its head against that 27-cent level. That's a wall. It's a clear resistance point, not a launch pad for a new trend.
And last but not least, two huge mistakes people make. On the left, with guns, the breakout is coming from what we'd call an invalid box. A prior box failed, so the whole pattern is compromised. And on the right, oh boy, this is a big one. Look at Legal Co. The price is already way up at $1.70,
but the top of the last box is all the way down at $1.03. That is the definition of chasing. The train has already left the station, and trying to jump on now is just way, way too risky.
Okay, so let's say you've done everything right. You've filtered out all the junk, you found a great setup, and you're in the trade. Now for maybe the most important part. How do you protect yourself? How do you manage the trade? This is where we need to talk about the stop loss. All right, let's do a little case study. We'll walk through a trade together. So the stock breaks out of box A. That's our signal. We buy. And immediately we set our stop loss, our safety net, right below the bottom of that box. You can see it there at line 1. Simple enough, right? So far, so good. So the stock keeps climbing, which is great. It eventually forms a new valid box, which we'll call box D. And only now are you allowed to move your stop loss up. You bring it up to the bottom of this new box D, which is line 2. But look at the time that passed. It took nearly 6 weeks from when you first bought the stock to when you could finally move your stop up and lock in some of that profit. Think about that. For 6 whole weeks, all your gains were completely exposed.
Now let's zoom out and look at the whole ride. See those huge gaps in time between each stop loss move, between line 2, line 3, and line 4? In those big gaps, sometimes weeks at a time, the stock price is just rocketing higher, but your safety net is stuck way down below. That growing distance between the current price and your stop loss, that is a massive amount of open risk. And in today's super fast, volatile markets, that's a pretty scary place to be.
So just to hammer this point home, it's really a double whammy of risk. First, the stock price can run way, way ahead of your stop loss. And second, it can take forever for that stop loss to catch up because you're stuck waiting for a whole new box to form properly. And all that time, your hard-earned profits are just sitting there, totally vulnerable.
Which brings us to the big question, right? What's the takeaway here? How does a system invented decades ago hold up for a trader looking at the markets today?
Look, there's no denying the elegance of the Darvas box. It is such a powerful, simple, visual way to understand and see a trend taking shape. But, and this is a big but, the insane discipline it takes to manage the risks, especially that time lag we just talked about with the stop loss, that's the massive gap between just knowing the theory and actually making money with it.
And that really leaves us with one final big question to chew on. The core ideas behind this strategy, follow strength, cut your losses quick, let your winners ride, those are absolutely timeless. They'll always be true. But the actual mechanics of the system, they were built for a world of telegrams and newspapers, not high-frequency trading and algorithms. So the real challenge for you, for any modern trader, is to think about how you can take the beautiful simplicity of this 70-year-old idea and adapt it to survive in markets that move at the speed of light.
All right, let's dive in. Today, we're taking a classic trading strategy, the Darvas box, and giving it a massive modern upgrade. Why? Well, because a strategy that worked wonders in the 1950s really needs a tune-up for the kind of markets we're seeing today.
Come on, you know the feeling, right? You're up, you're sitting on a really nice profit, the trend is moving your way, and then just like that, it all evaporates. It's one of the most frustrating things in trading. And you know what? It almost always comes down to one thing. Your risk management is just not built for today's speed.
So, here's the game plan for this explainer. First, we're going to pinpoint the big problem with the classic method. Then I'll show you the elegant fix, the ghost box solution. After that, we'll talk about getting into trades when the market's on edge, dealing with the messy stuff like failures and dividends, and then we'll wrap it all up with the key takeaways you can use.
Okay, first things first. Let's really get into the weeds on why the classic Darvas method can be so risky now. It was born in a totally different time, and that's the heart of the issue.
Look, the original Darvas box method was genius for its time. Back then, markets tended to be a lot calmer. Trends would build in these nice, orderly steps, and you could just raise your stop loss along the way. But today's markets, whoa, they are a completely different animal, way faster, way more volatile.
And this chart right here shows the problem perfectly. So the trade gets entered at 593, and the stock just rockets up to 662. That's a fantastic run. But here's the dangerous part. Because a new official Darvas box hasn't formed yet, the stop loss is still stuck way, way down at 587. That huge gap? That's you risking every single penny of profit you've made. It's a disaster waiting to happen, and that's what we need to solve.
So how do we fix this giant profit-eating gap? Well, that brings us to the ghost box solution. It's a really simple but frankly brilliant way to shield your profits when a stock starts moving fast.
Okay, so what in the world is a ghost box? Think of it like an imaginary projected box. All you do is take the height of the last real Darvas box, which is basically a snapshot of the stock's recent volatility, and you project that height straight up. What this does is create a dynamic, stepped trailing stop that actually follows the price up much, much more closely.
And here's exactly how it works in 4 easy steps. First, you measure the height of that last real box. Simple. Second, you project that ghost box right on top of it. Third, and listen, this is absolutely crucial, you wait for the price to close above that ghost box. A little intraday poke doesn't count. And finally, step 4, as soon as you get that close, you immediately raise your stop loss to the bottom of the ghost box you just cleared. That's it.
Now let's go back to that same chart and see the magic happen. The price closes above ghost box A, boom, the stop loss jumps up. It closes above B, boom, it jumps again, and again for C. See what's happening? With each step, you're building a higher and higher floor beneath your trade, locking in more and more of that profit.
And this just lays out the whole concept so clearly. Instead of one giant nerve-wracking leap from your first stop loss to your second, you're just stacking these ghost boxes one on top of the other. It creates these intermediate safety nets. It keeps your stop loss tight to the price, and that is exactly how you protect yourself and your profits in a fast-moving trend.
Now, having a great exit strategy is awesome, but it's only half the story, right? You still have to get into the trade in the first place. So let's talk about how to adapt your entries, especially when the market is feeling a bit nervous.
You've really got 2 main options here, and it kind of depends on your personality as a trader. Modification 1 is for the more aggressive folks. You're getting in as a new box is still forming, basically anticipating the next big move up. Modification 2 is more conservative. You wait for the breakout to happen, and then you wait for the price to dip back toward the top of the old box, giving you a much lower risk entry point.
And you can see the difference so clearly right here. On the left, the aggressive trader jumps in early, right inside that new box. But on the right, the conservative trader is patient, waiting for that little dip to test the old resistance as new support before getting in. One is about catching the move early, the other is about waiting for proof. Both are totally valid ways to handle tricky markets.
Okay, time to get real. No trading system works every single time. So we have to talk about the practical side of things. What do you do when a trade fails, and how do you handle everyday stuff like dividends?
You know, sometimes getting out of a trade is nice and orderly. You see it on the left here, the price slips below the box, and you've got a day or two to close it out. But in choppy markets, exits can be chaotic, like on the right, where the price just gaps right through your stop. In those moments, there's no time to think. You have to be ready to cut that loss, and cut it fast.
All right, let's talk about a classic trading dilemma. You're in a stock, and it's about to pay a dividend. Now you know for a fact that on the ex-dividend day, the price is going to drop by the amount of that dividend. It's guaranteed. So here's the question. Do you lower your stop loss to account for that predictable drop?
The answer, and this might surprise you, is absolutely not. You do not touch that stop loss. It's sacred. You can see it right on this chart. The price drops because of the dividend, but that stop at 286, it stays exactly where it is. It's a line in the sand.
And here's the logic, which is so important. The bottom of that box represents the absolute most weakness you are willing to tolerate from that stock. Period. It's your exit signal. No questions asked. So, if a completely predictable drop from a dividend is enough to break that level, well, that tells you the trend was already on shaky ground to begin with. You don't make excuses for it, you respect the signal. Okay, let's wrap this all up and put a bow on it. These are the core principles that really turn this classic strategy into a powerhouse for the modern trader.
So number 1, use ghost boxes to aggressively manage your risk and lock in those profits when a trend takes off. 2, always make your decisions based on the daily close, not some wild intraday swing. 3, be flexible with your entries, especially in nervous markets. 4, never, ever adjust your stop for a dividend. And finally, remember the goal here. We're not trying to catch the exact bottom and top. We're trying to take a good, solid bite out of the middle of a powerful trend.
So, I'll just leave you with this one question to think about. I want you to take a really honest look at your own trading rules. Is your system for managing risk basically a relic from the 1950s? Or is it dynamic? Is it tough? And is it truly built to handle the speed and the volatility of the market we're trading in today?
All right, let's talk about the Darvas box. It's a classic trading strategy for sure. But here's the thing. we're going to look at how you can take this old school tool and sharpen it into a serious edge for today's wild, unpredictable markets.
So let me ask you this. You ever have a trading strategy that feels like you've cracked the code 1 minute, and then the next, it just completely falls apart? Yeah, it's super frustrating, and we've all been there. The truth is, markets change, and if our strategies don't change with them, we're going to get left in the dust. Okay, here's our game plan. First, we're going to get real about where the classic Darvas box falls short. Then we'll dive into 2 really powerful tweaks, something called breakout trading and another for mid-trend entries. And we'll wrap it all up with what I think is the real secret sauce to long-term success in trading.
So, let's kick things off with the big question. Why are we even messing with a classic? I mean, the Darvas box is legendary, but even legends have their limits, especially in the kinds of markets we're seeing these days.
You know, the original Darvas technique is honestly a work of art, but only in the perfect environment. It's built to do one thing really well: buy stocks that are already screaming upwards, making new 12-month highs. It's the perfect play for a big, roaring bull market that's already well underway.
And this chart right here just lays the problem bare. See that classic entry point way up at the top? By waiting for that brand new yearly high, you've missed a huge chunk of the move. You're basically buying when everyone else already knows it's a good idea, and you've probably left the easiest money on the table.
So that raises a massive question, doesn't it? What are you supposed to do in a market that's just starting to climb back from a big hit, or when a totally new trend is just getting its legs? If you stick to those classic rules, you're pretty much stuck on the sidelines just watching.
And that leads us right to our first major upgrade. This is modification number 1, breakout trading. This whole approach is designed to help you spot a new trend right as it's being born. So, how do we actually do this? We change the rules. And the biggest, most critical change is this one. We completely ignore the first Darvas box that forms after a downtrend. Why? Because that first pop is often just noise, a fake out. We wait for the second box. That's our confirmation that the new trend might actually be for real. Then we get disciplined, enter based on the high, exit based on the close. It helps keep you from getting shaken out by all that random daily chop. Now, theory is one thing, but let's actually see how this whole thing works on a real chart. We're going to walk through this step by step.
Okay, check out this chart of the stock Amtech. Our goal here is simple. We want to get in on this new uptrend as early as humanly possible, right after we get a signal that the old downtrend is over.
All right, now look closely. See, D-box number 1 that forms after that long slide? The secret here is just patience. We do nothing, we totally ignore it. Our actual trigger to even think about buying is the breakout above the second box, D-box 2. That simple little filter makes a world of difference. It gives us so much more confidence that we're looking at a real trend reversal, not just a dead cat bounce.
And here's where the rubber meets the road. That box confirmation entry point, that's our green light. But just as important is where we put our safety net. You see how the stop loss gets moved up as the trend keeps going? In this case, it's tucked right under the bottom of D-box 6. That is absolutely critical for managing your risk. It helps you lock in your profits and protects you if things suddenly go south. Okay, that's great. But what if you miss that first breakout? It happens, right? Well, don't sweat it, because there's a play for that too. Let's look at modification number 2, the mid-trend entry, or as I like to call it, how to safely jump on a train that's already left the station. The key change here is so simple, but it's really powerful. Instead of holding out for that elusive 12-month high, which, let's be honest, might not happen in a choppy market, we just lower the bar a bit. We look for a 6-month high instead. This flexibility gives us so many more chances to get in on a trend that's already working. Now, this next idea, this is a real game changer in how you'll look at this tool. I want you to stop seeing the Darvas box as just a simple buy here signal. Instead, start thinking of it as a volatility box. Right, it's like a container that's showing you the current tug of war between the buyers and the sellers. It's the market's energy, boxed up. And once you see it that way, you realize there are 2 totally different ways to play it. You have the aggressive trader who jumps inside the box, trying to buy near the bottom. They're betting on the breakout before it even happens. Then you have the more conservative trader. They wait. They need to see the price actually break out of the top of the box first. They want that confirmation. This chart shows that trade-off perfectly. The volatility box is basically the zone between 70 and 85 cents. An aggressive trader might try to get in down at 71 cents, right?
they're anticipating the bounce. But the conservative trader, or the classic Darvas trader, is waiting for proof. They won't touch it until it breaks above 85 cents. It's that classic dilemma. The aggressive entry gets you a better price, but with way more risk. The conservative entry gives you more certainty, but you have to pay up for it.
So we've gone through two very specific ways to tweak this strategy. But the real lesson here, the biggest takeaway, isn't about one specific tactic. It's about understanding what a true trader's edge really is. And it's this: adaptation is everything. And let's be absolutely clear on this. There is no magic bullet in trading. There's no perfect system. Not the classic Darvas box, not even these powerful new versions we've just talked about. The market is just too dynamic, too complex for any one-size-fits-all solution to work all the time. I want to leave you with this quote from the source material, because it just nails the whole point perfectly. Markets do not stand still, and we are constantly challenged to adapt or get washed out of the market. I mean, it doesn't get much clearer than that. So the final question I have for you is this. Forget about the Darvas box for a second. Think about your own trading. What's one strategy you are using right now that could be adapted, that could be tweaked or updated to better fit the market we're actually in today? Because that's where your real edge is hiding. Have you ever looked at a classic trading pattern like the Darvas box and just thought, man, I wish I could just make my computer find this for me? Well, if that's you, you are in exactly the right place. Today, we're going to do just that. We're going to build the formulas from the ground up to automate the whole thing, step by step, right inside Metastock. So let's just jump right into the big challenge. It really boils down to this one question. How in the world do you teach a computer to see a pattern that's, so obvious to our eyes? The answer is you have to translate those visual rules into a language it actually understands, and that language is formulas. That's our mission today, to build this logic piece by piece. Okay, here's our game plan. We're going to start by teaching the system how to find the top of the box, and then, naturally, the bottom. After that, we'll connect the dots to actually draw the box, and then, the best part, we'll make it automatically find the buy and sell signals. It's a really clear 4-part journey to building a complete trading expert from scratch. All right, first things first. We have to start with our very first building block. I mean, you can't have a box without a ceiling, right? So our first job is to define and then identify a potential peak in the price. We're going to call this the Darvas high. So what exactly is a Darvas high? Well, the rule is actually pretty simple. The market makes a new high, but then for the next 3 days straight, the high of each of those days fails to go any higher. It's like the momentum just stalls out. That pattern suggests that, hey, a potential top might be in place. Now here's what that simple rule looks like when we translate it into code. I know, it might look a little intimidating at first glance, but let's just break it down. All it's really saying is, hey computer, check if the highs from 3 days ago was a peak. And then, and here are all these and conditions, confirm that the highs of the next 3 days were all lower than it. See? It's just a perfect logical translation of that visual rule we just described. It's not quite enough to just find a high. Our system needs to know the exact moment a new one has been officially locked in. And that's what this next little formula does. Think of it like a trigger. It just watches that first formula we built and sends out a little spike, a signal, the very moment a new Darvas high is confirmed. And here is the code that actually creates that trigger. See how it references our first formula, Darvas high? Its job is super simple. It just watches that value, and the instant it changes and confirms there's a new peak, bam, it fires off a signal. This little signal is actually the key that unlocks the rest of our entire system. All right, we've got our ceiling. So, naturally, the next step is to find the floor. In part 2, we're going to build the logic to identify the low point that's going to form the bottom of our Darvas box. Okay, now for a Darvas low, there are 2 crucial conditions that have to be met. First, just like the high, it has to be a turning point, so a low that's followed by 3 consecutive higher lows. But second, and this is absolutely key, all of this has to happen without the price breaking above that Darvas high we already found. If it pops above that ceiling, the whole pattern is invalid. And this formula, it captures both of those rules perfectly. The first half of the code, that's just checking for a low followed by 3 higher lows. But you see the second part here, this H less than DH logic? That's our critical check. It confirms that the highs of those days all stayed safely below our established Darvas high. And this little guy acts as our system's memory. I mean, look how simple it is. Its only job is to wait for that new Darvas low signal to pop up, and when it sees it, it just grabs that low's value and plots it on the chart, holding it there until a new one is found. So simple, but so effective. Okay, this is where it gets really fun. We've got the top, we've got the bottom. Now let's put these pieces together and actually build the Darvas box right on our chart. Now, before we can actually draw the lines, we need one final confirmation. And this Darvas Boxes formula is basically our official stamp of approval. It only fires off a signal when it sees a confirmed new Darvas low that happened after our new Darvas high. This is what tells our system, okay, the box is complete, it's valid, let's go. So as soon as that box end signal appears, this formula for the Darvas box high just kicks right into gear. You can see it's just waiting for that signal, and then it simply grabs the value of our confirmed Darvas high and draws it as a line across the chart. This becomes the top of our box. And at the exact same time, its sister formula does the same thing, but for the bottom. It's waiting for that exact same box end signal, but instead it grabs the value of the Darvas low to draw the floor of our box. And just like that, these two formulas work together to create the visual boundaries of our pattern. And here it is, the payoff. Just look at that chart. Those upper and lower lines, they weren't drawn by a person. That is our code, live at work, automatically plotting those boundaries based on the rules we just built. This is that awesome moment where our abstract formulas become a real, tangible tool you can see. So the box is officially on the chart. Now we get to the final, and let's be honest, the most powerful step, teaching the system when to actually do something. Let's create the automated buy and sell signals. The sell signal is really straightforward. The bottom of our box is basically the support level, our line in the sand. So our formula just asks one simple question. Has the low of any price bar dropped below our Darvas box low line? If the answer is yes, it generates a sell signal. It's a really clear, logical breakdown. Now for the buy signal, there's a really important distinction to make. The classic, old-school rule says to buy the moment the day's high just pokes its head above the box. But the more modern version, which is better for today's volatile markets, waits for more solid proof. The price has to close above the box high. Why? Well, a close above the box tells you that the buyer stayed in control for the entire period, which really helps reduce the chance of getting faked out by a false breakout. We're going to use the modern rule. And here is the formula for that modern buy signal. You can see it right here. It checks if the close, represented by C, is greater than the Darvas box high. But the beautiful thing about this is how flexible it is. If you wanted to use that classic rule we just talked about, all you'd have to do is change this C to an H for high. It is literally that easy to adopt. Okay, finally, we just have to plug all of this into Metastock's Expert Advisor, and it's a simple three-step process. First, on the Trends tab, you tell it how to color the price bars. Say green if it's above the box low, red if it's below. Second, on the Symbols tab, you assign our buy formula to the up arrow and our sell formula to the down arrow. And third, you can even use those exact same formulas to send you custom alerts right to your phone.
And there it is, the final result. All of those different building blocks we created have finally come together. The Expert Advisor is drawing the box, and more importantly, it's automatically putting those buy and sell arrows right on the chart precisely when our rules are met. We've successfully taught the computer how to see this pattern.
So, what's the big takeaway here? We just went through the entire process, from a simple visual idea all the way to a fully automated expert. And now, you have the logical building blocks to find this classic trading strategy on any chart you want. So, we've proven we can automate this classic strategy, but that kind of leaves us with a much bigger and maybe more important question. Should we? Is this strategy that's 60 years old still relevant in the kinds of fast-moving, volatile markets we see today? Well, now that you have the tools to test it for yourself, that's a question for you to explore. Thanks for joining me. All right, let's talk about something that happens to pretty much every trader. It's that powerful, kind of baffling feeling that makes us hold on to a losing trade way past the point when every rational signal is screaming at us to get out. So let's figure out why our own brains seem to betray us the second our money is on the line. I mean, it's the perfect metaphor, right? Why do we cling to a sinking ship? You're in a trade, it's going south, everything you know about trading is telling you to cut your losses. But you don't. You hold on. What is going on there? Well, the answer is all in our heads.
Okay, this is where it gets really interesting. On the right, you see what should happen. It's just logic, right? As profits fall, more and more traders should be getting out. But look at the chart on the left. That's what actually happened in a real test. As the profits went down, fewer people got out. They actually held on tighter. It's completely backward, and it's the core of the puzzle we're going to solve today.
So yeah, let's just call it what it is. The sinking ship paradox. It's this completely counterintuitive behavior because it feels exactly like you're staying on board when you absolutely should be jumping into a lifeboat. You know, the data couldn't be clearer. Logic says, hey, as your returns are shrinking, you need to get out fast. But our psychology, it does the exact opposite. I think the pain of actually clicking the button and realizing that loss is so intense that we'd rather risk an even bigger one just to put off that feeling.
And this quote, man, it just nails the feeling. It's not a logical decision anymore, is it? It becomes purely emotional. You're not analyzing a stock chart, you're just hoping. You're hoping for some miracle, some sudden rescue that proves you were right all along.
So where does this incredibly dangerous hope even come from? It doesn't just pop up out of thin air. It's actually the last stop on a 3-part psychological trip that can take a beautiful winning trade and turn it into an absolute disaster. So here's how it goes down. First, when the trade's a winner, you get temptation. Should I take these profits now or let it run? Then after the price peaks and starts to fall, regret kicks in. Ugh, I knew it. I should have sold back there. And finally, as the trade slips into the red, that's when the third and most dangerous transformation happens, hope. And get this, in the study, traders had a chance to get out with a 34.38% return. I mean, that's a fantastic profit. You'd take that any day of the week. And yet, almost nobody took it. They were already stuck in that regret phase, and they were sliding right into that final, dangerous stage of hope. And this is the key. Hope completely reframes the situation in your mind. It takes what is clearly a losing position, a mistake, and it magically transforms it into a future opportunity. It's this powerful mental trick that lets you believe you can still win back everything you lost, and maybe even more. Okay, so how on earth does a trader justify this hope when all the evidence is pointing the other way? Simple. You start seeing only what you want to see. This is the secret sauce of self-deception in trading, and it's got a name: confirmation bias. This part is just wild. In the study, you had 2 groups of people, traders who'd already sold and those who were still holding on to this losing trade. They were all shown the exact same charts, the exact same indicators, and they came to totally opposite conclusions. And get this, both groups were congratulating themselves on making the right decision. Just look at the idea of a rebound. A trader who's clinging to hope sees a tiny bounce in the price and calls it a bullish rebound, a sure sign of strength. But the trader who already sold, they see that exact same bounce and call it a bearish rebound, a weak little gasp before the next leg down. Same data, totally different story. Let's look at a specific indicator, the Guppy Multiple Moving Averages. The hopeful trader, they just focus on the long-term averages. They'll say, see, they're still spread apart. The big trend is fine. But the objective trader looks at the short-term averages dipping down and sees the truth. The trend is losing steam right now. It's a classic case of cherry-picking your data. Or how about the RSI? This is where the bias gets really creative. A hopeful trader might literally start drawing new trend lines on the indicator itself, which is not really how it's used, just to invent signs of a new uptrend. The reality, the RSI isn't signaling anything at all, it's just noise, but they're interpreting it as a sign of hope.
And one last one, the MACD histogram. The hopeful trader looks and says, oh, it's stabilized. An uptrend could be right around the corner. They're literally projecting a future that doesn't exist yet. The simple reality is the indicator is below the 0 line, period. That's a bearish signal, not a bullish one. So, we've seen the paradox, we've walked through the psychological journey, and we've exposed the sneaky mechanism of confirmation bias. Now, we're going to flip this around and put you in the hot seat.
You've just seen how easy it is to fool yourself, how you can stare at a chart and only see what you want to see. So now it's your turn. You have to make a call, but you're armed with the knowledge of these psychological traps. Okay, here it is. This is the chart, updated with the price action from the next few days. Take a second, look at what happened. That trend line has been decisively broken. And here are the indicators to go with that new price action. The short-term GMMA group is now diving headfirst into the long-term group. The RSI is falling off a cliff. The MACD is deep in negative territory. The evidence? Well, it seems pretty overwhelming. So what's it going to be? After everything you've just seen about the incredible power of irrational hope, can you make the rational choice? Is it finally time to jump from the sinking ship? Or are you going to stay and just hope for a miracle? The decision is yours.
All right, let's talk about something that drives traders absolutely crazy. You can have the most perfect back-tested strategy in the world and still lose money. So what gives? Well, it turns out the real battle isn't on the charts. It's happening right inside your own head.
I mean, think about it, right? You've probably put in countless hours, you've done the research, you've crunched the numbers, you're a smart person. But when it's go time, when your money's on the line, something just breaks. It's this huge paradox in trading, and that's exactly what we're going to dig into.
And here's the kicker, the part that's maybe a little tough to hear. The problem probably isn't your plan. Nope, it's you. It's kind of like that brilliant student who knows all the material, aces every practice test, but then completely freezes up during the final exam. The knowledge is there, the plan is solid, but the execution, that's where it all falls apart, right when the pressure hits.
So, to really get to the bottom of this, we have to look at this idea that inside every single trader, there are basically two different people, and they're locked in this constant battle for who's in charge, especially when real money's on the line.
And the source material for this explainer has this fantastic analogy for it. Think of yourself as Dr. Jekyll when you're planning a trade. You're calm, you're rational, you're setting all your rules, everything is logical. But then you click buy, and it's like a switch flips. Suddenly, the emotional, totally impulsive Mr. Hyde bursts onto the scene and takes the controls.
And this really breaks down that internal tug of war. Over here, you've got Dr. Jekyll. This is the trader you want to be, right? Calm, objective, sticks to the plan no matter what. And then there's Mr. Hyde. He's all fear and greed. He couldn't care less about your plan. In fact, he's the one who grabs it, crumples it up, and throws it right out the window.
Okay, so what is it that unleashes this monster? I mean, if Dr. Jekyll is so smart and has everything planned out, why on earth does he let Mr. Hyde take over the second a trade goes live?
Well, it really comes down to one thing: isolation. See, in almost every other part of our lives, we have these invisible guardrails, right? Social pressure, what will other people think? That keeps our worst impulses in check. But trading? Trading is often a really lonely game. There's no boss, no coworker, no one looking over your shoulder, judging you as you decide to ignore your stop loss. It's just you, your screen, and your emotions running wild.
And this is what Mr. Hyde sounds like in your head. First, it's that little whisper, that bargaining. Come on, just a few more cents. Let the loss get back to a point where it's not so bad. It's that dangerous hope.
And then, when that doesn't work, it's pure, raw panic. Sell everything! Get out now! All logic is gone. The plan is a distant memory.
And this diagram just nails that emotional roller coaster, doesn't it? It all starts with so much optimism at the buy point. Then, as it goes up, greed kicks in. You feel like a genius. But then, it turns. Denial sets in. It'll come back, you tell yourself. Fear starts to creep in, and then bam! Full-blown panic, and you sell everything at the worst possible moment. That right there is Mr. Hyde's signature move.
Okay, so we've seen the monster, we know what the problem is. The big question now is, what do we do about it? How do we build a cage for Mr. Hyde and make sure Dr. Jekyll is the one calling the shots? Let's talk solutions. What we're aiming for here is something called trading discipline. And listen, this isn't about becoming an emotionless robot. That's just not going to happen. We're human. It's about building a system, a skill, that keeps your rational brain, your Dr. Jekyll, firmly in control, even when the market is going completely haywire.
And the solutions we're going to look at break down into three main buckets. We've got internal solutions, stuff you do for yourself, social solutions, where you bring other people in, and external solutions, where you use tools to kind of force your own hand. So let's break them down.
First, let's talk internal solutions. See, Mr. Hyde loves paper losses because they don't feel real. They're just numbers on a screen. So your job is to make them painfully real. If you're down $500, literally transfer $500 from your trading account to another one. Make it disappear. Or go old school. Write that loss in huge, angry red numbers and tape it to your monitor. The whole point is to make that loss so real, so impossible to ignore, that your Dr. Jekyll has no choice but to wake up and deal with it.
Okay, next up, social solutions. Remember how we said isolation is what unleashes Mr. Hyde? Well, the cure for isolation is community and accountability. You've got to drag your trading out of the dark and into the light. Tell your spouse about your open positions, join a traders club, and share your plans. Just the simple act of knowing you'll have to explain why you broke your own rule to someone else is often enough to keep you honest. You're basically rebuilding those social guardrails that keep us in line everywhere else.
And finally, we have external solutions. This is basically about handing over the keys. Your calm, rational Dr. Jekyll makes the plan, sets the stop loss, sets the profit target. But then, you take your own emotional hands off the wheel. You give the plan to a partner to execute, or you use a service that automatically closes the trade based on your rules. You're essentially creating a system that completely bypasses Mr. Hyde. He never even gets a chance to argue. Just one really important warning here. You're outsourcing the execution, not the thinking. The plan is still 100% on you.
So, when you start combining these things, the internal, social, and external tricks, what's the end game? What are we really trying to do here?
It's this. This is probably the most important thing to get. The goal is not to stop feeling fear or greed. You can't. You're a human being. The goal is to become a brilliant architect of your own trading. You design a system around yourself using these internal, social, and external tools that makes it impossible for your emotional, impulsive Mr. Hyde to grab the keyboard and make that final disastrous decision.
So I'll leave you with a question to think about. You've spent all this time building your plan, right? Perfecting your Dr. Jekyll. But how much time have you spent actually studying your Mr. Hyde? Do you know what triggers him? Do you know what he sounds like? And most importantly, have you started building his cage yet?
You know, every single trader has been there. You hit a string of losses, your plan suddenly feels like it's falling apart, and you get that sinking feeling in your gut. What's the first instinct? Well, it's to blame the market, right? But what if the problem isn't out there? What if it's right in your own system? That's the huge question we're going to tackle.
So which one is it? Are you just having a temporary run of bad luck that you need to power through? Or is it a red flag for bad trading, a really deep fundamental flaw in how you're approaching things? Getting this answer right is, I'm not kidding, one of the most critical things you can do to actually survive and, hopefully thrive as a trader.
It's such an easy trap to fall into, right? When you're losing money, it honestly feels like the market has a personal vendetta against you. But like the source material says, blaming some secret conspiracy or just hoping your next trade hits the lottery, well, that's not a strategy. The real path forward is figuring out the difference between what you can control and what you can't.
Okay, so let's get practical. Instead of just getting lost in that feeling of frustration, we can actually diagnose the problem just by looking at it. We're going to check out the loss patterns of 3 different traders, and it'll give us a really clear picture of what a good system, a bad system, and just plain old bad luck actually look like.
All right, first up, we have Trader 1. Now, what's so cool about this is the pattern. You see that box? That's the zone of expected, totally acceptable losses for their system. And look at the dots. Almost every single loss falls right inside. But you see that one single dot way up top? That is a random event. That, my friends, is what actual bad luck looks like. It's not a broken system.
Now, let's switch over to Trader 2, and oh boy, the story changes completely. The pattern here is, well, all over the place. A huge number of losses. We're talking 5 out of 15, that's a third of them, are falling way outside the acceptable range. This is not random anymore. This is a clear pattern of failure. This isn't bad luck. The source is telling us this is a sign of some very, very bad trading.
And finally, Trader 3. This one's a little trickier. The losses are pretty consistent, right? There's only one outlier. But just look at the size of that box. It's way, way bigger than the 2% of capital line. So yeah, this trader is consistent, but they're consistently losing way too much money on their trades. The system itself is like a leaky bucket, making it almost impossible to ever get ahead.
So these visuals give us a fantastic gut check. But to get really serious about this, we have to move from pictures to hard numbers. We need a real tool that can measure our trading consistency and tell us exactly how big a role luck is actually playing. And that tool is called standard deviation. Now, don't let the name intimidate you. Just think of it like a golf score for your trading consistency. That's it. The lower the number, the more consistent you are, the more control you have, and the less that pure luck or randomness is a factor in your results. And this slide just shows you how powerful this is.
On the left, you've got a trader who started out really inconsistent with a score of 4.86. After they tweaked their system, that score dropped all the way down to 1.41. That's a massive improvement. Then on the right, you see the opposite. A trader started with a great score, 1.34, but then completely lost control, and their score ballooned up to 5.22. See, the numbers tell the whole story.
But here's a question. What happens when one single, catastrophic, genuinely unlucky trade just blows up your numbers? It can totally distort all your data and make it look like your system is getting worse, even when you've actually been improving it. How do we deal with that?
So let's look at this case right here. This trader started with a consistency score of 1.34. Pretty good. They worked on their system, but then, bam, they get hammered with one massive, unlucky $1,500 loss. Now, when you include that one trade in the math, their score actually gets worse. It jumps up to 2.82. It looks like they went backwards, but did they really? Nope, not at all. Once you correctly identify that one crazy trade as a bad luck outlier and you take it out, the real picture comes into focus. The new true consistency score is 1.05. That's a huge improvement, proving the new system is actually working much, much better. And here's exactly how you do it. First, you find that one trade that is just way bigger than all the others. Second, and this is super important, you have to remove the entire trade from your data. Just delete the whole row. Don't just replace it with a 0. Then you can recalculate your score. But the source gives a really important warning here. If you find yourself removing 2 or 3 or 4 of these bad luck trades, you're not dealing with luck anymore. You're just in denial that your system is broken. Okay, so we can measure consistency. That's a huge step. But what if you're trying to choose between 2 completely different trading systems? Maybe one is high return but high risk, and the other is medium return but low risk. We need a way to compare them, apples to apples. And for that, we have the Sterling ratio. This is basically the ultimate scorecard. It directly compares your average profit to your average biggest loss, and it spits out a single number that tells you how good your system's risk-to-reward balance is. The goal is simple. The higher the ratio, the better the system. Period. Okay, so let's put it to the test with 3 different systems. You got System A with a 40% return, System B is a little less at 35%, and then there's System C, which looks like an absolute rock star with a 45% average return. Now, just based on returns, you'd pick C in a heartbeat, right? But which one actually has the best risk-reward relationship? Well, the Sterling ratio gives us the real answer. System B, the one with the lower return, is actually the best system of the 3. And why is that? Because its average loss is just so much smaller. It gives you the best bang for your buck, risk-wise. And would you look at System C? That monster 40% average loss completely destroys its high returns, making it barely better than a coin flip. All right, we have gone from a simple gut feeling of frustration all the way to a precise, data-driven diagnostic process. So let's wrap all this up into a clear action plan that you can actually use to ditch luck for good and really take control of your trading. So to recap, here's your diagnostic toolkit. First, just visually scan your loss patterns, just like we did with those 3 traders. Second, calculate your standard deviation to get a real number on your consistency. Third, know how to properly handle those true bad luck outliers so you can see the real trend. And finally, use that Sterling ratio to find the system with the absolute best balance of risk and reward. At the end of the day, it all comes down to this really powerful idea from the source material. Getting a lucky trade is a great feeling. It's a nice bonus, but it is not a strategy. Real long-term success comes from building a skillful system that doesn't need to get lucky to win. So I'll leave you with this one question to really think about. Take an honest look at your own results. Is your system truly built to withstand the occasional, inevitable, unlucky hit? Or deep down, are you just closing your eyes and crossing your fingers, hoping your luck is about to change? You now have the tools to find out the real answer.
All right, welcome. Today, we are going to tear apart one of the biggest myths in the entire financial world, the idea that there's some kind of secret trading formula out there. And we're not just going to talk about it, we're going to dissect this incredible real-world experiment that shows you what really separates the successful traders from, well, everybody else. So let's jump right in.
This is the question, isn't it? It's what every trader is looking for. Is there some hidden indicator, some secret piece of info that the pros have and you don't? We're all looking for that magic bullet.
But what if I told you the secret isn't a formula at all? What if it's actually something inside you?
So to get to the bottom of this, we're basically putting the entire myth of trading secrets on trial. And like I said, we're not just going to talk theory. Nope. We're going to look at the cold, hard results of a live trading exercise where the very idea of a secret was completely eliminated.
I want you to just picture this for a second. What if you gave a whole group of traders everything they could possibly need? The exact same charts, the same data, the same technical indicators, and even the same predefined trading plan, right? No one has an advantage. So what do you think happens? Does everyone end up with the same results?
Okay, so now we get to dive in. We're going to follow the anatomy of one single anonymous trade from this experiment. We're going to watch it go on this incredible ride up, and then we're going to see that critical moment where the plan and raw human emotion just slam into each other. And trust me, that's where the real story begins.
So the setup here was basically a perfect laboratory. First, the stock was anonymous, which is huge, right? It strips away any bias or any preconceived ideas somebody might have. And then everyone saw the exact same charts, the same indicators, and this is the most important part. They all had the exact same trading plan. It was a perfectly level playing field, all designed to isolate just one single variable, the trader themselves.
Just look at the journey this trade took. The price went on this absolutely incredible run, hitting what the analysis calls a bubble peak. Now, at that exact moment, traders are just staring at their screens, looking at this spectacular potential profit. Can you imagine the pressure, the greed? That little voice in your head just screaming, "Sell now, take the money."
And how spectacular are we talking? Well, at its absolute tippy top, this trade offered a staggering 68.75% return. That was it. That was the perfect exit. The absolute best outcome anyone could have possibly gotten. Now remember that number, because it's kind of the ghost that's going to haunt the rest of this story.
And right here, this brings us to the battleground. On one side, you've got the cold, hard logic of a trading plan that you agreed to. And on the other side, you've got the primal, powerful forces of human emotion, fear and greed. This is where the real experiment starts, inside the mind of every single trader.
So right after that peak, the technical signals were just screaming. I mean, you can see it right here on the chart. The price broke below this rising trend line. That's a classic sign that the upward momentum is fizzling out. And then the moving averages crossed over, another textbook sell signal. The data left absolutely no room for interpretation. The plan was crystal clear. It was time to get out.
And this is where the two paths just completely split. The rational trader, they followed the plan. They acted on that clear exit signal, and they walked away with a very, very nice 40% gain. But the emotional trader, oh, they froze. They held on, just hoping for a rebound, totally paralyzed by fear and greed, and they ended up with just 25% or maybe even less. Think about that. The difference between discipline and emotion cost them 15% of their profit.
So why? Why did so many people choose that emotional path? Why did they just fail to act when everything was telling them to? Well, let's dig into the psychology of it, because it wasn't a lack of information. No, it was because they were being held captive by one single powerful emotion: hope.
Now look closely at this chart again. See that part labeled Area A? As the price was falling and all the signals were blaring sell, the number of people actually exiting the trade plummeted. It went down. That is completely irrational behavior. Logically, selling should have surged, but instead, people just froze, glued to their screens almost in disbelief.
And the source material just says it perfectly. It says that even with all the evidence staring them in the face, even with their own pre-agreed plan telling them exactly what to do, the majority of traders just held on, betting on hope instead of data.
And I mean, there was zero room for doubt here. This summary table shows the mountain of rational evidence that they just chose to ignore. The count backline, which is a tool for identifying exit points, was flashing red. The moving averages had crossed. The trend line was broken. Every single indicator was singing the exact same song, and that song was "Exit the trade now."
So, after all of this, what's the big takeaway? What did we learn? Well, this whole experiment pulls back the curtain on the only true sustainable edge a trader can ever have. And spoiler alert, it has absolutely nothing to do with a secret formula.
And here it is. The real trading edge isn't something you find, it's something you build. It's not about some secret indicator or a hidden piece of information.
It is the disciplined ability to follow your plan and to manage your own emotional responses to the absolute chaos of the market. It's an internal skill, not some external tool you can buy.
So the conclusion here is just undeniable. You can give a group of people the exact same information, the same tools, put them at the same starting line, and they will still end up with wildly different results. Success isn't about what you're given, it's about what you do with it.
And I want to leave you with this last thought from the source material because, man, it just says it all. Your edge isn't found in some secret newsletter or a complex algorithm. It comes from making better use of the information that we all have access to. It comes from you. The secret, it turns out, was never really a secret at all. So the real question is, now that you know, what are you going to do about it?
Hey everyone, and welcome. Have you ever looked at a financial chart and just felt completely lost? Like you were trying to decipher some ancient, forgotten language? Well, you are definitely not alone. And today, we're going to talk about why that exact feeling is actually the secret to understanding it all.
This quote just hits the nail on the head, doesn't it? We're always being sold these easy fixes for things that are, incredibly complex. Whether it's mastering Mandarin or the market, the reality is there's no magic button for either one.
You know that feeling, right? Staring at a screen just packed with flashing numbers, weird-looking charts, and all this insider jargon. It's totally overwhelming. And for so many of us, that first hit of confusion is enough to make us just turn around and walk away for good.
So, this is the big idea for today. Trying to understand the market is almost exactly like learning a brand new language. I mean, think about it. Both are super intimidating at first. Both seem hopelessly confusing, and both have their own unique vocabulary and, their own grammar that you have to figure out.
All right, let's dive into that a little bit more. Why is it that the market feels so alien, so much like a foreign language when you're just starting out?
Well, when you first step into this world, it's like a total assault on your senses. You're bombarded with confusing language, terms you've never heard before, and charts that honestly just look like gobbledygook. And then, on top of all that, the advice you get can feel so intimidating. It makes you feel like you don't even belong there.
But here's the kicker. We can't really just ignore it, can we? There's this mounting pressure on all of us, from society, from the government, to take charge of our own finances, especially for things like retirement. So, like it or not, we're all being pushed to learn this strange, difficult new language.
But what if it isn't just chaos? What if there's actually a logic hidden inside all that noise? That's what we're going to get into next, how you can start to crack the code.
And this, right here, is the crucial shift in your mindset. The market isn't just random. Just like any language has rules of grammar, the market has its own internal logic, its own structure. It's a system, and any system can be learned.
To someone who's never seen one before, a candlestick chart is just as nonsensical as a character from a foreign alphabet. They both just look like symbols. But for the people who learn how to read them, each one is absolutely packed with meaning. Each one tells a very specific story.
And really, that's the whole goal here. It's not about becoming a financial genius overnight. It's about cracking the code. Because once you start to grasp the basic rules and the structure, the whole picture starts to get a lot clearer, and it all becomes so much easier to understand.
Okay, so if it's learnable, what does that journey actually look like? Let's get real about the process and what to expect.
I absolutely love this quote because it is so honest. You're not going to wake up one day and suddenly have it all figured out. There isn't some big aha moment. Nope. Instead, it's a slow burn, a gradual process where your understanding just grows bit by bit, day by day.
This is pretty much the path to fluency. You start with just complete bewilderment. But then, after a while, you start picking out individual words, recognizing a simple pattern on a chart. And then you start reading headlines, understanding the bigger trends. And eventually, step by step, all that confusion starts turning into real comprehension.
There's this great personal story about this in the source material. The author talks about sitting in these awful traffic jams and just trying to recognize a few Chinese characters on the signs outside. He said it was painfully slow, but over time, he went from picking out a character here and there to actually being able to read the headlines in a newspaper. That is gradual learning in a nutshell.
And isn't that just the truth for learning any new skill? When you're right in the thick of it, it feels like you're making zero progress. But if you just pause for a second and look back at where you were a few months ago, or even a year ago, you'll probably be amazed by how much you've actually picked up.
So all of this leads to a fundamental choice. It's a choice everyone has to make when they decide to approach the market. So what's it going to be? Are you going to be a passenger, just along for the ride? Or are you going to be the driver, taking control of the wheel? And trust me, this isn't just a metaphor. It defines your entire approach.
Let's break this down. The passenger just gives up control. They rely 100% on translators, like financial advisors. And by doing that, they risk getting, well, taken for a ride. The driver, on the other hand, puts in the effort to master the language. They learn to read the signs for themselves, and ultimately, they're the ones in control of their own journey.
And this is a really crucial point. Being a driver doesn't mean you have to do everything yourself. Even if you decide to work with an advisor, learning the language empowers you to check their translation. It gives you the ability to make sure the advice you're getting is legit and actually in your best interest.
Okay, so how do you make sure your own financial goals don't get lost in translation? Let's lay out a clear path forward. Here are 3 simple first steps. 1. Learn the alphabet. That just means understanding the basic building blocks of a chart, its written characters. 2. Start forming words. Learn how to read simple price movements and basic trends. And 3. Build your vocabulary. Pick up a little new knowledge every single day. That's how you make the market feel less and less foreign.
This really just brings it all home. The whole reason to do any of this is to protect your own goals. When you learn the language of the market, you make sure that what you want for your future is actually what you're working toward.
It all boils down to this, really. You don't have to become fluent tomorrow. You don't have to be the world's leading expert. Taking control. It all starts with a simple decision to learn that very first word.
So I'll leave you with this question to think about. What is the first word you're going to learn to start your own journey? It could be anything. Understanding a term, figuring out a type of chart. What's that one small step you'll take to make sure you're the driver, not just the passenger?